Okay, everyone. Good morning and welcome to the Token Engineering Global Gathering, the TEGG 2019. It's such a pleasure to have you here, and it was actually such a pleasure to prepare this event. Thanks to the collaboration with DebCon and East Berlin, we're able to run this full-day program on tokens, and I think we have an amazing lineup of talks, and this is another milestone to develop token engineering as a discipline in its own right. So only 1 year ago, we started this up with the first inauguration event during New York Blockchain Week. Then there was a second global gathering in 2018 in Berlin. And today we have a growing community worldwide. So we have 17 meetup groups in 13 different countries who ran in total 63 meetup events on token engineering over the last 15 months. And in addition to that, there's a range of projects working on cryptoeconomic models, sharing their knowledge and open source their work. And some of them you will meet today, like the CatCat beta testing group, like CommonStack or Protea. And I'm really glad that we have also speakers from the research sector today here on stage, because this collaboration between practitioners and research is important to drive token engineering. And we will hear more on that in a minute in Sherman's talk. Token engineering is a multidisciplinary effort. It combines domain expertise in engineering, economics, computer science, and data science. And for making progress, we need this collaboration of those different disciplines, and we need collaboration between practitioners and research. And what sounds quite easy is sometimes hard to achieve. How to align the spirit of hackers and scientists, of builders and researchers, and of make and break with engineering ethics. So we try this at TEGG, and I think it's worth the effort. And this is why I'm really grateful for the crowd here today, because you all understand that in such an early stage, it's important to think beyond the borders of your own peer group. Expose yourself to different mindsets, mental models, and languages. And here I'd like to highlight two players in our community which are spearheading this multidisciplinary work. It's Block Science, Michael Sargem and his team, and the Cryptoeconomic Research Lab of the University of Vienna, who also curated the research talks today. And Chris, where are you, already here? Chris Paru. I remember the several phone calls we had to produce this program, and this was truly a multidisciplinary effort, and I'm very grateful for this collaboration. So let me briefly walk you through the program today. We start with an opening keynote on state of the arts in tokens, and then we take a look at the current challenges in blockchain projects. Funding and token distribution, decentralization and governance, regulation, irrational behavior of system agents, and the challenges of a token launch. So throughout this morning, we'll explore the context and the requirements for cryptoeconomic systems. And the afternoon is dedicated to solutions and research. How can we better model token economies? How does the design and engineering process look like? What's the difference, what's the definition of token engineering as a scientific field, and how can we apply scientific methods to build token economies? You'll also have the chance to attend 2 workshops in the afternoon. One is an introduction workshop on the CatCat simulation framework, and the second one, Ask Me Anything session with DWF on regulation of token economies. And finally, we'll close the day with some great projects and initiatives in token engineering. And this is a call to action for you to get involved. because the tech should be a catalyst for future activities. Your starting point to contribute and to benefit from this growing ecosystem. So what's the future for token engineering? First, I would love to see token engineering in every single blockchain project as an own domain and own role, very much like software development. And just like in software development, we need specific tools, frameworks, and processes. Token engineering is complex systems engineering. So when looking at the discussions in our space over the last 2 years, we see a shift from technology towards organizations. So remember the talks, for example, at Web3 and at DebCon. We are not only discussing protocols and technology, actually we are discussing new forms of organizations, DAOs. We are discussing power. So we are building complex socio-technical networks, and we will be engineering power in such systems. Tokens will grant access. Tokens will define rights and decision-making. And tokens will offer economic incentives. And these economic incentive machines will make people do stuff. And I think we haven't even understood yet to what extent these economic incentives in blockchain token systems will define our world in the next decades. So let's use this power in a conscious way. Because what's the point in all our efforts if we didn't contribute to solving the major challenges of our time? Can we create new economies for sustainability, for freedom, for justice, beyond nation borders, on a global scale? For this, we need to tackle complexity. We need to embrace complexity. So we have the chance to redefine the rules of the game in the 21st century. We have the chance to fix the flaws in our systems. Let's take this chance. So now enjoy this day, get inspired. Thank you for being here. Looking forward to the talks and conversations of today, and looking forward to all our joint activities we'll be starting tomorrow. This is a community effort. Let's build successful and sustainable blockchain token economies. I'd like to start the day with Sherman Foschkmir. She's director of the Cryptoeconomic Research Lab at the University of Vienna, a pioneer in and for token engineering. You have founded the Blockchain Hub Berlin, and most recently published a book which is available here. It's called Token Economy, and we will learn more about this in your talk. Welcome, Sherman.
Hey, thank you very much. I know it's the end of an exhausting week. There's been many conferences, many evening events, too many, in fact. So I really appreciate everyone who could make it early this morning here. And thank you, Angela, for setting up this major event. It's not easy, I know that myself, to start a new brand, a new topic, and especially if it's interdisciplinary. So I'm very glad we are here today to talk about token economics. Where's my clicker? Here, right. Yeah, I have to turn this on, you know. Technology is sometimes complicated. It's not actually. So if we look at the evolution of the internet, we can see that the web brought us the information revolution. The Web 2 in the end brought us kind of the platform economy. And the Web 3 can be seen as the token economy. In my opinion, tokens are the killer app of this new Web 3. And we haven't seen the beginning of it yet. It's only just started, and people are trying to make sense around what they can do with tokens, very similar to the fact or to how people in the early 90s, when hypertext came up and allowed us to create visual websites, people all of a sudden could create websites, but they didn't know what to put on it. So it said hello world, or maybe it was kind of a link at a search engine to an accumulation of information you could find somewhere else. But for a long time, people didn't know really what to do with these websites. And we're at the very similar stage when it comes to this new token economy. So tokens, in fact, are not a new thing. I think most of you very well are aware of the fact that tokens have existed for a long time. We've had asset tokens starting with shells and any type of really vouchers, computer chip, casino chips, etc. Royalty programs can be seen as some kind of asset tokens, but also the computing world has known tokens, and cognitive psychology has used tokens, among others, for positive reinforcement techniques to incentivize some kind of behavior. And these computing tokens very often manifest as QR codes, etc. But what we can now do with blockchain tokens, we can combine asset tokens with access tokens, with kind of incentive tokens, and we can do that at very, very low transaction costs, because the kind of copyright mechanisms, the counterfeiting mechanisms that tokens need so they're not copied are usually costly, and we don't need to invest so much in making them copyright protected, because we can now use a public infrastructure like a public blockchain network to manage these tokens. So these blockchain tokens are essentially rights management tools that give me access to either something I own or something someone else owns or a collective is maybe managing. And they are very, very powerful tools. We can see that as of today, if we go on CoinMarketCap, we already have over 2,000 publicly listed tokens, but they're a very special type of tokens. They're fungible tokens that are transferable and that can be traded, but we've seen recently a very much more interesting and diverse brand of tokens that we can create, any type of non-fungible token that might be tied to an identity, etc., etc. If we go on, for example, Etherscan, we can see that the Ethereum mainnet only has already 200,000 token contracts have been kind of deployed on the Ethereum mainnet only. So this thing is happening, but we're still in this very early stages of creating tokens and figuring out what we can do with it. So issuing a token has become very cheap and easy. But how to design this token, the engineering, the socio-economic engineering of the token is a very different question. What is the purpose of the token would be the first question. Derived from that, what should the properties of a token be? And derived from that, we can now create some business and governance models around these tokens. And if you would ask me today, very often when people talk about tokens, they talk about tokens, or they classify tokens from a kind of regulatory perspective. So we hear about security tokens and utility tokens and whatnot. And I think while that is a very important aspect, this is not where we should start. We should start looking at tokens in a more generic way. What can we theoretically do with these tokens? And as we looked at token kind of business models or token systems, we can classify them into simple token systems and complex token systems. Simple token systems would represent any type of asset or access right to goods and services that we already have today, like an asset token, for example, a token that represents a piece of art, or any type of security token, or a token that represents maybe a fraction of a real estate, right? Or access rights, tokens that give me access rights to a concert, or maybe to perform operations in a network. These simple token systems require mainly legal engineering. I'm saying mainly, not only, obviously, but the main part here is how can I create these tokens so they're legally compliant? So here the legal engineering part is predominant. Now, when we look at the complex token systems, for example, purpose-driven tokens, here the economic engineering part becomes much more important, and this is what we will be speaking about today, mostly throughout the whole day. So what is a purpose-driven token? Bitcoin, in fact, is a purpose-driven token, and it enables us to have a completely new type of coordination tool for networks, or for steering coordinated action of people who try to achieve something. So we're moving away from the coordination mechanisms of having top-down organizations to coordinated action in a network of untrusted actors that are coordinated by the token governance rules that incentivize individual behavior towards collective action, towards a purpose of the network. And the purpose of Bitcoin is to provide a peer-to-peer payment network. And if you perform kind of security operations for the Bitcoin network, you get rewarded with the token through the block rewards. So purpose-driven tokens are, for example, state layer tokens like Bitcoin, Ethereum, etc., for the purpose of creating this universal state layer that allows us peer-to-peer transactions. But we could also have other types of purpose-driven tokens, like, for example, any type of social media tokens, like Steemit, tokens that get minted upon kind of contribution to the network. When you provide content to the network, you can get rewarded with a token. Attention tokens would be such an example. Some type of token curated registries, or CO2 tokens. In fact, with the city of Vienna, we're working on a prototype to incentivize people to reduce CO2 emission, and when they can prove it, they get rewarded with a token. So these purpose-driven tokens are very interesting, and I think this is what most people don't talk about when they talk about Bitcoin, is because they represent a new type of value creation. If we look at how the economy works today, our current economy predominantly incentivizes individual action towards creating private goods. And public goods are created usually by public institutions, railroads, any type of public service, healthcare, etc., is provided by trusted third parties through very often taxpayers' money. Purpose-driven tokens like Bitcoin transcend this dichotomy and kind of transcend, in a way, this concept of, which I think is antiquated, communism versus capitalism, because it incentivizes individual action towards a collective goal. And I think this is a very, very interesting area of research of creating purpose-driven networks, and we will hear more about it later this afternoon from Jamshid, who I'm very happy to collaborate with in our research. He will be joining us starting next month. So, if we look at blockchain networks, we can say that blockchain networks are complex systems. We have simple systems and complex systems, and simple systems can use reductionist tools to kind of map and plan them and organize them and steer them. Complex systems are, well, a bit more complex, and social systems tend to be complex systems, and economic systems are a subset of social systems. And therefore, I believe that blockchain networks are, in fact, socio-economic systems that are in specific, they're networks, multigraphs, in fact, they're adaptive, they're multi-scale in time and space, they're stochastic, and they're dynamic. So if you're not a math person, that might be gibberish for you, but Chris, later on this afternoon, will be going into the details of what that means. But to sum it up for the purpose of this talk, complex systems are different from simple systems that, because the system behavior cannot be easily implied from state changes induced by single network actors or maybe coordinated action of network actors. So blockchain systems are complex socioeconomic systems, but they provide us, and they're very interesting in a way because they provide us with a rich and almost real-time data set of all kind of reflecting all economic action in the network. And this is something we've never had before. And this is something that now allows us to apply new tools and techniques in steering these economies because our analog economies of our nation states don't have this real-time data. And so the tools that we're using in macroeconomics to steer our economies, they are very often reductionist and needed to be reductionist because they didn't even have a data set to build on, right? And even if they had the data set, up until the emergence of data science, computers, the internet, and data science, we didn't even have the computational power to kind of compute everything that is happening and make sense of everything that is happening in an economy. But given the advances of data science, and given the fact that these socioeconomic systems, these blockchain networks, have this real-time data, allows us to do really cool things. And this is what we're building in our research together with our partners, Block Science, etc. So we're trying to build this new academic discipline called, and you'll hear more about it from Michael Zarkam, economic systems engineering. And here we want to combine rigorous economic methods with engineering methods to enable the steering of these complex systems and the steering, regulation, and control of these complex systems. We would like to build on the powerful consensus mechanism that kind of proof of work showed us, that we can achieve consensus in a network of untrusted actors, but maybe make this consensus mechanism that is very resilient but not flexible, more adaptive, and create complex adaptive systems, building on ideas like Elinor Ostrom, Hayek, etc., etc. So there are many researchers that have criticized the lack of tools and methodologies for steering complex systems, and I think finally we're there to do that. So what is token economics? I've had a lot of discussions this week. Is this really economic? Isn't it just economics? Well, yes and no. Obviously, token economics is a subset of economics, and as such also an emerging field. It studies, to make this whole thing short, is basically economics, right, around the consumptions of goods and services that have been tokenized. If we look at economics, this is a slide that shows you all the schools of economics that we have. So each box is kind of a different school of economics, and each school has their own points of view, their own methods. They sometimes overlap, they sometimes agree, but very often disagree and say quite contradictory things. So there is no one thought or one school of economics. But that's not the whole picture. There is a second. We needed a second slide to show this picture, is this whole thing. Economics as such is quite a diverse discipline. And in cryptoeconomics, the economics kind of domain needs more space. And given the fact that cryptoeconomics comes more out of the computer science field, we believe that there is a lot of room to apply, to look at existing tools in economics and see which kind of models would be appropriate in building complex systems. Isn't it just economics? I don't think so, because as we're approaching the full tokenization, our economy, and the speed at which these tokens are currently being issued is, I think, a strong indicator that eventually, the timeline is unclear, but maybe rather sooner than later, all our goods and services will be tokenized. The real world goods and services and all the other digital services that we're tokenizing. And at this point, it is really unclear how such tokenization of our economy will affect the overall system dynamics of our economy, right? And this in itself is a study, requires kind of a specific studies of token economics, in our opinion. To conclude, and I think this is probably the most important slide, I would like to argue that these blockchain networks or purpose-driven systems that we are also creating with application tokens, they are mission-critical and safety-critical systems. Why? Because they come with an inbuilt economic incentive layer. So a failure of these systems might provide huge collateral damage of many actors involved. And we've seen that with the DAO. We've seen that in many protocol upgrade debates. We've seen that with the multi-sig failures of the Ethereum network. These mission-critical and safety-critical systems need completely different rigor in research and development than a website in 1992 needed, right? We're not building a search engine. It matters whether the system will fail or not, because a lot of people will lose money if it fails. So we need different approaches to building these systems, and the startup mentality of Silicon Valley of get shit done is not appropriate. And we've seen it because a lot of people over the last few years have lost money because of that. So we need to enter, as we're entering really this network economy, as we're changing this backend of the internet that comes with this thick economic layer, we need to understand that we're building these mission-critical systems, and we hopefully will see many advances in rigorous economic systems engineering. And I'm very happy to point out that Michael, Jamshid, Chris, and many others will be speaking about that later this afternoon. Thanks very much.
Thank you, Sherman, for this talk.
Yeah.
I think we have a couple of minutes left for Q&A.
Yes. Okay.
So any questions?
There's no question. Maybe until there is...
Yeah.
Yeah.
There's the mic.
Yeah, two questions.
Hi, yes. Can you just touch on non-fungible tokens?
I mean, non-fungible tokens is a big world, right? By the way, I forgot to mention, I didn't finish on the last slide, that one of the first things we did out of the Research Institute is that I wrote this book, Token Economy, which is also for sale here. You can also buy it online. There is a whole chapter on NFTs, by the way. But non-fungible tokens are... it really depends what you want to do. An identity token could be a non-fungible token. Any type of reward token could be a non-fungible token. For example, we're doing this use case with the city of Vienna where we want to incentivize people, if they can prove with their app that they walked or took the bike or public transport, we can see how much, based on public data, how much CO2 emission reduction happened, and for each, and then they get rewarded with tokens, right? But ideally, the city of Vienna doesn't want to make this a fungible token. There shouldn't be a market, because then it becomes money. So we're thinking of tying it to an identity. And I wasn't planning on showing this, but you will find it. I won't talk about the slide in detail. But when we design tokens, we have to ask ourselves these questions. Only one of these questions is the regulatory aspect. But everybody always focuses on the regulatory aspect. Is it a security token? Is it this token? Well, that's also important. But first you need to think about other functionalities. How do you want to design it? Apart from the fact of asking yourself, is it on the technical level, is it a protocol token or a second layer token? Rights perspective, is it a property right or an access right? Or from fungibility perspective, should it be identical, and why should it be identical? Of course, any certificate needs to be non-identical, right? Because a driver's license or my university certificate, we don't want it to be kind of, it's not identical and it shouldn't be transferable. So depending on the use case, I need to decide, is it identical? Is it fungible? What's the durability? Will it expire after a while, like bonus miles? Or is there no expiration date? What's the incentive perspective? Upon which behavior is the token minted, or is it issued against some other value? What's the token flow? What's the supply? All these things. So I think, to cut a long story short, NFTs are very, very exciting, but there are a myriad of use cases, so I think it's hard to answer that, but I'll be here all day, we can talk about it, hopefully. Yeah, okay.
One second question.
My question is quite simple. If we as economists see these complex systems, don't understand the whole consequence of it, have different opinions on it and can just test it, how should, in the long run, normal users that don't know anything about economy trust these incentives and understand which incentives are set and how their behavior should be influenced? So,
very interesting question. Why do I trust my Minister of Finance?
Yeah,
because
exactly.
I don't understand what they're doing and
Exactly.
why they're increasing the interest rates, etc. So we're not eradicating trust with this new technology. We still have to trust the experts who write the governance rules, or who understand the technology to write kind of the smart contracts, right? That's a philosophical question. It's a valid question, but it also applies to our current economy, right?
Final question.
Yeah, I have a question. As you're from Vienna, right? Are you a pro or con Austrian school, or are you avoiding philosophical discussions and be more like an overwatcher, something like that?
Okay, so where is Michael? We're already, like, we're referring, we're actually working on a research roadmap, Michael and I, which will be published in September. And we're referring to Hayek, we're referring to Wiener, cybernetics, and we're referring to Ostrom. So one of the things, the Austrian School of Economics said many things. But one thing I identify with that they said is that we have this computational problem. And what they criticized in the early 20th century was that, in fact, all these tools used by economists were reductionist and not appropriate. Unfortunately, they didn't have tools that they provided that could be used. The critique was bigger as the solution pool that they had. So I think that, but the critique was valid. And we're building on that critique because, and that spans also to Ostrom and public good theory and complexity theory. So in a way, yes, we do refer to the Austrians, especially to Hayek, and some people have been joking, New Austrian School of Economics, I don't know. All right.
Okay,
I think
thanks
we need
again,
to wrap it up.
Sherman, for your talk. And thank you for the questions. A round of applause. Sherman, we have prepared a little present. Everyone gets this nice pink t-shirt. And yeah, if you have any further questions, take a look at our website, teg.io/program. You will see all the talks there and a link to the speakers with their Twitter username. So feel free to reach out to the speakers and get in touch. All right, we're coming to the next speaker slot, which is our discussion panel. So we've heard from Sherman that the ICO wave is over. And let's discuss tokens as a funding instrument and the future for funding decentralized token economies. And with that, I'd like to welcome on stage Jonathan Gabler from Block Science, Jamie Burke from Outlier Ventures, Richard Meyerhead from Fabric Ventures, and Eric Sung from Binance. Welcome.
Thanks, Jason. All right, good morning. How's everybody doing? So I think the reason why we have this panel at the beginning of the event is because at the beginning of most projects, centralized or decentralized, different types of capital have to come together. Raising financial capital is something that in traditional financial markets is something that's reasonably well understood. So if you're a builder or if you're a project, you know what a sensible deal is, and you have some rough idea what kind of impact it has on the life cycle of your project. In crypto capital markets, it's much less clear, and I think looking at the vast amount of experimentation that we've seen over the last 2 years, it's clear that we're still trying to kind of refine the idea of professional investing or professional fundraising. So what we want to do in this panel is to shed some light on what's happened over the last 2 years, where are we right now, and what are kind of the challenges that projects who want to fundraise or investors who want to invest into these decentralized ecosystems are facing. And I'm very excited to have a super strong panel here. You guys have been at the epicenter of this development. And I would like to start out with basically setting the stage. We've all heard about ICOs, we've heard about IEOs. By the way, I looked at some research this morning from Circle. ICOs still raise more money than IEOs if you take out the outliers. That's actually interesting.
Not outliers companies.
Exactly. But the underlying trends, sort of these mega trends that are going on, they're much less visible to all of us. And this is what I would like to ask you. I don't know, Jamie, maybe you want to start. What are these sort of tectonic plates that have been shifting over the last 2 years? What are these trends that we have been observing?
Well, I think, obviously the market's evolving alongside token design, and things are getting more sophisticated in terms of the technology, the tokens that have been designed and how they function, beyond just as a fundraising mechanism. And then on the other hand, you kind of have these very wild, volatile markets that are typical with any nascent technology. And so I think that creates quite a challenging environment to be issuing tokens, because on the one hand, you have a regulatory environment which is increasingly moving projects towards having full utility at the point of issuing and selling a token. So effectively, they're requiring projects to raise more money privately from professional investors, institutional investors. And so, of course, projects raise money in a given market condition, be that a bull run or a bear market, and they price the project accordingly sometimes. And then 12 months later, they conduct the sale and issue a token, and the market's totally changed. And so that creates 12 months or 18 months in crypto is a long time. And so you've got so many shifting factors. It's not it's an unenviable position to be trying to appease early stage investors to make sure that there's going to be the right level of distribution of a token, and then of course to make sure that there's the right level of secondary market and support in that secondary market. So I think it's a natural evolution towards an initial exchange offering, because ultimately that's where the secondary market is.
Richard, does that reflect your experience as well? What are the key trends that you've been observing over the last 2 years?
So first of all, I'd like to basically echo what Jamie said, that people are having to wrestle with this question of which problem they kind of address first and in what sequence when they're trying to build these companies out. But I mean, to summarize our perspective on it, I think a reversion to the kind of fairly well-trodden path of fundraising, going through a very small round at the beginning, pre-seed, pre-product, whether it be in debt or equity, into a company, giving you time to think about the market opportunity and the product, and think about perhaps the way you might design a token to assist your company being successful. Essentially the similar pattern to what we've seen in the past is totally appropriate. I don't want to sound kind of like unadventurous, but I think that structure has been honed, say, for half a century for good reason. But as a counterpoint to that, I do think when the time comes to design your token economics and think about what that part that can play in your venture, there couldn't be something more extraordinary that is happening. I mean, and not wanting to get into kind of let's think back to the time of Mesopotamia and think about organizational structures and so forth. There was a good gag about that, and during Web3. But it's been 500 years now since a guy called Luca Pacioli wrote a book called Summa de Arithmetica, which was basically the first time someone wrote down the principles of double entry bookkeeping and the theory of the firm. And we've essentially had the same model since then. But we've now got an opportunity to turn the concept of debt and equity into just some rather trivial type of financial instrument in a much broader universe where you can involve many different stakeholders, and you can, I think, be even more effective perhaps in building marketplaces addressing very complex problems than Bezos has been in building Amazon, to move to what we think of as a kind of a form of collective capitalism, more effective for the business, and actually ultimately more progressive and more equitable for society as a whole. And that's due to this kind of infinitely programmable nature of the underlying token. So the path may be kind of similar to before, but the tools now at the disposal of the entrepreneur are way more potent than they've ever been, in history. And I think we're entering kind of the next couple of thousand years of using that, putting that to good use, hopefully.
Richard, so Binance, I think, where's Binance headquartered? In Singapore?
In Malta.
In Malta right now, right? But you headquartered in Singapore, I think, right?
Yeah, I'm based in Singapore.
So you've observed the Asian fundraising landscape for a while. I think Binance Launchpad hasn't been around for 2 years now, but you've seen this this development over time, and all of us who've been in this space know that the Asian landscape looks a bit different. There's some nuances that are different. Can you speak to those? And I want to throw in one spicy question there. Last night I had a conversation and I asked people, what's the future of fundraising? And when they talk about IEOs, people are not so positive. They're saying, they're way too expensive, and it's not a sustainable model. Maybe you can include that in your answer as well.
For sure. Maybe let me add a little bit onto the trend, the ICO trend in the past 2 years. I think the reason that you just mentioned that ICO still raise more than IEO does is because, for example, Binance Launchpad, we do very rigorous evaluation on those IEO candidates. So only among those, 100 ICOs, only 10% can be selected, get onto a Launchpad, because we need to do full due diligence on across, product, their go-to-market strategy, technology, in order to bring the best to our platform to protect our investors. That's why ICO still raise more money than IEO. I don't think that person who asked the question really look at the projects we launched, because if you compare the IEO projects that we brought onto our platform, the valuation is lower than their comparables. I think primary reason is Binance Launchpad is not only a platform for projects to raise funds. It's also a good platform for token distribution, right? Also a good marketing tool. And we usually suggest the project teams to use a relatively conservative approach, right? If you compare to the other projects, you can get a reference of their valuation, but position a little lower. That's always the safer and better way. That's why. The other thing is observed. I mean, you're asking where we're based. So right now, majority of our employees are still in Asia. Part of them are in Malta, across the other countries. The interesting thing we find about the Asian market is people are relatively. I mean, you guys probably talk to a lot of investors, projects in different regions, right? So If you look at the ICO distribution by country, US had the largest number of projects, then Europe, then Asia. If you look at where the money comes from, is Asia, right? If you look at the secondary market, the percentage of the money from Asia is even higher. But majority of them, I hate to say this, but it's more speculative money. One interesting thing is people in those emerging markets, like to talk about trading, speculation, etc. While in those relatively mature market in the States, Europe, they tend to talk more about the real technology, etc. So, but for us, right, that's also why on our platform we really select those projects that are down to the ground, bring the best technology.
There's two topics that you mentioned that I want to quickly take up and ask Jamie and Richard about, and you as well. And one is token distribution, right? I think a lot of the difficulty in fundraising for these ecosystems stems from the fact that we're using tokens as a vehicle for acquiring financial capital, but we also use these tokens as sort of inherent parts of these, what Trent called the incentive machines, right? And I think that makes it very difficult to define a strategy. So I was, maybe Eric, you could just expand on how do you think about this token distribution at Launchpad, right? So for a given network, there's probably an optimal token distribution across roles in that particular system. Is that something that you look at all?
Yeah, we do. We sometimes work with the projects to design the token distribution to make it fit to the current market condition. For example, this year, since the beginning of this year, the market hasn't been doing great. It was pretty weak. So we usually suggest the project teams issuing for the initial circulating supply is around 10% of the total supply. Because if on day one, if you release too much, the market is not great. It cannot sustain, right?
How do you guys think about that? Is 10% that's a number, and that may be based on some data that you have, right? That
there
that the markets could support it.
Yeah. Multiple factors, but that's really
How do you think about token distribution? I think we actually have a deep dive talk coming up later on, so we shouldn't go too deep into it. But when you recommend a fundraising strategy, how do you recommend to distribute those tokens across stakeholders?
I mean, it feels a little bit to me like we're collapsing a few questions together. I'd prefer to kind of tease it apart. I think if you just want to go and raise capital, I'm actually bullish about the use of tokens to do that over time, but you just got to wait for the regulatory environment to be right, and that's one thing. If you're going to be using tokens perhaps to raise some capital, but actually as a fundamental incentive mechanism, then I think the first thing to contemplate is, before you get to kind of what float you have in your ultimate sort of secondary market raise, that's the third step. The first step is think about what are the fundamentals of your token design. Do you want it to be, or do you think it could be a payment token? Do you think it could be a work token? Do you think it could be a token that you're going to have to burn in order to create value in the remaining tokens? There are going to be two tokens. There's a lot of that's what we're going to be talking about here, I'm sure, in great detail, and understand in your model conceivably how value is going to accrue to that token over time, and convince, if you're going to mix that role of fundraising and incentive design, convince everybody involved that it's going to be the case. The second part is going to be, and this is what I think about it in terms of token distribution, is really the expanded version of what any good startup founder has already done. You have to think about rounds of capital raising, but also rounds of option allocation and maybe inviting in strategic partners to buy some of the equity in your company. That's the distribution of tokens that you're doing. And in any company, it gives thought to that and perhaps lays out a plan for how much is the executive team going to get. I'm going to partner with Visa. How much am I going to sell them in my business, and so forth. And you lay it out. It's not going to be absolutely right, but if you have got a clear view now of why there is utility and value in this token, and you have a clear budget essentially over time for how to distribute it, then you're set up in a good position to raise your capital at the beginning, and then the question of how big the float is, well, from my view, that's just a question of how bullish the market is at that point in time, and you probably tend to constrain the supply if it's a worse market, and you go bigger if you want to take the capital, and it's a better market.
Yeah, I mean, I'd just build on that and say, when you're designing for a token economy, what is the role of capital providers in that economy at its various stages of evolution? And so that is a design choice. The reality is that in the earlier period of experimentation, there wasn't much design thought put into the impact of the various financing rounds and that stakeholder group. It was assumed that the end user would also be the investor, and so it kind of had a unified concept of what that stakeholder is. But of course, as we know, in many instances, some of the main users are speculators, so not even long-term capital providers. And I think that's okay. We now can design for that, to accommodate it or to restrict it and limit it. But there's just so much variability, and that's still really driven by your geographic presence. If you're in the US, there are so many constraints as to how you can design the role of a capital provider that shift projects much more to a conventional structure. And so, equity is a way to keep the capital providers out of the token economy in a way, and unless it kind of converts at a certain point. So it's really a design choice. I think as the market matures, as we kind of get more data points and more experience as these things evolve, the role of people like us, you could say, well, actually, the role of, let's say, a pure play a venture capitalist who's just deploying capital is fairly limited. It's contained to the early stages of a project. And actually, we want them to exit that token economy at a fixed point. And you could do that in a structured way. So it's a managed sale of assets rather than a kind of a dumping on the market. Or equally, you could say we want to lock people in with more kind of conventional vesting terms, which is very typical in venture if you want to kind of lock people in. But even then, what are you locking them in for? And what value are they going to provide beyond capital?
I want to segue into actually the second topic that I want to take up from your response, Eric, and that's fundamentals for crypto capital markets. So in traditional capital markets, when supply and demand meet, then they can typically look, for example, at balance sheets, and there are some practices that are accepted to determine the valuation and the fundamental health and value of a company in this case. For crypto capital markets, there's really little empirical evidence that any of the metrics that we're currently looking at are sort of correlating with price in secondary markets, for example. What are the trends that you're seeing? Are there some fundamentals emerging that are useful, or are we still kind of winging it at the moment?
I mean, I'm happy to answer, but I don't know if Eric wanted a shot. I mean, I would just say that sadly at the moment there's very little correlation between at least what we understand as fundamental measures of network health. We have an internal measure of network health within a given network. Some of that's universal measure and some of that's specific to a network. However, there is the ability to kind of have a degree of prediction of price. But this is primarily momentum trading. We're still in a period where most price action is just momentum trading because the tokens are very thin liquidity in the market, and so there's a huge opportunity to game that system. And so thinking from a systems design perspective or game theoretics perspective, there is currently a massive incentive to game that system. So again, it's a design question actually. How could you design that out of the system?
So the bottom line is there aren't that many networks out there that have got true usage, and therefore sort of trying to get some empirical data to inject in a model and work out fundamentally what it should be worth is sort of limited to a few different networks. And if you take, Bitcoin, obviously it's in a sense it's sort of money and meme driven to some degree. I'm a Bitcoin bull in the broader sense. But let's leave that to one side. I think you can look at something like Ethereum and look at fundamentals like gas price and the quantity of Ethereum locked up in decentralized finance, starting to look at how it's securing, applications that are starting to be driven. So, but I think a lot of the value of Ethereum is, in a sense, its financialization now as well. So it's it's more challenging to look from a kind of fundamental valuation perspective, although people do. I think more interesting is, rather than trying to work out whether publicly listed tokens are valuable or not, is rather to analyze the fundamentals for new projects. And there are sort of two types of project you might want to analyze kind of from the bottom up. One sort of, in a kind of simplistically a kind of burn token type model like Maker, and look at the stability fee, and look at the amount of Ethereum locked up, and there are various fundamental measures that can give you a sign of network health and growth and so forth. And I think now in that DeFi space, we're seeing a diversification going on in the overall ecosystem as well, which will create sort of competition, which I think will be healthy across Compound and other platforms too. So that's great. And then looking at work tokens of the like of Augur or Keep or Orchid or LivePeer, for example, I think looking at the participation in staking, is key, for example, and look at how the inflation rate has been set to incentivize people to do that staking. Look at the split between the rewards for those who are staking, between block rewards and transaction fees, and still, in that context, even the ones that are live network-wise, are really, immature, and that's fine. But you can see fundamentally how, in that work token context, that if there's the price of being able to participate in that network and do profitable work, is that you stake some of your tokens, and that ultimately you will be rewarded in transaction fees. That is really just like a deconstructed discounted cash flow that you need to do to value that network. It's not, although like all modeling, you have to be clear what questions you're trying to answer when you try and project it. It's absolutely doable. And so those are the types of analyses that we do from kind of the bottom up.
Eric, is that similar what you do at Launchpad? I think when we chatted yesterday, you said you do valuation on companies that come through your Launchpad, and a BitTorrent is a different valuation than a more seed stage kind of project.
Right. So previously we tried multiple different sophisticated models, right? We tried, for example, to use the equation of exchange, right? MA equals to PUA, right? So it's a wild estimation, like what Jimmy said. You guys probably tried many models as well. So I think given the immaturity of the crypto market right now, those complicated models just doesn't work. Simple. So we would rather, but we still have to do valuation for our IU projects. So we usually do comparable valuation to look at the similar projects in that vertical. Some people may argue that the price on the crypto market right now is not very good estimator, right? Because it's the deviation from the true value and the price is huge. I mean that also happens in the stock market, to be honest. That always exists. But on the other hand, you have to know that the market is always right. I mean it takes into all those factors that you are aware and you are not aware of. So we think that simple method is the most suitable way for us to do valuation right now.
Yeah, I mean, I'd add that to that question, that the biggest challenge is price discovery, especially when you've had long periods of lockup or liquidity. So there are some really interesting mechanisms. There's a guy called Jason somewhere over there who recently wrote a paper on ICO, which is how do you establish a price at a way where the market can set that price either in advance or during a sale. So I think there's going to be some really interesting mechanisms coming through that will allow that to happen, and that should allow for kind of, aside from the wider macro movements, allow for more stability. But then I think to kind of pick up on the last point, as we, in the first talk, it said these are complex systems. One of the major limiting factors to date has been that people have put they've hard-coded assumptions into the design of a network, which invariably proved to be wrong, and they're too rigid in the way that their governance is structured to be able to adapt to the market. So I think we're going to start to see more adaptive systems. For us, a really important point is, this idea of decentralization in a kind of binary sense. It's centralized or decentralized, and it must be totally decentralized at the beginning. By the way, a pressure that regulators are forcing on without really understanding the consequences of that, is that if it's totally decentralized from day one, what that means is it's then very difficult to make changes to something, which makes it fragile, and fragile economic systems aren't great. So for us, decentralization should be a pathway, but regulatory environments make that quite challenging.
Can I just talk about the infamous equation of exchange, where there's been quite a bit of chatter about it over an extended period of time. So here's my perspective. I'm not an economist, I'm kind of an optimistic engineer, but in understanding the history of the equation of exchange, it's basically a supply-demand equation applied to money. It's a macroeconomic theory that's existed for about 100 years. And if you look back at all of the contending kind of philosophies relating to it, and there probably are almost philosophies, it's almost never had any predictive capability. And quite often, in fact, it's got kind of inverse predictive capability when applied to the kind of real world economies. So trying to apply it to a new sort of more micro digital economy, which actually isn't even directly applicable, because I would argue that money, as we've traditionally known it, does not have all the programmability, customization, adaptability that you've got in a token. The ability for it to be involved in work and to be burnt, to reward people for devoting computing resource or for providing reputation, for providing liquidity, all of these different things in very intricate ways. And so I just don't think it's usefully applicable. It's like you're trying to, it's overly simplistic. I try to maintain that to a friend of mine, John Pfeffer. He told me it was the worst investment thesis he had ever heard, but I stick by it.
Just add on to the end of that, again, it was presented in the keynote that the benefit that we have here is we have a feedback loop compared to traditional economics. So not just within the individual token economy, but the kind of presumably an interplay between token economies. So in theory, if we can create a governance model that can allow for adaptability and response to that feedback loop, then we could have economic systems that are more measurable, quantifiable, adjustable.
Just want to quickly add to
a quick point. Yeah, I just got the signal that we're gonna wrap up soon.
Yeah. So I think in the future, when we have more data points, we know how many users can be converted from non-blockchain space to blockchain. That will give us more, data to estimate. Right now, the DAU of all the apps is like 10, right? I went to Jimmy's party the other day. The DAU is 50, right? So, I mean, that is very, very hard to estimate right now. But in the future, I think when we have more users.
As a last question, just to get very practical, and I wanted to quickly ask, how many projects and builders are here today that are potentially fundraising? Okay, so that's a lot. How many investors are here today? Okay, awesome. So that last question is, what is the single biggest piece of advice that you would give to a project that's building a decentralized network that's going to fundraise in the next 6 to 12 months? And we have to be quick because we're going to have to wrap up.
I just say keep it simple and don't forget basic startup, lean startup principles, right? You validate an assumption before you kind of commit it to code.
Yeah, so echo that, build on that. You know, a startup is not a company; it's a kind of a vehicle for experimentation, and decide which experiments you want to, you know, run and investigate and in what order. And remember that, you know, Google went from like 98 to 2002 and was still languishing, you know, back in the pack in the peloton somewhere, hadn't broken ahead, and then it kind of combined a few different elements from, you know, go to Overture, put it together, and suddenly leapt forward and was about to run out of cash effectively, leapt forward, and 2 years later was worth 36 billion. It's very hard to see what the business model is going to look like, and we are playing with a lot of business models here, you know, hard to see it in advance. So, you know, run the experiments, keep the faith, and keep being excited.
So our suggestion is just be a little patient. Don't be in a rush to raise a lot of money, right? In the primary market, you can give a portion to those early investors who can bring true value to you guys. You know, later if you want to do another round, you can consider doing a public round, where you can make the tokens more widely distributed, right? That's, you know, the users, those investors will become more motivated to use your product, so to become your users.
Awesome. Thanks all for listening. That's all we have time for. Please join me in giving the panelists a big round of applause.
Thank you. Your T-shirt. Thank you.
The stickers?
Jane. Yes, we have outside. Yeah, and I need this mic. Thanks. Your T-shirts. Ja, klar, halt. Meine Karten reich. Okay, thank you so much for this panel and the insights from a VC's point of view. Now, our next talk will be discussing token distribution again. And I remember Cassidy Daly, we have been talking prior to the TEGG about what are the most relevant and pressing questions for blockchain projects. And of course, this launching a token as a funding instrument is important. However, we've heard from VCs, be careful with that, step by step. And maybe we are going back a little bit to traditional funding models and traditional funding phases. However, as Cassidy will explain in a minute, token distribution matters. And we can look back on traditional economies to find out why token distribution has really a big impact on the network and the network health. So I'm very much looking forward to this talk. Welcome, Cassidy. And yeah, give her a warm round of applause.
Okay, so my name is Cassidy, and I work for a company based here in Berlin called Centrifuge. And the high-level mission that we have at Centrifuge is to foster economic opportunity everywhere. We do that in our project by changing the financial supply chain, changing how it operates. Other projects, though, choose to focus on something else. Some projects are focusing on creating a stable digital coin, stable value digital coin, so that people can transact much easier. Other projects might be focusing on private messaging, so that you can privately send memes to each other or start the next revolution. And I think that token distribution is really key in actually accomplishing those goals, those things that we set out to change in the world. And I believe that we can do better. So in this talk, I'd like to talk about why token distribution is particularly important. So I'm going to walk through just briefly what I mean by token distribution, and then I'm going to dive into wealth distribution, historically in economies, what that looks like and what impact that has on the growth of an economy over time. And then I'm going to touch on some distribution mechanisms and hopefully have a little bit of time for your questions at the end. So first of all, I'd like to ask you in the audience to raise your hand if you've ever participated in any type of token distribution event. Wow. That's amazing. Most of the room. Okay, I've got people here who know where we're starting from. So what I mean by token distribution, really just a comparison of the ownership of the holdings of these tokenized assets by entities or unique individuals in a token-based system. The token generation event is the moment of the initial disbursement of the token to the first owner. So that could be something like a genesis block where there a certain allocation of tokens allocated to certain entities from the very beginning. It could be a token sale, and we'll touch on some of those mechanisms as we go forward. What are the goals of this token generation event? Well, as we heard on the last panel, one of the primary goals has become raising funding. But it could also be to just determine a market price for the token. So they mentioned that sometimes the IEOs now are not only used for raising funds, but also just to get the token out there and to find what the market thinks the price is, to incentivize user participation, to target the users that actually want to use your product and get it into their hands, and primarily to distribute the token, to get it out there so that people can actually use your product, whatever you're using the token for in your system. I would argue that the primary objective, instead of the raising funds, instead of determining this market price, although they're important, it should really be to get tokens into the hands of users who are going to benefit from and add value to your token economy. So now I'm going to dive into historically why I think that's so important, why I think that's the primary objective. And we're going to dive into a bit of research here. And so I ask you to bear with me and hopefully you will get something useful out of this walkthrough. So I'd like to start with Germany actually first as a case study. So Germany is actually very recently reunified, 30 years. In 1949, they actually established East Germany, the Soviet zone, and it was a planned economy. It was run by state authorities. It had its own native and non-convertible currency. But then in 1989, the Berlin Wall fell, and they established a monetary union. And they substituted the currency of the GDR, the east side of Germany, for the Deutschmark. But those assets from the eastern side of Germany were converted at an average of 2 to 1. So you're starting off East Germans at a disadvantage. And in 1991, the East German wage level was less than 50% of the West German wage level. That's a pretty incredible difference. So what has that resulted in now? Well, the economy of the eastern part of reunited Germany, 30 years later, is still lagging far behind in productivity and income growth than West Germany. So 93% of the largest firms are actually based in the West. The wages in the East are 80% of the wages in the rest of Germany. Companies in the East are 20% less productive. And the productivity levels, if you look at East between West, are actually greater of a divide than if you look between rural cities, rural regions and cities. And this is a look at the current, 2014 wealth distribution in Germany. So as you can see here, the wealthiest 10% control more than 60% of the wealth in Germany. Actually, 70% of that is land, and only, actually, I won't say the number, but a very small percentage of Germans actually own land, and so that contributes to this concentration of wealth in Germany in particular. And 50% of the country, the poorest 50%, if you will, only control about 2% of the entire wealth of the country. So I think that's a pretty big outcome that we've seen from this initial distribution of wealth, 30 years later, the impact that it's having on the society. So the few things that I'd like to point out from this look into this German case study is that the concentration of wealth has really persisted over time. there's a clear impact on the lack of growth in East Germany, that actually the concentration of wealth within East Germany is higher than the concentration of wealth in West Germany. And there have actually been quite extensive programs in Germany to tax the western side of Germany and fund programs in East Germany. And even through this reallocation of capital, through their attempts to really fix this problem, there has been no discernible positive effect on the growth of East Germany. And all of these developments happened with a slower trend of growth post-unification of Germany than before, when we just look at West Germany by itself. So we can see that the growth of Germany has actually declined. And though I am not able to present to you very rigorous data to prove to you that it's this concentration of wealth that has had this measurable effect, I believe that it is correlated, one, and I hope that you've seen that. And two, I'd really love to see more people pick up on this as a deeper study. And so to carry through my point, to really prove to you that it's wealth concentration that matters, I'd like to point out a few different economic studies that have been more rigorous and do look at data a little bit deeper. I'm going to buzz through them a little bit quicker for you, but just to give you an idea of the types of research that's out there. So the first study that I'd like to point out is the most recent one by Deininger, and in a paper for the World Bank, they point out that inequality hurts overall growth, and that it has not income inequality, but wealth inequality and wealth distribution has had a great negative impact on growth, and also in their case showed to reduce the effectiveness of educational interventions. So in this case of East and West Germany, where the East might be less educated, this distribution of wealth even affects their ability to spread education. In an older study, Deininger, again, he's been looking at this for a while, together with Squire, looked at inequality and growth and used cross-country data to show that land distribution has a strong negative relationship to long-term growth. Again, Deininger looks with Nagarajan at India. So he changes where he's looking for more evidence, and shows that land reform, so in India's case, asset redistribution, actually had an effect, an observable impact, and that there was a significant and positive impact on income growth when they tried these land reform and land redistribution policies. Looking at a similar part of the world in Asia, and then comparing it to Latin America, this study looks at land distribution and the fact that actually in Asian countries there is a better distribution of these assets as compared to Latin America. And they show evidence that the regional differences in economic performance are actually partially explained by this land distribution inequality. In another study by Alesina, they look at the distributive politics and economic growth, and they show that inequality in land and income ownership is negatively correlated with subsequent economic growth. And then finally, I looked to an older study by Galore and Zira to show the role of wealth distribution in macroeconomics, and they show that cross-country differences in macroeconomic performance are actually linked to wealth distribution. So I know that was a lot, and I'm just trying to put the point out there for you that wealth distribution is linked to economic growth. And even if you're skeptical and you're telling me, well, maybe it doesn't have that big of an impact, I'm sure wealth distribution is correlated to lots of different things that are impacting these economies. But I'd just like to point out this concept of compounding for a moment and to question you and say, what if wealth distribution only had a 1% of an effect on the variance of economic growth? That 1%, though it's minimal, can compound over time. and say that there's just a 1% difference in wealth at the beginning of an economy. Over 30 years, that can compound into a much bigger difference in the growth rate of that economy over time. So just something to think about, and that I encourage you not to write this off and really internalize the fact that this wealth distribution, and now in our case with token distribution, can have a very strong impact on the growth of these token-based systems over time. So I'd like to question, okay, so then let's take a step back. Let's say wealth distribution does affect growth. Why might it have that type of impact? So I would say that, in my opinion, I think it's because long-term growth is really required from investment. Long-term growth requires investment in the short run in order to grow in the long run. And that capital must be deployed efficiently into areas that will produce value. So that's something that we heard on the last panel. Coming from investors, can you get investors on board, invested in your token, who are actually interested in the growth of your network over the long term and willing to invest in things that are going to add value to your token system? And I would say one place that we can see that today that is quite well known, I would say, in the finance space, is that this same trend exists for funds. So when a fund has a very specific strategy, say that the manager has an edge in some specific area that he's worked for 30 years and he knows how to exploit some type of vulnerability, and he needs 20 million, or she needs 20 million to execute that strategy. If he or she raises more than that 20 million that's needed to execute that, it's completely useless. They're going to put it to no work at all, or invest it in ETFs or some kind of market return rate, and you're not going to get the same type of performance. And the same thing exists for accumulation of capital in any place in the economy. If people are accumulating capital and they're not able to actually deploy it, invest it into anything that's going to add value, it's going to be useless. It's just going to sit there. And your economy is not going to grow, and your token-based system's not going to grow if you have investors who are just holding onto your token, doing nothing with it. So I hope that I've made the point, at least for you, that wealth distribution is important, maybe why that could be true, and how that can relate to token-based systems. I'd like to now turn to some token distribution mechanisms. So the tools that we have actually to accomplish this. Because the initial condition of your token-based system matters, I'm going to run through some of the options that you have and the options that we've explored as an industry into how we might accomplish this. So the first thing that we looked at was mining, and the goals here were really to have a fair and wide distribution with easy access to this token. But what they didn't foresee was that there could be pre-mines, there could be a lack of information that the project even existed, and so only few people were mining in the beginning and accumulated a lot of capital, and it became really expensive, actually. So then some projects turned to things like airdrops. They wanted an extremely wide distribution, but actually the downfall there was that it was a bit too wide, and people just got tokens that they didn't care about, and they saw that they could turn it for a really quick profit, and so they just dropped the tokens, and it had a really bad impact on a lot of these projects. So then some projects started out doing these token sales, and the goal here was really that fundraising component, but also a distribution to users who are really invested in your project. But this really inherently ties the token to funding, which is really not going to be appropriate for some certain projects, and it makes it open to speculation, and that can also hurt your project long term. Some of the more interesting mechanisms that have come about recently are the Merkle mine, which was to try to separate the fundraising of the token from the distribution, but still get users to pay a little bit of something in computation power for the tokens. And now turning to the lock drop and really paying with the time value of another currency for access to this token. But unfortunately, most of these mechanisms have resulted in quite concentrated token distributions. So this is actually from a paper by Kyle from Multicoin, and he looks at the percent of tokens held by the top 500 addresses. And as you can see, we can do better as an industry. We are quite concentrated. And just as a comparison to other countries in Europe, this newer project Decred that tried to really improve on Bitcoin and create a mining system that would be a little bit more fair of a distribution, that was part of their thesis. They're actually quite concentrated compared to every other country in Europe. And this live pure Merkle mine, the Merkle mine itself actually happened to be a bit better than Germany, for example, but still not as good as Slovakia or even France. So I would say this shows me that we can do better. If we're trying to improve the existing situation that we have economically, we're not doing that. And I'd encourage you to take a closer look in your projects of the token distribution mechanisms you use and how important this really is for the growth of your system long term.
Thank you very much, Cassidy. And I think it was quite interesting to see this comparison between different token distribution mechanisms and wealth distribution. So I can only encourage you, if you have any questions or like to discuss this further or have additional comments on that, get in touch with Cassidy. You can go to tag.io/program. You will have all the talks there and also a link to the speakers and their public account, for example, on Twitter. Thank you, Cassidy. Talking about distribution and wealth. When we were planning the session for the TEGG, of course, we were discussing Libra. So we need to have Libra as a topic at TEGG. And actually, I've been in touch with Nina Siedler, seeing how we can get this involved. And when thinking it through, we thought, okay, one of the major question marks on Libra is actually governance and decentralization. So how can we and how do we want to define governance structures? And Nina now will introduce an initiative by the Wharton School on finding a structured way to define decentralization and certain governance structures. Nina is attorney at law and partner at DWF, a very active member in several German working groups and international working groups and think tanks, and is working on legal and regulatory questions in the blockchain ecosystem. So thank you so much for being here.
Thank you. Yes, the starting point was indeed Libra, but I'm happy that I'm not talking again about Libra, but can take a little bit more holistic view to crypto governance and share with you what a group organized by the Wharton School of the University of Pennsylvania is currently working on, and we're hoping to publish that maybe in 2 or 3 weeks' time. But as a starting point, you all know this chart, right? Distinguishing the different types of blockchains depending upon the validation being permissionless or permissioned and whether they provide for public or private access. I added some bullets there from the holistic governance point of view. So I'm not talking about consensus mechanisms or on-chain governance, but I'm talking about the whole governance of networks, right? The off-chain part is not really structured in the permissionless public systems. Most of this is done by, social media coordination, some core developer groups, some thought leaders, but the off-chain governance part is is typically just historically grown, but not further structured. To the opposite, on the lower right-hand side, the permission and private systems, the typical, single entity DLT solutions or consortia. There you see typically a very well-structured governance, but which is built upon corporate governance structures. And I personally believe corporate governance is too little for networks like this. I personally see blockchain networks more in a comparison to states which have no geographic boundaries, but are rather centered around certain topics. So the pure, simple corporate governance structures need to be enhanced in order to create a fair and transparent system overall. And in that area, I really like to see to the upper right-hand side box develop further, because those permission public systems that we are seeing growing over time, they actually provide for an opportunity to explore a proper governance of the off-chain part, together with various different on-chain governance mechanisms. So, for example, the IPDB, the Interplanetary Database Foundation, we organize it in a way that only the members can run nodes, and we're working on a set of policies for those to make that more clear, and then everybody can basically do with the network whatever they want, but we create with a main chain like a trust anchor for various side chains that might build surrounding that. There are many more examples on that end. Decentralization has an issue, we heard it before. You need to fund it. People working on those things need to earn something to make a living. And that resulted, historically seen, during the past years in structures which typically base upon a public infrastructure, decentralized, and then alongside of that, people, founders especially, build their centralized ventures to make their own living. That's a great thing to do, right? Combining a non-profit infrastructure with for-profit companies, privately held companies, but and it kicked off basically with Ethereum and building the Ethereum Foundation. The problem with that is that there is always a conflict of interest involved in that, and plus, I personally don't believe that non-profit infrastructure, decentralized, should be governed or majorly influenced by a vehicle like a foundation. Why not? Because a foundation is the most autocratic governance model that you can think of, right? You separate funds into a vehicle, then you choose initial directors, and those will sit there for the rest of their lives, or as long as they like. And they can basically do whatever they like within the purpose, the given purpose of that foundation. In some jurisdictions, they can even amend the purpose, right? So that's not inclusive. It's not democratic at all. And from my perspective, doesn't make any sense. So we need to rethink that model. I personally like very much the association approach, which is membership-based. And then we need to think about how to organize that membership and to get it as broad as possible. And typically, founders would like to keep control for at least a certain period. I can understand that. It's their baby, right? They are kicking it off. They are organizing the funding initially. So how can they do that in an association-based model? Well, they can start off as directors, and they can choose typically in the beginning the term. Right? They can say, well, I will need 2, 3, 4, 5 years, and thereafter there will be a re-election of the directors, and then it really moves into the hands of the members and the network. Back again, problem financing. How to finance an open source, public, permissionless infrastructure. And I like to compare it to the streets outside, right? This is just the digital version of the streets outside. And we want to have them permissionless, we want to have them public. And ideally, we want them not to be rent-seeking. So historically, this has been the task of governments and finance via tax. Nowadays, you know, our governments, they lost track about the digital infrastructure and left it completely to the private company sector to build that. And that resulted by now in a large internet monopolies ruling this whole area. And I always understood, and that's why I got interested in the whole blockchain movement, that this is a counter movement against this development. But, you know, we started off and then we came into the ICO hype. And again, we are seeing that we are just replicating old structures, right? Everybody is concentrating on its own profit making. We just heard it before, you know, how do you fund these things? Everybody needs to make a living. I understand that, right? But the problem is that this ICO hype really splintered the whole movement into thousands of different projects, all of them building against silos, and all of them trying to compete and to fight for their own token, because, you know, the idea is first mover advantage, and my token will rise in value if I only get a sufficient number of users to join it. But that doesn't really work if there are too many projects trying to do the same thing. So I really believe we need to go back to our initial values, start working together again, not fighting against each other, and start to build a joint infrastructure and to move the for-profit ventures rather on the application layer, but work together again on the base, on the protocol layer, to create something meaningful and something that really serves society. All right, how to overcome this this mechanism that we, again, in the blockchain space, see monopolies growing, see a concentration of wealth. So thank you very much. I don't see her, my prior speaker. That was a great contribution to this discussion. And I believe the starting point is transparency. We need to talk frankly about how the governance structures are built. And I'm very happy to be part of this group which met like 6 weeks ago in San Francisco, invited by the Wharton School. They got together a great crowd of, you know, starting with people from the core blockchain Ethereum side to representatives of Facebook and R3 Quarter, a couple of professors from economics, social studies, and law. And that great group really started discussing what are the important questions to ask. And after that 2 days, we agreed that we would write these down, and we're still working on it. There is a group call every Monday, and we're hoping to get this questionnaire done by maybe in 2 or 3 weeks' time. And the holistic governance questions, including on and off-chain parts, they really require interdisciplinary input. There is no single science that can answer all important questions surrounding that. And I'm very happy that Jamin showed earlier this slide with the breakup of various groups in the economics field. And now add that with social studies, with computer studies, with legal studies, and then you really get a full picture. And we are really lacking proper research, and I'm happy that Jamin is picking a part of this up, even though concentrated on the economic side, which I personally believe is not sufficient to really cover the whole spectrum. And the question is, and I talked to a lot of professors about this, why is this the case? Why don't we have already proper research in that area? And the problem is, again, silos. Also in science, we have silos. The institutes need to publish in certain magazines in order to get funding. The magazines are concentrating on certain topics. So the research institutes are struggling with finding magazines publishing interdisciplinary studies, and hence they don't get funding for it. And I really can invite everybody to support thinking about how we resolve that problem. Because I really believe we need to overcome this in order to build something meaningful. So, Wharton disclosure questionnaire. Let me give you a little bit of insight how this is structured. We have currently 5 sections. The first one is just a background section asking for the general purpose of the given network, success and metrics for success, the question if there is any coordinating entity or organization of any sort involved, and if participants in the network are identified in any manner. Then the most important thing, I believe, is to think about the stakeholder groups. We had long discussions about how to define stakeholder group. What does that term actually mean? And who does this include? So we tried to left it as open and as much to the viewpoint of the project, hopefully answering that question at some point, to define it itself, but we wanted to give a little bit of guidance, what you could think about. So we were coming up with this term of intrinsic groups. These are those groups which are recognized by dry or wet code, and which are built in the social or legal structure of the project. But we would also like to invite people to think about extrinsic groups. So those groups which are only more or less directly or even indirectly effective and not yet considered within the given governance of the system. So think maybe about competitors, right? And alike. And then there are questions surrounding how to actually access an intrinsic group, the ability and limitation to interact within that group. Is that group enabled to organize itself, to form opinions? And then also the question of costs of exiting the network or any of the groups built within the network. Then we come to the incentive schemes. That's basically surrounding the token economics topic. So what behaviors did the project decide that it wants to incentivize, and how does it do it? And for those projects already running for a while, it would be really nice to get some feedback on the experience with the chosen incentive mechanism, and if it actually worked out as it was intended to. Then we turn in section 4 to the governance powers, sources and roots of the network's governance, and the policy setting. And you can compare like policy setting with the legislative in, democracies like in the Western world, versus implementation power, which is the executive, and versus the interpretive power, which are basically the courts in our real world. And then we would like to add the fourth power, which is basically media, right? So who is creating transparency, and is transparency actually facilitated in your given network? And how do you build that in? And then after like structuring or thinking through what kind of powers did you build into your network, we turn to the procedures. So how are conflicts resolved in your network? What system of checks and balances do you provide for? How is the accountability organized amongst the governance powers of the groups? voting, is there any formal voting? Is there any informal voting, like signaling, and how, and what part of that is actually coded? And then, system for protocol updates, development work, how is that all funded? Does the system provide for such a funding? So that's basically what we currently built. It got more than we wanted. Initially we said, let's try to just come up with 5 core questions, but it turned out it's not possible. So once you start talking about that, it's not possible to really limit it to a very small set of questions. I believe we are now, I don't know, at about 30. We arrived at about 30 in total to cover all these topics. Yeah, maybe just a few words coming back to my legal background, because there's so much discussion about DAOs. DAOs are a great idea, but I just would like you to consider what this means from a legal perspective. And I know, I'm aware it's very hard for like a global DAO to figure out whose jurisdiction is actually applicable, but I'm sure in the end, rather more than less jurisdictions will believe that they are applicable. So it's rather a bigger problem than a smaller one. If people gather to pursue a mutual goal, then they are forming an entity, if they want it or not. This is simply due to the fact that any group of people working together needs to choose between a specific set of entities. If you don't do that, you end up creating what I call the default entity, which is in Germany die GbR, die Gesellschaft bürgerlichen Rechts. Any kind of jurisdiction knows such default entity, and it typically comes along in any jurisdiction with unlimited liability of everyone involved. So that's rather something to avoid, right? And I know it's unfortunate, and you would love to do it differently, and do it without any legal framework, but law really applies universally. You cannot exclude it. This is simply what automatically happens if you don't make a distinct choice what else you want. So we started discussing if we could maybe see it rather as star contracts compared to franchise system. In the end, it doesn't really work. If you do a joint voting on stuff, if you organize like a partnership or like a company, you will find yourself in such a setting. So that's a reason why also we need to think about how to organize this better. And Malta is making some steps. We'll see when this comes up. Yeah. So in the end, I would like to invite you to rethink about governance structures, because I personally believe that the history through which we went during the past years did not lead to a healthy development of the whole ecosystem. I think we need to focus a little bit more on the social impact of the networks we are building, and not only to see them as economic mechanisms and as private wealth growing tools, but get back to the idea that we are building digital streets, that we want them to be open and permissionless, and that at least the basic infrastructure shouldn't be profit driven, but should be there for everyone to access it, and to move the for-profit things rather on the application layer, which would enhance collaboration again, and which would certainly, lead to systems that I guess we all can quickly agree on will deliver a better world to the next generations, our kids in advance, in opposite to building something that creates roadblocks at any intersection where you want to make a turn, as it is right now, because every system is expecting its own toll in its own currency, and that's not really helpful and sustainable. Yes, thank you very much.
Thank you. Thank you very much, Nina. Thanks for being here. And I think this Wharton School initiative and this project is open to everybody to join in and contribute.
Well, it started with a group of 30 people really sitting for 2 days around a table. And it will be, the crypto governance disclosure questionnaire will be published, and whoever wants to use it can use it. There will be certain groups trying to motivate their projects to actually participate and answer all of those questions, which might not even be that convenient to do if you're forced to think about things that you maybe rather avoid talking about. And then we will see how we can gather that. And if we actually find a research institute picking up on the data that we're producing by collecting those answers to the questionnaires. Yeah, but everything will be public except for projects choosing not to have their answers published, right?
All right, thanks a lot. We will definitely share once this paper is published, and so stay tuned and get in touch with Nina. You'll find her Twitter contact on the speakers page, tegg.io/speakers. Thank you. Our next speaker is Paul Kohlhaas. Hello, Paul. So Paul is the founder and CEO of Molecule Protocol, and one of the key players in the token engineering ecosystem as well, researching and doing meetups, spreading the word on curation markets and bonding curves. And in your talk, you'll explore bonding curves for funding R&D in the Molecule case, and the legal and practical challenges resulting from such a design. Looking forward. Welcome, Paul.
Okay, super. Thank you so much, Angela. Yeah, it's really a pleasure to be here. It's been an incredible week. And I've really been looking forward to this event to really kind of deep dive with you guys into some of the legal and token engineering designs that we've been working on. So maybe a little bit of background about myself. I originally studied economics and politics. And ever before that, got really fascinated about the global pharmaceutical system. I think it's one of the really last big, well, we have many broken systems on our planet, but if you look at the incentives in pharma and the effect that it has on global GDP and on our global healthcare system, I think it's one area where we can really innovate and where we really need to innovate. And I think in a similar sense as with, so like if you think about blockchain networks, decentralization is a very important aspect, and we're seeing huge advances in bioengineering at the moment. And I think in the same way that there's a large discussion going on around the monopolization of artificial intelligence networks, I think we really need to think, cool, how can we apply this in drug development and bioengineering so that we don't end up in a similar monopolized ecosystem. Cool, so before jumping into like the depth of token engineering within Molecule, I just want to describe the problem to you that we're really trying to tackle here. So over the past 20 to 30 years, drug development has become exponentially more expensive and hard. And so currently it costs about $2.5 billion to bring a single new drug to market. It's extremely slow. It takes 10 to 12 years for the FDA to approve a new treatment. And if we think about capitalism, we can say, cool, all of that is fine as long as drugs actually make it to market and people are cured. But it's also increasingly unprofitable for pharma or biotech to pursue this. So it's projected that the internal rate of return of investment in pharma R&D is projected to hit 0% in 2020, which means economically most of these giant pharmaceutical companies would be better off cutting R&D completely. So what we have in pharma today is a really broken incentive engine and a very, very long development cycle. And we look at this from a very basic statement. If you think how pharma works today, it's very close to how software development worked in the early 90s to mid 90s. So very monopolistic, very kind of large corporate players that take drugs through these like last final stages to market. So drug development is kind of where software development was 30 to 40 years ago. And it's really because of how incentives are structured in that system. So incentives, and this is not just the case for drug development, but also in other areas where intellectual property is still the key value driver. So patents and intellectual property by design disincentivize collaboration because they create a monopoly. So this pricing monopoly that an entity is granted once they bring a new drug to market. And that essentially creates very closed source research and development systems. So what happened in open source software in the 90s was new licensing frameworks moved software development away from patents and into open source licensing frameworks that allowed people to develop new business models that really drove collaboration between different industry players. So the Linux Foundation is one of the best examples of like a non-profit entity that started driving these new designs forward. And I think we in the blockchain space, or like I'm saying we in the blockchain space, I think we've learned a lot of those designs. So if you look at designs like the Ethereum Foundation, they're structured in a very, very similar way. Imagine Ethereum had been like patented, or like, I mean, we see this again and again that like big banks in the blockchain space are still patenting new blockchain designs, and everyone is always shaking their head. But you have to think many other industries still completely operate in that way. Another big problem that comes with that now is that negative data is never published. And that leads to, or is very seldomly published, and that leads to reproducibility crisis, not just in pharma, but in the broader sciences. So imagine now, if I have a patented compound or even a patented program, and we find out that the compound doesn't work, or let's say the program is extremely buggy. Well, if we want to take the program to market, we're going to fix all of those bugs. But if it's a drug, for example, maybe we don't want to show some of the negative data. And this has happened in drug development over and over again. Like out of, let's say, 100 trials that are run, you only want to essentially release the good ones, because why should you show the world that you're developing something that isn't working? And so open source development really turns that on its head. So for example, in Ethereum today, there are economic incentives to show bugs. And I mean, one of the easiest way to do that is by exploiting a bug in the Ethereum network. I can negatively influence the price, and I can gain from that price arbitrage. So, and the last point, IP and patents are one of the last big areas that are extremely illiquid. So to date, we haven't seen any kind of liquidization of these assets, even though they hold so much economic value. So if I, for example, successfully bring a new cancer therapeutic to market, that intellectual property can be valued upwards of $100 billion, just because it has a long expiration time. And essentially what's priced into that are all the future revenue streams. So what do we need? We need new incentives and really new solutions that can drive stakeholder collaboration. And so what we've been working on at Molecule is really trying to design a system that unites incentives between the different participants in the pharmaceutical and biotech ecosystem, so from patients to universities to larger corporates, and really trying to combine these two methods. One of them is open source R&D, and the other is token economics. So this is the typical drug development process today. You move through these different development stages: discovery, preclinical, phase 1, phase 2, phase 3. And below you kind of have typical innovation cycles within companies where you have a lot of ideas to begin with, and then you kind of narrow it down. And when I first heard about curation markets in like it was like mid 2016, end of 2016, Simon de la Rouvière started working on this concept called meme markets, where essentially, if you think about how memes are chosen on the internet, you have people post memes to different sites, and then some of them get upvoted, others get downvoted, and somehow a meme goes viral. Development processes are very similar in that sense. And in drug development, you start with a lot of molecules that have potential, and then the market narrows it down. And so this is when we first started thinking about applying the concept of curation markets in this use case. So enter curation markets and bonding curves. I'm assuming most of you know or have a basic understanding of what bonding curves are. So I won't go too deep, but they're essentially incentive coordination tools. A bonding curve is an autonomous market maker that we can use to price illiquid assets. And they really provide new financing and funding mechanisms. And they also reduce information asymmetry. So, and maybe as a super small recap for anyone who doesn't know, so a bonding curve is basically a smart contract that I can deploy that enables me, that creates a continuous issuance of tokens for a specific objective. So anyone at any time can always trade with that contract by sending it funds and receiving tokens, and vice versa, sending it tokens and receiving funds. And the pricing in between that is structured via an algorithm. So this is the most typical, kind of typical depiction, which is just a quadratic curve. And what we can use these now is really get people and systems to behave in new ways. And the other example that I want to make is, so we, in a token engineering sense, we now combine this with a concept called a non-fungible token. So IP, intellectual property in the most basic sense, is usually based on patents and proprietary data as a time-stamped claim. And so we take the information, the data in a patent or in a new piece of IP, and we attach that to a non-fungible token. And what we then do, and this was a concept that was first spearheaded by Billy Rennekamp in early 2018, is a concept called a refungible. So we set the owner address of that NFT to a bonding curve. So now the bonding curve fully controls that intellectual property asset. Of course, there's still legal implications to play into this, but that's the basic concept. So this was first proposed, for example, to trade shares and attention in a CryptoKitty, but we can obviously also trade shares and attention now in a pharmaceutical patent. So what happens now once we create these open markets for IP? You kind of have to think back to this picture. We can take each of these assets that are in an early stage development process, we attach it to a non-fungible token, so now it's unique, and then we create a market for each asset. So now different market participants can start curating information and releasing information about the assets, because they can positively or negatively influence their prices. So in a very basic sense, this is also, in this case, bonding curves have a lot of similarities with prediction markets to some extent, because they curate information. So positive data is likely to increase the price of the asset, negative data is likely to decrease the price of the asset. The market participants now have an incentive to reveal data, to analyze the data that other participants release, and to place their bets accordingly. So in the concept of science, I think this is really interesting, because now this can also boost peer review and take peer review to another level, because now each data set that is released is likely to be analyzed by another participant who might have a differing position and might correspondingly want to react and say, no, I think in your study this and this wasn't correct, because look at these properties here, for example. It's really interesting as well, because if we have these open markets now, what are the implications for insider trading? Is insider trading in this context still a thing? Like, in our case now, scientific data can become insider trading information or financially valuable information, which I think is really interesting as a concept. Cool. So what's really new with bonding curves? So they provide immediate liquidity by creating a primary public market maker to issue, buy, and sell tokens. As a side note, and we'll get to more legal stuff just now, so this contravenes most securities laws. So most securities laws by definition have a lock-in period. If you do Reg D or Reg C exempt securities offerings, the lock-in period tends to be 3 to 12 months. So bonding curves by design just topple that regulation to begin with, so it's something to consider. But what they really enable us to do is they create markets where it was previously completely impossible to create a market for, like a meme. So anything that is illiquid or hard to price. They also enable trustless price discovery and new funding models, for example, through taxation schemes. But also consider that this creates revenue model implications. So if we put, for example, a tax on a bonding curve, which a lot of DAOs are currently kind of experimenting with, there's a project called Continuous Organizations that really tries to, so essentially for anyone who doesn't know, is if you put a tax on a bonding curve, you essentially have a different buy and sell curve. But if you're now using that as a revenue model, that also has VAT implications, which is interesting. So we've kind of tried to think around what are existing legal models like that we have in our world that we can apply to this, and one is a market maker. And I have a very simple definition here. You can go much deeper into like the legal definitions of a market maker. In financial markets, is a market maker or liquidity provider is a company or an individual that quotes both a buy and a sell price in a financial instrument or commodity held in inventory, hoping to make a profit on the bid, offer, spread, or turn. So market makers are an existing thing. And so we can analyze how autonomous market makers or bonding curves are different from that, and we can learn quite a few things. Just looking at the bottom definition, so first of all, a bonding curve is not a company or an individual, it's an autonomous smart contract. It does quote a buy and a sell price at all times. It doesn't have to be a financial instrument or commodity. We now know it can be pretty much anything that we want it to be. It holds whatever it sells in an inventory, but it also doesn't hope to make a profit on the bid, offer, or spread. So there's a lot of differences to the only definition that we have in our legal world already. This is kind of a taxonomy of the different design parameters that kind of I drew out, I think about half a year ago. And the more people started exploring bonding curves, the more they really realized that there's an extremely wide set of parameters that we can fine tune. And then going into token engineering and simulation, we really need to simulate what these different parameters do once we start tuning them. Because what bonding curves really just are, they're programs, and we can program them in whatever way we want. And just to run through, like very briefly, you can change the issuance in a token bonding curve. So we could issue NFTs through a bonding curve, like artworks that are autonomously issued. We can change the token supply. A lot of bonding curve designs initially assumed infinite token issuance, for example. We can also make cap token issuance, have different stages of a sale. We can use different forms of collateral. So most bonding curves initially assumed using Ether as the base collateral. We can also use DAI. We can stake a different asset into the curve, use a different function, and price the curve accordingly. The biggest legal implications come both from the asset that is in a curve, as well as how we structure the pricing. So the asset is normally like what does this curve actually represent? Is it a security? Are we selling a membership? Are we selling a service level agreement? And the pricing is if we have different buy and sell structures. Because I could make a very pure bonding curve that only kind of measures interest in this asset, but I can also kind of now start creating these revenue models where a central entity gets revenue from each buy and sell that gets made through the curve. So there's huge differences here in terms of how this might be treated by the law. And so something really important is all of our engineering and design choices have really profound legal implications. And this is what the previous speaker also said, which I thought was really great. Consider like a DAO that doesn't have any legal framework might mean that it's unlimited liability for all of its members, which is a really scary, crazy thing to think of in like the real legal world. Cool, so what are some of the legal classifications that we can look into? And this is a fully non-exhaustive list, but one simple way to look at it are if you structure them as donations. So the tokens are pure donations and they don't have any backing into the real world. And then you're in gift law. This could be used for Kickstarter, it could be used for certain DAOs, it could be used for grants. The other one is gambling and predictions. Then you're in gaming law. Meme lords, for example, I think one of the first like live implementations of testing bonding curves would most likely be in gaming law. Then different prediction markets, things like FOMO 3D. Another big one, I think, and payment for services will be a really big area, I think, because we can now structure various service agreements through bonding curves. This could be, for example, concert tickets, it could be licenses, it could be event tickets, it could be service agreements, and then you're in contract law. Remember, in contract law, you most likely have VAT implications from the tokens that you're selling there. Then membership, then you're in membership law. So Common Stack, for example, is mostly looking at a membership model. Other DAOs are looking at that as well. Beware that if you're in membership law, but you attach profit incentives to it, then you're probably in a collective investment scheme, and then you're probably a security. So those are all things to consider. And the last one are assets and securities. Then you're obviously in securities law. And so this is the area that we've been mostly thinking about, because as soon as you deal with intellectual property, you're actually dealing with the rights that are attached to that IP. And how can you structure that? So I have two examples that I quickly want to go through with you. The one is kind of the purest example that we've been working with Molecule. This is obviously extremely oversimplified, but so a bonded market for intellectual property. The tokens that are issued through this bonding curve represent ownership in the intellectual property. And now, thinking back to the incentives again, we could have multiple parties now developing this intellectual property and receiving stake in the intellectual property through their contributions. The intellectual property is moved into a special purpose vehicle, so it's moved into a separate entity to wherever it was before. We could then say a 10% tax is applied to all purchases, and that tax goes directly into that real world special purpose vehicle. These tokens are 100% securities. You're securitizing the future royalty streams that could come out of those tokens. So let's say at some point down the line, I hold one of these tokens and I would receive almost like dividend payments for when this drug comes to market. Remember as well, in this case, if you put this on a bonding curve, all contributions would need to be KYC'd. They would also need to be whitelisted. And here, participants acquire rights in an investment contract. Really, that represents rights to those royalties. One more example? One more? Okay, and the other one is, for example, would be an example of a donation curve. And this is what we're really pioneering with our alpha launch that's coming up in early October. So in our alpha launch, all tokens would represent donations to a project. In our case, it's 3 early stage research projects. And then what you say is a 20% tax is applied to all of those contributions to fund a specific project. And once the curve fills up, so there's a limited issuance, once the curve fills up, at the end, all the funds are redistributed between the participants minus those 20%. So this is really now like an incentive game. And here the participants essentially gamble on the success of a donation campaign through a bonding curve. So the early participants stand to win back a part of their contribution or maybe even make a small return. But this really depends on their own efforts. And the token itself, in this case, represents the value of the curve collateral, so the value of all of the collateral that has been staked in, as well as a memento of the project, or in particular cases, you can also bake in project rewards. We on? Okay, maybe one last thing that I want to say is we've been working a lot with block science to engineer incentives and simulate incentives exactly for use cases like this. And I think there's going to be a workshop later on CAD, which is a specific tool. And here we can, for example, we can measure what returns would be based on like different stages of contributions. We can measure what tax rates kind of have what incentives. So we found out, for example, that 19% of all contributors at a tax rate of 20% can stand to break even or making a small ROI. We've also looked at dynamic tax rates, so ranging them from 5% to 20%. In this case, obviously the ROI changes. And then we've really looked at the desired ROI that we want and then defined the tax rate based on that. So it's been a really incredible tool for us to work with and to test a lot of these new behavior patterns that we're building here. As a last point, I want to say it's super early days. So simulation in simulating these designs and really testing different parameters is extremely important. And then I think it's really early, and in that case, we also need to consider a lot of the things that we're doing as experiments and be careful not to kind of venture too far down the legal rabbit hole too early, but really choose use cases that we can easily alter and experiment with. Thank you.
Thank you, Paul. Thanks also for mentioning CAD tool. So we will dive deeper into simulations and engineering tools, framework, processes in the afternoon, where we have several use cases and also, as mentioned, the CAD introduction workshop where you can try yourself and see how simulations work. In this case, with Clover's network use case. And I guess there are also examples online from the bonding curve simulation at Molecule. So again, sign up to our newsletter. We will be happy to share material and links related to that. Now, as the final speaker prior to our lunch break, I'd like to welcome Caleb Sheridan on stage. Welcome, Sheridan. Caleb.
Thank you.
So Caleb, you're the co-founder at Blocklytics, and you're currently analyzing data at FoamMap. And the special thing with cryptoeconomic systems, as we heard already, is that there's data available on transactions and network behavior. And we will be able to engineer feedback loops to develop and adapt and improve the systems. And part of these feedback loops can be analytics like you will present in a minute. And in addition to that, I think we can also get insights from the behavior of the networks and how they, let's say, cooperate in specific cases to get a glimpse on how to tackle irrational behavior of network agents. So I'm very much looking forward to this talk. Caleb, the stage is yours. Give him a round of applause.
Thank you. Hi, my name's Caleb, and today I'm going to tell you a little story about the FoamMap and what happened earlier this year with regard to some very contentious activity on the map. I'm the co-founder of Blocklytics. We look at on-chain data, and we've been looking at Foam for about the past year. In case you're not familiar with the Foam project, their goal is to provide decentralized location services. And this takes the form of two products. One product is their location product, which is a dynamic proof of location, which is under development now. And then the other product is the FoamMap, which is a TCR, or token curated registry of locations. So this token curated registry includes information about points, like where the point is in latitude and longitude, the name of the place, like a restaurant or an attraction, and a short description with some other metadata. The system design of the FoamMap and how this token curated registry works is that cartographers add points, and they stake a few tokens in each point in order to assert that the information is valid and correct. And challengers or validators can challenge points to vote them off of the map, or to say that this point should not be included on the list. So challengers also have to stake tokens, and what this creates is an incentive mechanism for people who add points to add valid points, and also for challengers to identify and ultimately remove points that are invalid. The final kind of party within the system are voters who actually determine the outcome of these challenges. And so what's happening is people are staking Foam tokens in points, and then challengers are also staking against those points, and voters decide who wins. And if the point owner wins, the point stays on the map. And if the challenger wins, the point is removed from the map. And a portion of these tokens are split between voters and challengers or the point owner, depending on the outcome. So what's happened on the map is that 10,000 new points have been added. And then following along the top line of this diagram, about 6% of points have been challenged. And then continuing along the top line, about the vast majority, about 87, 86% of the challenge points have been ultimately removed from the map by the voters. And so looking at an actual example of a challenge, this is the first challenge on the map. And in this challenge, the challenger asserted that the White House was in the wrong location. And this was pretty typical challenge activity, right? So in this case, the cartographer who placed the point actually placed the White House on the north lawn, which is not where the White House is. The point was removed. And this is kind of, over time, a lot of these points were challenged for being in the wrong spot. And over time, the challenges shifted towards maybe imprecise metadata or missing metadata. So for example, the Kyoto Imperial Palace was removed because the cartographer who added it did not add a phone number or website. So this point was deemed to be not high enough quality to be included on the token curated registry. At some point, a point called the Meatworks Butchery was challenged, and the challenger asserted that the phone number was incorrect that was listed on the point. So a community member actually posted a picture of a business card from the Meatworks Butchery that showed that the phone number was accurate. And so we saw challengers kind of taking the history of challenges and maybe kind of using it against the voters, right? So where it's very typical to have a challenge where the phone number is wrong or is missing, in this case, that wasn't true. So Meatworks Butchery ended up being challenged another 5 times and survived each challenge. And the challenge reasons became quite interesting. So in some cases, one challenge reason was that meat is murder. Another challenge reason is that the point owner is a communist. Another challenge reason is that I don't like the name. In these cases, of course, the point survived and the system was working as expected. But there was a broader issue, and there were two kind of things that happened around this time on the foam map. So one is that community members were starting to post lists of assessments of the challenges and the challenge reasons. In this example, the community member Foam Spacer posted a list that included challenges based on blatant lies. And he posted a series of points that probably should have stayed on the map. But in this case, what was also going on is that the amount of tokens deposited in the voting contract, which provide voting power, was also increasing. It almost doubled. And so what this means is that contentious challengers were using foam tokens to vote on these contentious challenges and kind of taking over the voting process by bringing a new weight of votes to the map. And so how the community combated this, and what's kind of interesting is that they started more of these lists of assessments. So this one is by Ainsley Sutherland, and it includes a lot of points with justifications or reactions to the challenge reasons about why the point deserves to stay on the map. In this case, most of these points did survive. Another interesting thing that happened is the community user GeoPeter posted a forensic guide, a forensic research guide on foam. And this is like an extreme reaction to a set of contentious challenges. The community was spending a significant amount of time investigating on-chain data and going through Etherscan and the foam map and other tools in order to generate these kind of lists, and then cross-comparing it with the information about the individual points. And so what this activity ended up doing is actually bringing more attention to the contentious challenges and bringing in a significant amount of more voting power to the map. And it all culminated in this final challenge against Whole Foods Market. And in this case, 24 accounts voted on the outcome of this point, of this challenge. And the outcome was to keep the point, and they voted with a significant amount of tokens. So the core issue or the core solution in this case and in this story about this contentious challenger, set of contentious challengers, is that there was an information asymmetry. And so the foam team and the foam community and myself have been looking at ways to kind of combat this. In one instance, the foam team created alerts, email alerts if a point is challenged or if you have the opportunity to vote on a point. And then in other cases, we developed a custom blockchain explorer that's an alternative interface to the foam map to show all points, all challenges, and all cartographers of the map. You can go to this tool and view this tool at foam.tools. Some of the important things that we added here in order to reduce the information asymmetry is a history of actions taken by different network participants. And so this includes, of course, a history of, say, for example, who added the point or who challenged the point or who voted or what their historical voting record is, but also an element of reputation. And so these are profiles provided by 3box.io. And they provide a reputation system for the phone map. So if an account has a poor reputation, or then voters can use that information to make a better decision. Or likewise, if an account has a very good reputation, then voters can also use that information to make better decisions. And so that's kind of the end of the talk here, but what is really important is that there were these contentious challenges identified by the community. The core root of the problem is information asymmetry, and this is kind of some of the ways that we're balancing that out. Thank you very much.
Thank you, Caleb. Maybe, are there any questions, since we have some minutes for questions on this example? Any question? Yes.
Hi, thank you for your talk. Can you elaborate a little bit on that? So your project collects the data and the token mechanics should guarantee that the data is of high quality. Do you keep this data inside your project or do you feed it back into, I don't know which map, which underlying map you use, OpenStreetMap or Google Maps or whatever? Do you kind of try to, for me it would be kind of nice to help improve this big open data set which OpenStreetMap has been collecting for like 10 years already, then just keep it all inside your project. So what do you do with the data?
So I'm not formally with Foam. I am working on the Foam project, so I can't answer on their behalf. The OpenStreetMap data itself is not I don't think that it's as high quality as the Foam map data, because anybody can contribute to it, which is great, but the curation of the OpenStreetMap data is not there, right? That side of the ecosystem isn't there. So Foam has really effectively solved that side of the ecosystem of verifying data in a way that, say, OpenStreetMap has not. And in fact, this is quite a big problem where OpenStreetMap data was adjusted recently in a way that renamed New York to Jewtropolis on a lot of maps and affected applications like Uber and so on. So this is, I think that verifying, publicly curated data is a really important aspect, and a token curated registry seems to be a good way of doing it for now, but yeah.
Second question, yes.
Where is the data stored? Is it stored on Ethereum or where is it stored?
The points themselves are are stored on Ethereum, yeah, and there's an IPFS hash where the metadata for each point is stored.
Any additional question? Okay. So thanks again, Caleb, for being here. You'll get a t-shirt. Thanks a lot. And now we have a 1 hour break, have lunch. We will meet again at this stage at 1:30 with additional talks. And as well, you can, starting from 3, you can also participate in workshops. So see you in 1 hour again here in this room. All right. Let's go ahead with our afternoon sessions at TEGG 2019. Our next guest on stage is Dimi de Jonge from Ocean Protocol. Welcome, Dimi. Round of applause. Woo! So Dimi is co-founder and head of product and research at Ocean Protocol. And we talked, of course, about, okay, it would be so interesting to have Ocean because of your experience with token launches and the entire journey from protocol pre-launch to in early 2018, I guess, until now. And there you go, engineering notes on launching the Ocean network and tokens and all the stuff we didn't think of. It's yours.
Hi, everyone. Is this on? Or do I need to press a button?
Yeah, thanks.
Hi. Hey. Yeah, thanks for the intro. I think what I want to share for today is a bit more like really practical engineering, like close to DevOps. So we had always these big, gigantic ideas on what to build for, but then we actually start practically doing it. Turns out you forgot, or you just couldn't think of a lot of stuff. It's mostly about, yeah, you just have to have a good plan in order to launch a network, deploy your contracts, make sure they are upgradable, make sure that you leave some room for error and margin, and that you deploy this in the right steps. So I just wanted to share some of these notes because I think it's just practical. It might, hopefully, it saves some of you guys 1 or 2 days of your current plans for deployment. And if that's the case, then I think that I've been successful. Otherwise, if I add more time to your stuff, then yeah, I failed. But here we go. Right. So first, you kind of want to gather all the capabilities that you want your network and protocol to encompass. So I'll give you a bit of a rundown very quickly on what Ocean's supposed to do, what it actually does. We sometimes refer to this, to Ocean Protocol as either a public intelligence network, meaning that there's a supply chain of services, data services connected to each other, and they try to solve problems. And Ocean is built in a way that you have fine-grained permission structures between all those services, and you have attribution along those services as well. So if you do something successful, this entire supply chain gets rewarded. So we could call it an inter-service network. We're not saying that, well, you have to pick this compute, this cloud or this. No, it's very heterogeneous. There's a lot of service providers here. There are Web 2 and Web 3 service providers. And we've tried to find a way to create full supply chains of services that have the capability to solve interesting problems, necessary problems, and everybody within the supply chain, every service can have an attribution aspect and a governance aspect to it. So parts that we're thinking of is, well, can you create machine learning communities? Because for me, a token network is still all about coordination between agents, and those agents can be human or non-human. So what we're trying to see is that, well, if somebody is capable to solve one problem, for example, we have something going on to predict lung capacity from X-rays, so there's a lot of object recognition and anomaly detection going on there. If this is a successful project, can we create something that's called X-ray net? And that actually attracts a community, has an incentive around it for people to contribute to that, such that you create stronger healthcare capabilities. And you can also think about autonomous vehicles, you can think about preservation of natural resources. It all needs to have like a sort of community with an identity and an incentive around that. And maybe if you have a solution that works in one domain, maybe that can signal itself forward to other domains. So here you have not problems looking for data, but data knows it can solve some specific set of problems and signals itself forward to new problems. I think that's very interesting. Now, a lot of these services and data science and data engineering flows, they're currently living in Web 2 real estate. And then we're saying they're living in the cloud, they have toolkits that aren't necessarily Web 3 compliant. And when we're talking about data, we're often talking about privacy, but we forget that we're actually talking about information exchange. So we try to find the useful protocols for people to extract information from a set of data or machine learning algorithms. So you enter into kind of a protocol negotiation where, for example, some data scientist wants to deploy an algorithm on a data set, but the data set owner doesn't want to have any data escape. So the protocol could go like, hey, can I run this algorithm? Or can I pull your data into my algorithm? The data owner says, no, it's too private. I only allow algorithms to come to my secure private zone and there deploy an algorithm of these types of structures. For example, I only want to have algorithms that are provably secure from a data escape point of view. So this type of negotiation needs to take place between two actors, the one owning the data and the one wants to learn from that data. And that's happening in Ocean through something we call service execution agreements. And that's our access policy. And it goes a bit like this. These are instances on smart contracts. They're basically smart contracts negotiating conditional access. So it's modular. You can compose it out of cryptographic conditions, saying that, for example, hey, if you want to access this service, you have to prove that your public key comes from a set of trusted public keys, for example. You need to deposit this amount of tokens for security bounds. You need to deliver a proof of computation or a proof of retrievability for you to successfully prove that you actually delivered the service. Basically, this entire negotiation, we try to put it conditionally into smart contracts, deploy those on chain, have a cryptographic messaging back and forth between the actors, and then rewards are being dispensed in the end. So a little bit of the layout there. It's very close to what people would call service level agreements, but we moved that concept into smart contracts, and it's a very core engine within our protocol. And then, of course, we want to incentivize behavior inside of the network. So we have a network reward function, which is quite flexible to program and can steer and be governed over time. Currently, we're promoting people to provide something that's called commons.oceanprotocol.com. So there we just want to have free data sets. People hosting and providing free data sets are eligible to get rewards initially, because we want to get rid of something we call the empty network problem. But once more and more data sets come in, you kind of want to have high quality data sets, and then we can shift our network reward function to curation functions. And if we want to have more provable services, and then we could shift it towards proof of execution, proof of service providers. So creating this reward chest is something that we think, well, it's interesting and useful, but also needs to be dynamic. So we have to take that into account when we're going to design for this, that there is a governance layer need to be attached to it and needs to be programmed over time. Another interesting thing that we have is when, well, we have the ability to inject basically liquid ownership onto these services. So we use things like bonding curves that can attach to these policies. And it's a bit like a refungible token, right? So each service agreement you can think of, well, that's kind of an NFT, and then we make it liquid in the ownership structure by attaching the owner to a bonding curve. So this also could then say that people that signal forward that this is an interesting service, they get an early mover advantage, and that can then be rewarded through this network reward function. These are all things that either we have done or we're planning to do. And the thing that we need to solve now is the problem, how are we going to set up our deployment plan to make sure that all these promises can actualize with us, without us like fixing ourselves in a specific direction that we can't get rid of. So there's a few things. You want to first simplify the problem, right? There's a lot of capabilities you want to do, so we need to simplify it a bit. So one way you can do it is you can say, well, we're going to split it up in protocol layers. So at the bottom, we have service providers. They are connected through a decentralized access control token. I'll talk about that a little bit later, how we actually do that. Then we have the service agreements here. We have people verifying or agents verifying that the service actually behaved well. And then on top, we have more like the discovery, the opinion, and the creation part of things. So we say, well, our lowest layer where the smart contracts are running is the keepers. Then we have verifiers who verify bespoke services. On top of that, we have curators that are more into the opinion and signaling game. Another way to look at the same thing is the components, the microservices you're going to deploy. We have metadata discovery functions. Here we use technologies like BigChainDB or more centralized database technologies to set up marketplaces. And just like catalogs and discovery of those services actually. These agreements are running onto currently Parity POA. But they're just EVM compliant. They can also run on Ethereum mainnet, and that's what they do. And then the verifiers, this is bespoke cryptographic nodes. So we have one thing that we're using from Parity as well here is called Secret Store, and that's a way to basically shard of secret into little pieces and then have things like threshold encryption and threshold decryption, and it's very interesting for us to use. On the consumer side, we just have wallets. We have things like burner wallets as well to make the onboarding quicker. We have plugins with existing tools like data scientists. They love to use notebooks in Python, so we made dedicated plugins there so you don't really have to go out of your trusted environment. On the other side, we have, well, Web 2 real estate, meaning cloud service like Azure and AWS, and those need to kind of hook into the smart contract layer, right? So here you're looking at Web 2 authorization and authentication, and now you have to find a way to drive that access policy with our decentralized access policy. So for this, we have like kind of a proxy node that you would run in your cloud, and that proxy node makes all the bridging with our decentralized access policy possible. This is kind of how our engineers designed it. The interaction flow between all these things. So you have your decentralized access policy, you have your centralized access policy on the cloud. This node will basically make sure that those two are respected. We have a way to share secrets for example, session keys throughout the secret store, which allows us to encrypt and decrypt in a decentralized fashion. And then we have this OceanDB, this discovery service. So you have to hop up, like this is basically saying that how the protocol looks like. You start with posting your service into the metadata. Someone can discover and find it, then tries to negotiate access. The access points, hey, you kind of want to follow this smart contracts, and that will dictate what you actually have to do. Maybe you want to deposit some tokens. Maybe if you're permitted through your public key that you're part of a tribe that nurtures the commons, then you automatically get access to more set of services because you're a commons provider, then you automatically become a commons consumer, and et cetera, et cetera. The details are in the code, of course. So what was required, and maybe I just want to have a little time check here. All right, 7 minutes. Contract deployment and development. So we could easily identify these type of smart contracts were necessary to deploy this. The pink ones, they popped up as we went along. So we factored this in, and this was kind of, oh yeah, damn, oh, we need to put something here and there. And that basically, that hurts your deployment timeline, right? So if you know this up front, well, if you have a token, you also want to have some roles for the token to be dispensed into the network. So you need to create contracts that can either be a placeholder for that role, or they actually have capabilities to mint and burn tokens inside of your system. But you have to account for it. If you want to do some side channels or you want to have a side POA, then you need to have something like a token bridge that can communicate back and forth with another chain. So you need to set that up as well. It also has additional services attached to it. And then if you run a POA network as we do to make stuff more smooth, then you need to govern the network nodes inside of this POA network. And it's also, you need to have the ability to add nodes, remove nodes, add permissions, remove permissions, all these things. And then there's a set of utility libraries that's very practical to maintain, allows you to upgrade quickly. So from a topology point of view, we started them fleshing out, well, we know what the capabilities are, we kind of identified what the contracts are, now we need to find out what's the permission structure and the roles we need to deploy in this system. And sometimes we didn't know up front who was going to be that role, so then we either had to set like a temporary role managed by the foundation or organization. In our case, that's the Ocean Protocol Foundation, that then says, well, in the future, we're going to assign this role to a dedicated actor in the system, but now we don't know yet, so we'll put the Ocean Protocol Foundation as a stub in place. So as you can see, we identified a lot of roles here and made sure that, well, all of these things can be connected. More importantly, you want to look at how the timeline for your deployment. These things have to go in lockstep. Like you deploy one thing, then you have to deploy the other thing. And for example, you need to have your wallets first to deploy the token contracts. You need the token contracts before you do the dispensers. Then you can start registering the token minters. And then the stuff that we actually thought the only thing we had to do. So that's then saying that, well, we need to have a registry for all the services. We need to have the service agreements and then the administration functions, etc. So we went to all of these things. And actually what we did is we also created an open source tool, because this a lot of, well, there's things like Zeppelin OS and it's super useful, but you're gonna have to do a lot of the custom tooling. So we put our custom tooling and our learnings into a repo called Ocean Protocol/Dori, D-O-R-I. So you can see how we did it. There's a lot of interesting scripts that help you deploy these things, set roles and administration functions inside of our network, and that probably also translates to other networks. Last but not least, what we figured, and that's a tough one, always upgradability in smart contracts, right? Because you deploy it kind of sticks there, and there's a lot of, if you want to change something, it will affect a lot of users and wallets and things like that. So you need to proxy these things, and you need to make sure that, well, if you change the logic, you don't change the memory layout that's currently existing in your smart contracts, because you have to make things backward compatible. If you start fiddling with the memory layout inside of your smart contracts, you're gonna hit problems for sure. So our logical separation is storage and logic separate proxies for that. So that's kind of the practical things. Some takeaways we had. Token engineering, however you call it, you need to have a solid production plan in order to put this in place. Think about upgrades and governance up front, not too hard, but do follow some guidelines and have a look in our Dori repo where we'll be adding guidelines as well. And yeah, you'll be facing a lot of bespoke tool change, but your DevOps hopefully know how to work their way around this. Yeah, that's kind of it for my talk. Do we do questions or?
We might have one question. Any question on Dimi's talk? Yes. Do we have a microphone? Yeah.
Yes, can you tell us some major clients that are using your Ocean protocol?
Using or engaging, because currently I don't think we have production users yet, as we launched our public network 2 months ago. But we're engaging with the Singapore government. We have in Singapore some auto registry set up. We are also working with the MOBI consortium. We have a few dedicated projects with some automotive companies. We have a company in Munich, Connected Life, looking at the healthcare capabilities of Ocean Protocol. They're looking at chronic diseases like Parkinson. I'm not responsible for the business pipeline, but one of my colleagues actually knows a little bit more and is hiding. So Don, show yourself. There is Don. So definitely have a chat with Don. He knows a bit more about the funnel.
Okay. Thank you, Dimi, for this talk. Thanks a lot.
My pleasure.
Thanks. Okay, and now we are wrapping up the morning with talking about practical challenges in blockchain projects with some comments from Ben Lifshitz. Great to have you here, Ben. Ben is chief scientist at Brave Software, author of over 100 academic papers and dozens of patents. And you say this talk is a call for faster maturation in this space. And you will introduce some pitfalls in token creation and solutions like a future library of reusable design patterns for token economics. So thank you for being here, Ben. Looking forward.
Thanks very much. It's great to be here. It's a wonderful selection of topics so far. And my hope is that this talk will be sort of gently transitioning us into the rest of the afternoons, into some of the topics that you'll see in the workshops, things of that sort. But what I'll talk about today tries to bring a bit of a software engineering perspective to this field, the emerging field of token engineering. So I wanted first and foremost to draw an analogy between what we've seen in smart contracts, which is an area that has been around for, well, a few years, right? And so there have been some wonderful things emerging from there. And certainly we've seen some pitfalls as well. So among those, we've seen some fairly major disasters, and I'll spend a few minutes talking about them just because there are some interesting lessons hiding for us there. So some of the takeaways here is that, well, it really helps to test and verify things before bad outcomes, before disasters are allowed to take place. But so let's get to that one step at a time. So here's a couple of things that motivate a lot of the work that's been happening on trying to improve the quality of smart contracts, trying to validate them, trying to verify them, so on and so forth. So the first one goes back to 2016, and I'm sure most of you have heard about this in some way, shape, or form. So this is the infamous DAO hack, June 17, 2016, and basically that hack led to 3.6 million ETH being stolen, which was about $70 billion at the time, and actually a fork of the Ethereum blockchain, and a lot of soul searching on the part of the community that was involved in the DAO, and those obviously were not involved in this as well. So this is the first one. 2016, mid-year. The second one is the Parity Wallet bug, 2017, about a year later. And so basically it's got to do with some issues with the Parity multi-sig library. And, there was, again, quite a lot of soul searching. There was a proposal that was put forward to try to rescue those frozen wallets, and nothing really has come out of that. So there's quite a lot of money sitting there on the Ethereum blockchain that's still locked. And so that's the second one. Well, so what's happened after that? A few things happened. So we've seen an emergence of what I would call a cottage industry when it comes to smart contract validation, verification, checking, auditing, and so on and so forth. And so last year, 2 years ago, there were many, many consulting companies being formed here, people reading contracts, providing audit reports, tools being created, academic projects as well, and I have a couple of those shown on this slide, something called Scylla and Zeus and many, many others also. And so arguably we are somewhat more mature than we were back in 2016 as a community when it comes to creating smart contracts that are not as easily exploited as they were before. Okay, well, so far, so good. I think that's not such a bad takeaway. That's not such a bad place to be as a result of some of these disasters. I think we've learned as a community, we've figured out some of the ways and some of the strategies to do better and to kind of proceed forward. Okay. Now, as part of what I do, I also run a reading group when it comes to, which focuses on white papers. So this is something that I run out of UCL, which is a university in London. And so what we do is we spend usually 90 minutes at any given time looking at the white paper and generally criticizing the hell out of pretty much every white paper that we've looked at. So it's a bit of a takedown exercise. And actually, this is not uncommon in a wider community as well. So this is a specific project here, Bancor. This goes back to 2017, so a couple years ago. And this is an example of, somebody, in this case, somebody who is, exceptionally well-informed, Emin Good-Sir, who is a professor at Cornell. Basically taking this project apart, if you will, and looking at the different aspects and highlighting a whole bunch of flaws of this project. And so this is kind of how it starts. This is, a snapshot of his blog post. You can see the URL at the bottom here as well. But more specifically, though, if we dig in, we'll see that he highlights a whole bunch of specific issues, about, I think, 25 or 30 specific issues that have to do with many, many aspects of this project. Let me just highlight a couple of these things. So he definitely focuses on issues that have to do with specific implementation bugs in smart contracts. So at the end of that list, you'll see that he highlights a couple of re-entrancy bugs, which is definitely a problem, definitely an issue. But it's not only that, right? So he criticizes their on-chain versus off-chain design. He criticizes the need for decentralization. He criticizes, various issues that have to do with their underlying token economics. And so specifically, for example, he's saying here that, the project is effectively executing a central bank strategy for automatically setting a peg for new coins. And then effectively what he claims is that, Bancor as an organization is able to set pricing independently of what the market would otherwise suggest. So, well, what kind of lessons do we learn from here? One of the lessons here is that when it comes to contracts, smart contracts, and analysis of those, we've, as a community, developed some tools. When it comes to figuring out what's wrong with token economics and issues related to that, or for that matter, decentralization, we can sort of mostly reason about that after the fact, which is sort of a problem, isn't it? Okay. More examples. So this is something from Vitalik's blog back in 2017 as well. So he's looking at a specific project and its fundraising strategy. And of course, fundraising strategies, ICOs and whatnot, have attracted a great deal of attention, but that's kind of the beginning of token economics. It's not the end of it, is it? But in this specific case for NadeSafe, basically they used two independent cryptocurrencies to fundraise, and the rate between those two things wasn't pegged at the time, and that led to problems where essentially some of these participants who converted their BTC to MSC, which is the other coin here, and participated in the sale, basically they were effectively at the end of this process stuck with a 30% loss. And so the lesson here that Vitalik is offering is that running a sale, a token sale in this case, that accepts multiple currencies at a fixed exchange rate is dangerous and bad. And so don't do it. So what is this? What would we call such a thing? Well, if we focus, if we go back to the vast literature that we have on software engineering, that's what's called an anti-pattern. It's the kind of thing you don't do unless you want, trouble to follow. And so as a community, at least when it comes to fundraising, we've seen some anti-patterns being offered, being discussed, and this is kind of nice to have. I think it's a certain sign of maturity. Something else to highlight as well, and maybe this is not as obvious to some of you, but here's the thing, right? So despite hundreds and hundreds of tokens, altcoins, and ICOs that we've gone through as a community, well, many of these projects haven't done so well. And to just kind of understand that point, go to this website, deadcoins.com, and you'll see hundreds of these projects, some of which were direct scams, and others, well, just didn't fare so well. They're trying to behave honestly in many of those cases, but didn't really work out for them. And so there are lots of lessons to be learned there also. Here's another thing. So projects often don't think about the long-term risk of token creation, because again, token creation is not all fun and games. It's not always an upside. Why? Because of this point here in the middle, which is the market will psychologically attach the value of your network to the value of the token, regardless of whether these two should be interlinked. And so if your token is not designed according to robust economic models and realistic projections, you risk devaluing your entire network in the eyes of the market, even if your network is otherwise successful. So this is another warning sign that people should heed here as well. Okay, so I mostly talked about projects from like 2017 or so, like what about here and now? So I want to go through this mini case study, if you will, of a project that's like super recent, right? I think, many of you know probably a fair bit about it. So it was in the news in the last several months. This is called Algorand, which is a project that I don't really have any association with. I'm actually quite fond of the technology in many ways, but let's kind of look at it and see what happens. All right, so in fact, yeah, when it comes to technology, there is quite a lot of innovation. So this is a project that came out of MIT. There was a famous founder, Turing Award winner. There was a lot of positive press about this, a great team, and so on and so forth. So lots of excitement about this. So in addition to fundraising through traditional means, these guys decided to do a token sale also. And, or rather, they decided to do something that is a little different. So they decided to go through this auction process. And so every month they decided to run an auction for these tokens called algos. And this kind of specifies, this is from their website, basically specifies what happens to the kind of pricing strategy. And there was an interesting trick there as well, which is to say they promised an up to 90% return in case of a drop in price. And so basically it seemed like a really safe investment vehicle as a result. And well, lo and behold, what happened is this. Back in mid-June 2019, this year, just a little while back, Algorand managed to, as a result of this first ever Algorand auction, raise quite a lot of money on a really humongous valuation. And this article goes on to talk about the project, MIT, all of those positive connections, all is good and well. And so guess what happened after that? And so after that, within, days really, right, weeks, a few short weeks, the price plummets by a significant amount, by over 60%. And, as they say, despite the Turing Award winner backing this project and so on and so forth. Okay, now the plot thickens. So basically, there were quite a number of angry investors who bought into the project, and then they saw their effectively money disappear very, very quickly again. Right, so basically within days of this, and you can read about this. There are really some fun stories if you look at this Medium post there. So some of these investors from China were really quite upset, and you can read about what they're saying. When is alga going to zero, and all that kind of stuff. All right, so without getting too much into this, within again a very short period of time, August 1st, 2019, this month. Algorand makes a somewhat unexpected move, and it says that, well, remember that 90% refund we promised to you a year from the auction date. If you want to get out and get 85% back, you can do so within the month of August. And this is obviously to please these investors who are, basically yelling at them on Reddit and places and Twitter and places like that. And so effectively this is what happened. Now, I don't think the process is over yet because basically the window will close on August 23rd. So I think maybe they'll announce some of the results very soon. I think maybe possibly within days. But this is an example of something they clearly didn't plan for, did they, right? Otherwise they probably wouldn't have done this in the first place. And so this is what this is kind of describing this alternative. So you can get as an alternative to this 90% back that was previously offered or was previously kind of advertised as part of the auction process. You can now get 85% back rather within the month of August. Now, it makes the fate of the project as a whole, I would argue, somewhat unclear. Because frankly, I don't know whether they'll have the next auction. I don't know what will happen to the token. I don't know what will happen to the project. If you look at the trajectory of the token, this is what it looks like. You see this kind of significant jump up front back in June, and then the price goes down quite a bit. Now it looks stable so far, but of course there is no telling what might happen if they continue with the auction process, or for that matter, if they stop the auction process, because, well, frankly, that's what they advertised in the beginning, right? Well, so lots of questions to be asked here, and I don't think there are too many simple answers. And so what kind of lessons do we learn here? I mean, I think there are a couple of things to ask for. One is, are there any patterns or potential anti-patterns, like what to do and what not to do, or primitives that we can find in this space? Not only when it has to do with fundraising, but token engineering as a whole. Secondly, what kind of tools should be brought to bear? Just like as we saw in the case of smart contracts, like what tools should we use here? That's the second question. When it comes to primitives, I'm going to go through this fast because we've already heard about both of these, by the way. I only wanted to mention two, which is the TCRs, token curated registries, and bonding curves, curve bonding. So that was the other one. We've seen examples of that in the morning. I don't want to spend any extra time on that, but at least there is a glimpse of some of these design patterns emerging, and I think that's a great thing. Some examples of these things being used, some of them come from the Ocean protocol, as we heard from the previous presenter, and other from projects like EdChain and Messari and so on and so forth. And this is actually a quote from somebody else from the Ocean protocol, basically calling for a discipline of token engineering and comparing it to other kind of engineering disciplines like, I don't know, civil engineering, software engineering, and so on and so forth. And this is what in part inspired my focus on patterns and anti-patterns that are things that we do see in software engineering, and of course we use them to our advantage as well. So to conclude, I wanted to talk about the project, and I don't have any connection to this project. This is called Incentivi, and I think this provides some good motivation for the kinds of things we'll see as part of the workshop later in the afternoon on CAD and things of that sort, tooling of that kind. But this is a project from 2018. They tried to build a company around this. I'm not too sure whether the company is still around, is still successful, but I think it, again, provides some good lessons in terms of connecting, actually, smart contracts to token engineering. And you'll see how this works in just a second. So essentially the focus here on building simulation and creating agents and basically defining a state space and figuring out reward function and basically figuring out how to optimize that sort of thing. And so I think that's best explained with an example. This is roughly, you know, this is what this looks like. Essentially when it comes to, I mean, this is their slogan, right? So this is effectively a form of A/B testing, if you will, for smart contracts. But again, the focus here is not really as much on the correctness of contracts. It's really on focusing. It's really focusing on economic incentives here. So how does this work? So this is one of their demos. So this is a specific project they've essentially simulated, and there are some assumptions that you can specify, and based on that, you'll basically be able to run these simulations and look at the outcomes. And this is kind of what this environment gives you. And so here are a couple of takeaways to highlight. So they say that given if there's uneven token distribution, it can lead to pump and dump schemes being executed. And so basically the advice here, or the suggestion here is quite clear, which is distribute your tokens more evenly. Okay, so far so good. And so the second takeaway here is that an insurance product where users vote on what claims should be approved needs to increase its bond price so that voters pay for verifying a false claim. And essentially that's kind of another lesson here that comes out of their modeling that consider the case of bribes that come from fraudsters, right? And so this is actually pretty nice. Of course, if you understand the context of this project, if you know what these things mean, and if you can also execute based on this kind of advice, I think these are very, very practical suggestions that you can put into practice before you actually proceed to deploy this project, right? You don't want to find this out once, at a point when it's too late. And here's something else. So this is an analysis of a specific project called the Nexus Mutual System, right? So incentive simulation report. And so this is like a, I don't know, 17 or something like that page report. And this is actually very much reminiscent, at least to me, of basically security audit, right? So when you build a system, it could be as simple as a set of contracts, could be a complex system that's written in C++ for all I care. You invite auditors to look at your system to apply either manual scrutiny or some sort of tools to your code. And typically what results is an audit report. And this is very much reminiscent of that, but this obviously focuses on the token economics that underlies this. And again, this uses tools of simulation to try to predict some of the less than desirable outcomes before these kinds of outcomes are allowed to happen. And I think this is pretty much where I'd like to stop. I'm happy to take one or two questions, but hopefully this motivates some of the things that you'll see late in the afternoon, and hopefully this forms a connection between what we see in both software engineering, but also more specifically smart contracts to the discipline of token economics. Thank you.
Great, thank you. Thank you, Ben. Unfortunately, we are running a bit late in time, but feel free to contact Ben. As mentioned, we have the page teg.io/program. You'll find his talk here and also a link to his speaker information and I think your Twitter account. So just reach out and we will also be happy to share the slides. I think there has been a lot of content on it which might be interesting to you. Sign up for your newsletter and we will make sure that you will be informed once we are ready to share it. Thanks, Ben. So let's move on with token engineering in practice. So the following talks are trying to give you a picture of how simulation can work and look like. And we start this couple of talks with Michael Sargam. Welcome here. Come on stage. Michael is the founder and CEO of Block Science, a company that focuses on design and analysis of complex networks. And I can hardly think of any blockchain project in our space that is not in some way relying on your advice. And you have created the CAD open source modeling framework and running the beta testing user group, and you will also run the workshop in the afternoon. But now we will listen to your talk about token engineering in practice. Give him a round of applause. Okay.
How about now? There we go. Okay, so we're going to talk about token engineering in practice. I'm going to basically start by reiterating a little bit of what we've talked about before, which is that these are in fact complex systems, and we're going to work our way down from the concept of systems. Their sort of general system theory helps us understand the way that things work in the world, regardless of what the sort of medium is. We're moving into complex systems because these things are sort of greater than the sum of their parts, and in fact, social systems are complex, economic systems are a subset of social systems, and now we're talking about these blockchain-enabled economic systems, which, when sort of modeled formally, tend to be dynamic, networked, adaptive, multi-scale systems, and with this sort of understanding, we can think about what kinds of tools and methods and approaches might apply. For time, I won't sort of go into the details of how to map Bitcoin into this sort of set of abstract sort of properties, but there'll be a paper about that at some point by one of the actual speakers who's later this afternoon, Chris Peruk. We want to talk about the relationship between economic systems and token systems, token economies. For starters, the economic systems are the things that we really care about, right? We might be engineering tokens, but the tokens are just sort of this now tangible economic component. It's a representation of a thing or a right, or could be a good, could be a service, it could be functionally a currency, but at the end of the day, we actually engineer them in order to drive a certain behavior in the economic system as a whole, which is actually a level of abstraction above the software itself. And I try to make this point pretty closely because often, when I first get involved with a project, I get handed a protocol specification. And I'm like, cool, that's the plant of the system, it's the machinery, this is what someone can do, but like, what will they do, what sort of happens, what's the extra layers of incentive control embedded through the tokens? Yeah, we don't really know. Well, what are we trying to accomplish? High-level business goals. We kind of work our way down from a representation of the economic system of interest down to what elements are sort of still under our control to design, what elements are in fact sort of predetermined by the use case or the software, etc. And ultimately we want to design generally steering systems. And if people were around for Web3, I talked a lot about cybernetics and the sort of history of steering systems and what it means to design them. Here we're going to move on and stick to the sort of engineering aspects. So engineering's sort of critical bedfellow is science, and science helps us understand the things that we observe, to understand things that might happen in the future, and we really think about this in terms of three kinds of science. We have analytical science, which is basically mathematics, but it's applied mathematics to systems we care about. We represent those systems, and in a sense, when you write down a mathematical model of a system, you're saying, here's an analogy, here's a story, but that story actually tells you something back. So unlike a sort of written language story, when you say, suppose the world works like this in mathematics, you can use sort of manipulations, theorems, proofs to say, wow, if the world worked like that, then this other thing must be true. So we sort of have formal assumptions in, formal conclusions out, but not necessarily guarantees that that's how the real world works. We can sort of power up these sort of storytelling exercises with these computational models. They're a bit like, guess you could think about them as thought experiments just supercharged. So we're still just saying, suppose the world works like this, and up to the degree those assumptions end up being true, the conclusions that you might reach from looking at those analyses might be true. But with the degree of computing power we have now, we can run really wide array of these thought experiments and actually make inferences not just about what will happen, but how sensitive the outcomes are to the assumptions that we made in the first place. And of course, we have our empirical studies, which are always critical. Backtest your models, understand how they work. But often we can't do empirical until we're further along. And so the analytical and computational are the things that help us understand that which does not exist yet, or that which we wish to instantiate. So in the engineering side of this, we have this concept of sort of design and development, of verification and validation. And while I won't sort of work all the way through this, the big picture here is that in the engineering world, where you're building composed, complex systems, you've got parts interacting with each other, experts over the subsystems, composed into wholes. You have to do this thing where you design something and you define formally its abstraction, then you have to worry about how to instantiate it. This might sound weird, but it's like blueprints for a building and then building a building. If you have to get to something that has a necessary set of different expertises, you need this engineering practice where you design at the level of abstraction, and then the components or subsystems have properties that are necessarily true, at least sort of up to whatever the sort of tolerances are in those systems, and then the systems below are then built to meet those specifications and tested against them. And so we talk about this in terms of validation and verification pretty much in every engineering class ever. We start with some system level goals, we design for them, and we work our way down to the lower level systems. So high level blueprints for your building might become sort of specific requirements for a set of stairwells, or maybe for even the plumbing or the electrical systems, etc. And then the experts in those domains have designs at their level, and that might have subsystems, and eventually somewhere along the line, someone's laying bricks and laying pipes, etc. And this is how we actually realize large-scale systems with heterogeneous elements. And in the case of crypto systems, we have this really important problem. We don't actually know what's going to happen. So there's this emergence chasm in my drawing, which basically says, well, We actually are designing for the emergent behavior of a bunch of actors we don't actually control. It's not quite the same as designing a building after all. It's actually a little closer to things like our power grids and our road systems. If you think about a road system, you actually are only laying down what people can do. The traffic patterns that emerge are not under your control. And in fact, you may very well build a perfectly reasonable intersection that has tons of accidents in it. And you might not even know why, but then you probably should redesign, or you might need an anti-pattern like we discussed in the previous talk to say, wait, like why did there happen to be lots of accidents here? There was nothing wrong with the road from a sort of first principles of roads perspective. And so we actually bring in this sort of idea of the infrastructure, the engineered thing, only sort of allowing people to do things, and then the actual implemented thing is including the emergent behavior over the thing constructed. And that's really tricky, but we're going to talk a little bit about how we go about dealing with it. And it starts with working through processes like saying, what do I really want to accomplish at a high level? And even though I can't strictly guarantee it, I want to keep in mind, and I want to work backwards from it before I start constructing something that I hope to achieve those properties. So from a simulation testing perspective, we break the world up into two pretty important elements. One is how the world works, and the other is what people do about it. And we can approach this from the whole sort of life cycle of the design process, where early on we might have these stochastic differential equations as the state update of the system. Some noisy processes might be out of our control, but at least up to a degree, if you do something, the consequence of those actions is reasonably deterministic. It's just that the behavior is not. And so you need population level agent models or agent-based models. And sort of as you move to the right on this, you're basically diving into finer and finer detail. And after you are building software, it generally makes sense to run backtests even between your models and your designs and the software you've implemented itself. So if you said in my design and in my, say, Python code, when the following behaviors are exhibited, the system does this. If I go to my chain code and I run agents that are emulated and I don't get the same behaviors, well then either my model wasn't very good or my code is wrong. And I can sort of begin to say, let's find this and fix this before we go into a production system. And in fact, after this, we can use the same modeling paradigms to analyze or understand the observed behavior on a live net. In general, we work with this sort of abstracted version of a decision problem. Pretty simply put, this diamond is people making decisions outside of our control. It can be many people, it can be many different kinds of people, it can be a whole mess of complicated things, but what matters is that their decisions are based on their private signals, their private beliefs, and we don't know what they are. So we don't want to say that they're rational in the sense that they behave according to some financial objective. We can actually say that they're rational in the sense that they optimize some private objective, which in the bottom, the equations, I won't try to go through it, but it's essentially a description of an optimal controller against some objective, even if we don't know it. So even the least rational seeming people could be argued as rational with respect to some objective we don't know. We might just not agree with their objective function. Conditioned on the actions that they take, we see state updates which are functionally deterministic. We might have an update to state that includes some states that we can't observe, and in fact those states that we can observe influence the future. And this is essentially a description of a differential equation because it can iterate over time, and because we don't control the players, maybe it's better thought of as a differential game. I'm going to talk a little bit about how I map systems out from an example on continuous organization. So some of you might have read the blog articles by Thibaut on the continuous organizations and bonding curves, and I'm going to use this example to show a little bit like what we might do to construct an abstraction for one of these systems. So here we have more than just the smart contracts for the continuous organizations. We also have a representation of a secondary market of the type of a Uniswap style liquidity pool on the upper right, and we have a sort of model of the continuous organization's operations itself on the left. And what we're doing here is sort of seeing how these subsystems interrelate with each other and the appearance of some of the decision processes. So we might have traders that are herders or signal traders, or maybe they're efficient markets hypothesis traders, or some population of actors in these pink bubbles on the right is making actions in response to observations. They are acting on on these mechanisms. And over here we have some purple things that represent the actual behavior of the operators of the Sea Org itself. Interesting thing about this is that it's essentially a stock and flow diagram. Anyone who's familiar with the sort of business dynamics, system dynamics literature would see this as very similar, with the exception that I removed all the faucets and replaced them with diamonds. And the reason that they're diamonds is because these systems don't change just because. They change because someone acts on them. And in fact, the biggest challenge in these systems is often understanding how people will act and what the implications of that will be. But it doesn't start there. It starts with the shape of the system, because this is a relatively high dimensional system, but it has a lower dimensional embedding or a configuration space, something that we deal with a lot in robotics. It basically means that, yeah, there's lots of variables, but not all possible combinations of those variables can even happen. And so the shape of that space has a lot to do with what actually can or does happen. And in order to get into that, we move towards building simulations, but to build simulations, we actually need to go beyond the view of a sort of system dynamics model and more something that looks like that differential game. And so we kind of created this, I'll say, sort of scaffolding that helps us write code. That code has sort of the classical control theoretic structure where you have sort of the U layer, the inputs, and they can be random processes, they can be behavioral processes, they can be algorithmic policies. That's the top row. And we've used yellow for the things that are modeled as random processes, pink for the things that are, these are like uncontrolled controllers in the controls literature. Just means that it's behavior, someone else decides the input-output function, and we deal with it. And maybe they're optimizing themselves, maybe they're optimizing against us. We can try lots of things, but we definitely know that we don't get to pick this. And then finally, the green boxes are the things that the designers are actually choosing. As a consequence of the top row, we have state update functions. This is basically just saying, cool, given all that stuff we didn't know, once we know that, we know exactly what happens next. And then we update our state variables, maybe compute some metrics, KPIs, or other measurables that we care about, and the whole thing starts over. In an implementation sense, this is literally a data pipeline looped on itself. Its input and output data sets are the same type. And so this is sort of the magic of how we got CAD up and running so fast, was because the lead engineer on the project is a very talented data engineer, Joshua Jodesty, and he basically figured out how to leverage the existing data science infrastructure to build these kinds of differential games as basically function compositions in data science pipelines. So we get results from things like Monte Carlo experiments. This is just like one plot. It's not going to be realistic to go into a ton of results, and this is an ongoing project. So what I really want to show is that we can start to get things happening in this sort of in expectation kind of way. So it's five experiments, same system structure, random variables on the yellow stochastic processes that are actually martingale style. They're diverging. So these things wouldn't actually converge around a particular outcome if the system itself weren't essentially processing that information and sort of shaping it. And so we're getting a system here where, under the assumptions that we made, which were, statistical adoption curves look like S-curves, certain assumptions, the faster the adoption, the higher this might be, the deeper it is, the higher this might be. But what's interesting here is really just that the results actually kind of clump up a bit, despite the fact that there's a lot of randomness being injected on the front end. And I sort of encourage people to sort of play around with the software in the future, try things out. But what really matters here is that you need the representation of the whole system that you care about with a state space model, get it actually mapped into something that looks like a system that evolves over time, and then you can start to run simulations using a simulation framework. It doesn't really matter what simulation framework you use. The problem is that what you care about is probably stuff in this bottom row. And those things are rarely totally defined by information that lives on chain. And so these unobservable states become functionally part of the abstraction. They're estimated, and they sort of help you build out an understanding about the relation between the concepts that you care about and the things you can actually tune. So in that sense, we're going to move on a bit. Well, how do we go about approaching this? Well, we have our sort of pre-launch design of the ecosystem. We want something that will sort of enable and empower an ecosystem to behave as intended. You launch it, and then it just like totally doesn't work like that because it never works how you think it's going to work. And you have to have a means of them feeding data collected on the live system back into these models to help understand what they're really, the state they're in. And actually in the robotics literature, this is called system identification. If you have a proper differential representation of the sort of way the system evolves, even when there's a bunch of stuff that you don't know, you can actually sort of learn the stuff you don't know. It's a gray box modeling. You have a white box, this part works like this, a black box, someone doing something we don't understand, and some data about the whole system. It's sort of a sort of more advanced version of autoregression involving sort of structural dynamics under the hood. In practice with CAD-CAD, what we're doing is moving towards decision support tools for live networks as we work with our clients and help them build models during design. We are actually driving towards integrating data and learning how these systems are actually behaving, because at the end of the day, again, we know that we can't predict them. The designs are not predictions, they're not guarantees, they're simply like any other system, something that has to be launched and taken care of. And in a world where we want maybe autonomous groups of individuals to take care of systems, we need to provide visibility. And that visibility comes from this type of workflow, and I'm pretty excited about it. My friend Jeff recently wrote an article called Computer-Aided Governance, which is sort of exploring this idea further. And here's what it actually ends up looking like from an engineer's perspective. We do quite a bit of effort to understand the economic system, these economic conservation equations, like the first drawing we saw. We do sort of user role taxonomies to help understand what kind of actors we can reasonably expect, behavioral models, statistical models, etc. And then, of course, we have to know what the protocols and mechanisms in the system that we're working on are, from which we can synthesize these differential specifications, like the one that I showed you before, leads to computational models during design, and eventually system identification during LiveNet. And ultimately, this is all just a sort of piloting system that helps the humans design, implement, and govern these complex networks. And anyone who's really interested in how to do this, I think we should talk offline, but we're working pretty hard to put the best practices from what is essentially OR and industrial automation into play in situations where there is actually very rich data, but there is definitely stuff out of our control that isn't observable that we care about. And in the end, it's all about achieving some goals that are determined by the project and not necessarily low-level things that can be defined clearly over the low-level data. And so sort of finally, this is a slide from my cybernetics talk where I talk a little bit about the importance of this governance feedback loop. So we build these automated systems that have these interaction patterns. They represent what one can do in these systems, but then we build in these incentive systems that kind of provide automated feedback, and they drive us towards some goals. But if those goals start to come out of sync with your community or your population of this network, then there's a feedback loop through governance. And one of the things that we find is that this type of model sounds great until you realize that participation isn't good enough. Informed participation is required. It's very common knowledge even in centralized systems that the intuitive thing to do is very often the totally wrong thing to do. If you've ever played the beer game, which is common in consulting, you end up creating this thing called a bullwhip effect just by making the really so-called obvious or intuitive decision, and you get a very non-optimal outcome. And the more spatial and temporal feedback loops in a system, the more likely that doing the thing that seems obviously right isn't. And the way that we avoid that with communities governed by themselves is to make sure that they have real visibility into the most likely consequences of their decisions. And so while this might seem like a lot, I am actually saying that token engineering is engineering. Engineering is full life cycle, and full life cycle means making sure that you keep that system healthy once it's deployed. So I'm going to wrap up with this demo. So we're working on getting cloud-hosted CAD-CAD models, and we're not on the internet. Can we make it so that we're on the internet? That makes me really sad. Okay, so I'm going to do a workshop later, but the point was we actually started working on our integrations, cloud hosting, and since we have these models of the sort of data science type, we are working on getting them into places where people can integrate their their models into a cloud-hosted environment and do decision support tools. The existing model here is just a demo, but it is in fact live on the internet and available for at least with a password, because we don't want to blow up the server, to try it out and play with a three-sided market model, which we're going to actually play with in the workshop at 3 o'clock. So I guess I'll show it there.
Yes, please show it there. And to remind you, at 3 o'clock, there is a workshop starting in the workshop area. The room is called Robston. It's just behind the catering area where you got your food in the lunch break. You will find it pretty easily. Just follow the red lines on the floor. Robston, it's starting at 3, and there you can take a look and also play around yourself, I guess, with CatCat. And with this, thank you so much, Michael, for this talk. We have another talk before we have a short break, and this talk is about a visual approach to characterize crypto assets. Welcome Wasim Al-Sindi on stage. So you are active in various areas as a researcher in physical science, as a curator of art events, and today, currently you are developing a new journal and conference series for cryptocurrency and blockchain technology research for the MIT Media Lab's Digital Currency Initiative. Looking forward to your talk. Thank you for being here.
Thanks, Angela. Hi, everybody. My name is Wasim, and I'm going to be that guy that's turned up with way too many slides, so I would recommend either taking a picture of this or scanning the code or committing to memory some or more of the URLs just in case you do happen to be interested later. So I'm going to try and skip as much of the preamble and the fluff that I usually lay out to give some context, and we'll, having had these really nice primers through the day from people like Sherman and Zargham, I think we can accelerate our ascent into multi-dimensional token space. All right. So first a plug. So I recently started working at the MIT Media Lab Digital Currency Initiative, and we are starting a journal and conference series, as Angela said. And so we're kicking off with a field building summit on the 5th and 6th of October at the Media Lab. Now I appreciate this is quite close to DevCon, but if you feel like doubling up and coming over to Boston on the way to Osaka, then we'd be very happy to have you. You can find some more information about that at the website cryptoeconomic.systems, which is the name of the journal, and you'll see more information about our conference, which will launch with a call for papers very soon. Okay. So, I don't think I need to motivate this systems level perspective, having had the, Zargham is a tough act to follow, and so he's taken us out to the nth level of abstraction, and so I just wanted to try and fill in some of the gaps. So if you think of, a network or any kind of system of knowledge as a stack of layers, then, this helps us to engage in and take advantage of some of the fruits of building layers. Things like differential discretization, which means that we can be very specific on one particular layer, we can abstract out to be more general on another layer, we can be objective in one place, we can be less objective in another. And this idea of the interplay between objectivity and subjectivity, which Zargham was hinting at, is something that I'm going to draw on a lot more here. And so I had this nice idea from Max Tegmark, which is that, at the very most high order complex levels of this metastack, things are very subjective. It's very hard for us to, pull one lever, change one variable, and have a predictable deterministic outcome. At the bottom, where we look at, say, quantum mechanics, photons, electrons, and what have you, and even before that, before the discretization of knowledge in natural philosophy, things were inherently subjective. And so what you have is this, what I call a subjectivity sandwich, where we have at the very base of this ontological, as closest to the ontological bedrock we can get, things are pretty subjective and messy. Planck time, uncertainty principles, and so on. At the very highest levels, these systems are so complex and multidimensional that we also can't be necessarily that objective. So the middle zone is kind of where we can be objective, and we have to, in a sense, choose our poison as we deviate from those central positions. Okay, so I'm not going to spend too long on all of this, but I think after a day of token engineering, we can appreciate that tokens, cryptoeconomic primitives, coins, whatever you want to call these things, they have some of the properties and characteristics of things that we've seen before. They look like they might be commodities. Some people say they're monies. Some people say they're unregistered securities. I would never say that because I'm not a lawyer and I don't want to get sued. So please bear that in mind. So we have things that are bearer assets, where ownership and custody are more nuanced and complex than they have been in the past. And we have these elements of culture, the memes and so on, that I'm sure you've seen around the DAppCon in East Berlin. So, loads of people in the past have spoken about what they think makes a good money, what the nature of money may be connected to. So I don't want to kind of teach grandmothers to suck eggs. I'm sure you've heard about Aristotle and Jevons and the store of value and all this kind of stuff. But yeah, suffice it to say that people have spent a long time thinking about what helps goods become more useful as monies, more money-like, or to have more moneyness. You already know this, so taking a systems and a network perspective, you have you could think of a P2P network as a kind of a rhizome or a distributed resource network, and you can think of the tokens as the fruits that arise from those. So I'm sure you're all familiar with Metcalfe's law, or if you're not, you're probably familiar with Moore's law, the idea that networks kind of assume value based on how widely dispersed they are, how many agents speak the same language, use the same protocol to communicate. And so I think Paul Gogarty actually gave a talk, Nick Gogarty actually gave a talk at a token engineering event a while ago. I think he might well have done. And I really recommend the video from that. And so he talks about this idea of network valuation theory, where you look at how redeemable a particular good is, the network utility, how useful that network is, how widely dispersed it is, and the speculative utility, and then you can kind of squash these into the notion of a price. In the moment, the price is determined. And what I like is you can look at this through a kind of a temporal lens. So if you think of all monies as protocols and all monies as protocol networks, then you can start to compare these things side by side. And so everyone knows the price of Bitcoin or Ethereum yesterday. In the moment today, it's an intersubjective fact that depends on many different variables which are fluctuating and not constant. And in the future, it's anyone's guess. So the joke I usually make here is, if you know the price of Ethereum in a week's time, please come see me afterwards. I would like to learn your secrets. So objective and subjective, I want to keep coming back to this, because you can make objective metrics, you can make objective conceptual frameworks, and you can make subjective ones. And there's pros and cons on both sides. So at the bedrock, this technique of token space involves something called taxonomies. And taxonomies are basically, in the most general sense, ways of collating, ordering, systematizing, and understanding domain knowledge. Can be anything. Now, this obviously started off with the natural world, with the Linnaeus in Sweden in the 18th century, and people started to use this kind of, it's called like a branching recursive hierarchy that they call binomial nomenclature, to try and discretize, to understand the similarities and differences between living things. So, does an animal suckle its young? Does it have body hair? How many legs does it have? These things we would call dimensions, the number of legs. Or how many legs does a creature have, and 2, 4, 6, and 8 would be the characteristics within taxonomy, let's say. So the why, we are here. So we find ourselves in this situation where we don't really know what these things are, and the interface between these networks and the real world it's not a very elegant and well-functioning one at the moment. So we have all of these kind of legal, regulatory compliance snafus going on all over the world, people engaging in regulatory arbitrage because rules are seemingly different from place to place. And so the objective with doing some of this work was to try and find a more legible grammar, like a visual concept that might help to bridge some of the semantic issues that we have in defining some of these terms. Okay, water break. So I'm sure some of you remember back to the good old days of 2008 when William Hinman made some personal comments one evening saying that to him, the token sale of Ethereum in 2014-15 looked like an investment agreement, looked like a security offering, but that by the time that he was speaking, the network and the asset that is propagated atop it had become sufficiently decentralized that this was no longer the case. Now, this is all very well and good and sounds nice, and we're very happy about that, but what do those words actually mean? So it seems like at some point, this thing has changed from A to B. but we don't know where it changed. We don't necessarily know what the reasoning is for why this thing has been kind of recategorized or reclassified. And so we don't have much of a kind of deeper explanation into what those comments mean and what we can learn from that in terms of building new systems and changing existing ones. So here's a graph. Everyone likes number go up. Unfortunately, this is the number of SEC enforcement actions, and this number is continuing to go to the moon at the moment. So it would be really helpful if we had some kind of shared conceptual understanding that we can take a lot of the complex information, subjective and objective, that comes from these networks and from these assets, and squash it down into something simpler. And so, side note on historical taxonomies. So this is some Linnaean work, Homo erectus and Camellia sinensis and so on. So I'm a chemistry nerd, card carrying, not apologetic, sorry, not sorry. And so the periodic table, which probably everyone's seen, probably above a blackboard in the class that you took when you were 16, this thing represents sort of a mature, systematic approach to understanding the similarities and differences between domain objects. These domain objects happen to be elements. And so atoms have different electrons. There's different numbers of electrons in the outer shells. There's a different combination of protons and electrons in the inner shells. These things have different reactivities. But to squash all this information into such an elegant diagram, it didn't start off like that. Here's a quick side note with my old professor, Martin Polyakov, who, as you can probably see, is one of the biggest connoisseurs of periodic tables in the world. Those are all his periodic table ties. That's the tiniest periodic table in the world that is on one of his distinctive hairs. And that's him almost getting decapitated by some guy. So, the periodic table didn't start off like that. It started off, in the days of occultism, in the days of alchemy, in the days of naive empiricism, mixing niter and saltpeter with fire, of phlogiston, before even oxygen was verifiably discovered, when there was just an atomic theory that hadn't been verified. So what happened is that as, various empirical validations of concepts and of predictions were made, axiomatic understanding of the underlying principles which give rise to these objects and the complexity that they exhibit is how we push our domain understanding forwards. And I've got bad news for you. I think we're here with cryptocurrency. Like, we are really early in this thing. So sorry about that. So just to make this point, that we, just like in Zargham's talk, he had these kind of double loop feedback systems. I think that's very similar to what I'm trying to say here, is that you've got axiomatic understanding, conceptual wisdom, and empirical verification, and these things are in like a constant feedback loop. And so we need more of all that, please. Okay, so I won't talk too much about how the sausage is made, except to say that this is an amazing paper by Nickerson, where they lay out a generalized framework on how to build a taxonomy, and you can apply it to anything. So I didn't do that much special work to build my taxonomies, and in the paper, which is linked towards the end, there's basically a generalizable framework for all of you to build asset and token taxonomies as well, and I very much welcome that, because I don't think I know everything. Some of this is subjective, so it's informed by my biases and my opinions, so I'd like to see plenty more data points and really compare and contrast approaches. So, one thing that's really important, because people like to use the word taxonomy, but I don't know if they use it necessarily in a correct sense. You're basically looking for kind of the optimum output from this iterative process of refining and validating and understanding. So you want something that's concise. It doesn't have more information in it than it needs. It needs to be robust. If there's a new class of tokens that spring forth, they need to be assimilable into this system. It needs to be comprehensive enough to be able to explain and characterize these things. But the most important thing, in my opinion, is that it requires explanatory power. You need to learn something about the underlying objects, about the systems and the class of items that you're trying to understand. Without that, you're back in what I call the laundry list paradigm, where you do your laundry and you've got some coats and some hats and some trousers and some socks, and you sort them all out. But what did you learn? What did you learn about the ontology of a sock? You did not learn much, my friend. So explanatory power is very important. Okay, and so this is where we are now, where people have been building these very helpful systems to try and classify and categorize things, but I don't think they have much explanatory power. And things like that, they're non-mutually exclusive. Yeah, I don't have much good things to say about that. So this is probably the least good, let's say. This is apparently a taxonomy of cryptocurrencies. I don't see any data. I don't see any explanatory power. They spelled things on the axes wrong, and I don't know. Okay, so some memes about taxonomies. So here's a good one. Unfortunately, I don't think it'll be very clear on the screen. This is Don't Slip on the ICO, which is an ICO of taxonomies by Phrygian. So the information systems literature are actually kind of building on Nickerson's work most readily. So I want to see people from our community using these kinds of best practices to build meaningful taxonomies. So while I wouldn't say that the explanatory power is very strong here, you can see that they've done like a clustering of different kinds of ICOs, like say something with a no inflation and a fixed cap and a limited supply and no pre-sale, versus something that's got no cap and it's like several rounds of pre-sale and so on. So they're doing this kind of naive sorting, categorization, but I would say it's of limited explanatory power. So yeah, descriptivism isn't good enough in my opinion. Just being able to describe and categorize the objects is not, it doesn't cut it. We need explanatory power. We need to understand what these things are. So with that in mind, and let me leave these things to do with monies, securities, and commodities fresh in your mind, I'll present to you token space. So this is a three-dimensional or n-dimensional idealized construction. Each of the axes is what you would call a meta-characteristic, and the value of the meta-characteristic comes from a taxonomy. So you score these taxonomies, and then you come up with a point, a three-dimensional point in the token space. And then this gives you a visually comparable output that you can, as technical as you are or as untechnical as the person you need to show it to, there's something that is visually passable. Could be more dimensions or it could be less, but three is useful because we're three-dimensional creatures. So yeah, tables are horrible in talk, so I'll just skip through them. So this is kind of like a short list of all the different things you can put into your taxonomy. So you're looking for things that are categorical discriminants, like how was the token issued? Was it an ICO? Was it a fork? Was it an airdrop? And then I also built in what you could call index dimensions, which are, these are kind of subjective frames where you might score something between 0 and 100, depending on how well the stakeholders are aligned, or yeah, whether what distribution of the tokens are in the founding treasury and things like this. So you, by choosing these discriminants, these dimensions, you choose how subjective or objective this technique is. And so, yeah, you can't see the whole taxonomy, and to be honest, tables are horrible in talks, but this is an idea of the kinds of things you can discriminate for. And this is giving you an idea of how security-like a project is, a token project is. So if there's a masternode system that has governance rights, that makes it more security-like, because this is a bit more like investor rights. If the token gives you access to cost reductions, that makes it more security-like. If there's staking, and so on. And so what can I say? If you don't like the scores, build your own. If you don't like the discriminants, build your own. There's a paper which is linked at the bottom, which is a very thorough manuscript, which contains essentially a manual to build your own of these, to build a custom methodology. So what you're really doing here is you're collapsing many dimensions into one. So you might have 15 or 20 different parameters which you're trying to squash into one thing. And that's kind of what price does, right? Price charts are these many different subjective and objective factors which get squashed into one number, which gets printed on a chart which almost anyone can understand. So think of it in the same the goal is very much the same. You're doing this kind of dimensional reduction. So this is really important. This is probably the take home, which is you're choosing how objective and subjective this thing is. So my one, I would say it's somewhere over here. But I would say that, wouldn't I? Because I don't know what my biases are. So this thing is, you have to own the subjectivity here. And the reason for that is if you don't include subjective metrics in it, then you're going to fall prey to Goodhart's law. And very succinctly put, Goodhart's law is basically that which can be measured becomes an optimization target and will be manipulated for. So if you say number of nodes means sufficiently decentralized, means that we don't go to jail, then you can just call up AWS and ask for 10,000 nodes and then you don't go to jail. So that is not a meaningful metric because it's so easily manipulable. So on one side, you have the manipulability, and on the other side, you just have bias. It's just subjective, so it's your opinion. So, I mean, that's fine if you're a central bank or a government and what you say matters. But if it's just me, like, why would you care what I think? Like, maybe my biases are different to yours. So the point is that you can choose your own poison. You can tune where you live on this parameter space. So here's some more boring tables. Let's skip those, and then we will get to some pictures. Okay, so going back to this idea of Ethereum being sufficiently decentralized, imagine that there was a space and there was a function, like a boundary surface in that space. And that's what I've tried to draw here. So imagine, little Ethereum up here, 2014, looking like quite security-like. And then as time's gone on, the network has matured and the use has proliferated and it's come down through this boundary, or it could even be kind of like a traffic light system where you have a kind of green zone where everything's cool, and then a yellow zone where things might not be cool, and then a red zone where things are definitely not cool. So again, this is a sort of a visual grammar, a visual tool to try and move the conversation along beyond, I think X is security, I think X is not, I think Y is a money, I think it's not. So yeah, please use more precise tools, even if you don't like mine. Okay, here is token space with the top 10 assets by market cap as of 4 or 5 months ago. I admit that market cap is a terrible metric and it's easily gamed, but whatever, you've got to choose somehow, haven't you? So again, this may be projection at least partially of my biases, but it seems to tally with reality that Bitcoin is kind of out on its own. It's a better money than most of these other things by virtue of the width of the protocol, the diversity of the options you have to jump on and off the network. Ethereum also seems to be sufficiently diversified or sufficiently decentralized, I don't know how you would describe that, to be out on its own as well. I would say it's got a higher security-ness because of where it came from. If it went to proof of stake, I would say that would go up again. If governance rights were attached to the tokens, I would say it would go up again. So compare that with some of the kind of, let's say, Bitcoin-like proof-of-work networks, Bitcoin Cash, LTC. They seem less security-like, but they're more security-like than Bitcoin. And you might argue that's because there are these centralized foundations or leaders and so on. Tether is in there. I'd say Tether is a bit of an anomaly. I don't know if Tether is well mapped by the existing set of taxonomies that I've built. So maybe something more customized, more bespoke for stablecoins would be better. And that's something that, that's one of the future directions I'd like to see this going. I'd like to see people using this kind of thing to delineate the similarities and differences of organizations, decentralized organizations and centralized ones, as well as things like new types of assets, such as stablecoins. Okay, so XRP and XLM kind of up here, looking quite high on the security-ness thing. I suppose that might be because so much of the supply is in insider possession, foundations and what have you. And then up there, the kind of class of 2017, these guys, Tron and EOS and stuff. Don't want to say too much about them. So if you have these data sets, then you can start to perform some statistical computing. Now, this is of limited meaningfulness with only 10 data points, but you can do basically clustering analysis. So you can start to pull out what might be subclasses of objects within these populations. You can do hierarchical clustering. You can then make really busy slides where you try to map things moving over time. So hopefully I've got 1 or 2 minutes. 1 minute? Okay, yeah. So I want to show you how these things might be evolving over time. Because obviously, we live in a 3-dimensional space, but time is our 4th dimension. So you can also apply this to token space. So imagine Bitcoin at the start of its history. It was not a very good money at all because nobody knew about it and nobody used it. And, the resilience of the network hadn't developed. So you might think of this thing becoming a better money over time. You might think of Ethereum becoming a bit of a better money commodity and less of a security over time. Sufficiently decentralized, remember. XRP, not doing much. Gold became less of a good money over time, right? So this one, I didn't build taxonomies for all of these things. This is more like an indicative projection of how I see these things evolving through time. That's gold. USD, I don't know where it's going. Looks like it's kind of going down the toilet, maybe? Okay, so anyway, I'll leave it there. Thanks very much for your attention. A couple of links here, one to the conference and one to the paper for this stuff. All right, thanks very much.
Thank you, Wasim. And again, a t-shirt for you. Thanks you for coming.
Thank you.
Now we will have 20 minutes of a coffee break. And as mentioned, you are free to choose to join one of the workshops, the CAD workshop right behind the catering area, or come back at 3:20 p.m. to this stage where we'll move on with talks on token engineering, and we will present most interesting initiatives in this space to join. Thank you. Okay, let's move on with our program on the main stage. And before we again dive deep into token engineering, we want to make you aware of Pretopia FM. This is a podcast show by Nima Ashkari and Anish Mohammed. And if you like to discuss upcoming technologies, their implications, and also their ethics, then this one is for you. Tune in, and Nima will tell us more.
Yeah, thank you for being here. We hope you listen to our podcast. We have about 10 episodes, a little bit more, and the focus for the moment is, Anish is also a co-host, we're focusing on token engineering and how we can, look into the future impacts of these technologies like AI and crypto. Very briefly, so the link is pretopia.fm. What we like to borrow from Michael Zargom, this is one of his slides always is, this is where we are, which we like to call we are in pre-dystopia or utopia state. And we try to talk to people, experts, mostly doers, engineers, who are building technologies in the direction of utopia. We won't get there, but we'll at least nudge it towards that direction. Some of the people that we've already had, so Trent McConaughey, he's almost a co-founder for a podcast. We have people from the AI space, probably you recognize a couple of faces. This week we're talking to the leading figures in the DAO space. So Ryan Drurin in an hour, and we just interviewed Ed Hesse from Energy Web Foundation, and also Luis from Aragon. So if you want to, spend more time, have unscripted, deep chats with these people that maybe you see them here, please join our podcast. And we have a tiny gift for everyone so I think we'll handle that over email, but we'll be giving a 50% discount from our sponsor, Pizzes, which is an app for people who want to sleep and think too much. But that happens over the email, so look out for that. Thank you for the time and having us here.
Thank you. Thank you for being here. Of course, you get your t-shirts. Okay, we will make sure that you will get the link to Pretopia FM and that you will be able to get this discount. And yeah, looking forward to have more episodes with people in this token economy space. Now, I'd like to welcome on stage Chris Paruk from the Cryptoeconomics Lab in Vienna. And you might have already heard, he not only is giving a talk about token engineering in this new emerging scientific field, he also curated the scientific track, and he is, let's say, contributing to this sector and bringing together research to this practitioners area in a super valuable way. Welcome, Chris. Give him a round of applause.
Thank you very much. Thank you, Angela. Hi. Hi, good afternoon. Hi, I'm Chris. I'm from Vienna, from the Research Institute of Economics, and I started to engage there around 1 year ago, shortly after I visited and took also had a keynote at the last year's Token Engineering Global Gathering here in Berlin. And what I'm doing is I'm trying to synthesize the methods from mathematics, from engineering to economics, because as my previous speakers already discussed today, we need to get a more rigorous approach in designing these ecosystems. And I want to talk today about the ecosystem and the purpose-driven ecosystem, because for those of you who have attended today in the morning, Shermin, the director of the institute, she was introducing the concept of purpose-driven token. But the token is only on the bottom layer of the ecosystem. And I try to describe how this token and the purpose of the system can connect. But let's start with a short motivation. Unfortunately, I'm not allowed to show a video here, so this is why I took some screenshots. And if you look at YouTube, you can find this. But what I wanted to show is a self-driving motorcycle. And it's a funny video, you should check it out. And what you can see there is that this is a machine that is autonomous and that is pursuing a goal as a system. And the goal is to stay upright all the time, even without a driver. And it's pretty funny because on the video you can see that the guys try to tackle the motorcycle and they try to even kick it in order to stop it, but it always gets up again. So I really recommend to check it out, because what you can see here is a system that has a purpose. The purpose is to stay upright and stay running all the time. But this system is a complex system, and it's an automated system. So what does it mean? It means that in robotics, we have very rigorous methods and very rigorous models of designing these kind of automations. So why don't we do this also in economics? And those of you who have attended today's talk in the morning as well might remember this slide. This slide describes the history of economic schools. And it's not everything, so you can see two of them. So this is from top to bottom. What I'm trying to say here is that economics is a scientific discipline that describes social interactions within communities. And we started to analyze this around 250 years ago. But at quite some point in time, we decided to go into a direction where we used simplified methods, because it was very difficult to observe and calculate what is going on in the economy. But it was very easy to do so in robotics and in automation. So my suggestion now is, why don't we use these tools that we have from complex system engineering and try to synthesize them into economic design? So let's talk about some core concepts maybe. What are complex systems? A complex system is a system that consists of more than one subsystems. So you have different parts that are connected to each other, that affect each other, and that they also influence. What happens in one will have a huge interdependency with the results of what happens in another one. Think of the motorcycle, right? You also have different components that inform and influence each other, and they always take into consideration what they can observe in another subsystem in order to understand how this might influence their state and their decisions. And I try to argue that economics is a complex system as well. So what are dynamic systems? A dynamic system is a system where time plays a role. So you simply cannot take a snapshot of economics, of the economy today, and try to understand, try to model, or try to design it in the future. So we also should take this into consideration. Let's talk a little bit about different scales and different perspectives. The most economic schools, or the most understanding of economics, says that we have a micro perspective, the individual level, and we have the macro perspective, the aggregate level of the economy. So these are two different scales. You can look at what's going on in the bottom, or you can look at the economy as a whole. In modeling automated systems, like for example this motorcycle, this wouldn't be enough. So you need more than one of these layers to understand what's going on. And what you also need to do is to connect those layers. And this is called micro foundations and macro contextualization, which means that in order to understand what's going on here, you need to know what's going on here, and so on and so on. So for each of these layers, you can make pairs, micro-macro pairs, and say that you need, for the top-down approach, you need the aggregate relationships to be consistent with the fundamentals. And from the bottom-up approach, you need to put the principles that you derive into the context of what's going on above. Another very important thing when modeling is taking into consideration different perspectives. When we look at decentralized digital ecosystems, we would be looking at the economic side, we would be looking at the technical side, legal side, and so on and so on. We need to understand this in order to have a good understanding of how the system as a whole might evolve over time. So now let's define what is purpose-driven. And I would like to talk about attraction here and not about incentivizing, because this is the core difference. What we want to achieve with our ecosystem, with our design of the economy, is we want to set a goal of the economy and to try to draw the people to this direction and not the other way around. Because when trying to push people, you might get them to another outcome that you imagined. But if you define some sense of a gravity of the system, the purpose, the goal, and if you derive all the mechanics and dynamics of the system in consistency with that, then you will really design an economy that has a specific purpose that you want to design. Another important aspect is dynamic control. Michael Zarkam was talking about this today with complicated words, I know. But what he was trying to say is that we have to control the system over and over again. Imagine that you want to fly to the moon. You can define some controls. You can define which direction you want to go, which height you want to go, which speed you want to go. But you have to allow yourself to change these controls over and over time, because you don't know how the environment will react. So this is why in designing and controlling and governing these ecosystems, we need to apply this dynamic control. So now let's try to connect how these concepts from system engineering might be consistent with economics. When we observe the world that we want to model or that we want to design or that we live in, we are facing a lot of data, a lot of information that we cannot really compute, we cannot understand them. So most of our models or most of our approaches trying to design, steer and control these economies rely on very limited data. So we only try to use the tip of the iceberg. What we do as well is simplification. So the methods and the models that we use are heavily simplified because it's easier to understand, it's easier to derive policies from them, and it's easier to compute. But now, since we are engaging in building digital economies, we can solve these issues, right? So what we have is computational power today, and the reason why we can apply the systems engineering approach into ecosystem design is because we can rely on computation and we can rely on data. Digital economies that are purpose-driven inform us all the time, continuously, about the state they are in and about the interactions that are happening. So why don't use this, similar to the automated motorcycle, to design an economy with a purpose? So what is token engineering then? Token engineering is the design of purpose-driven systems. And I would even go one step further and say that it is the design of cyber-physical economies. What does it mean? We live in an economy every day. A part of this economy we can tokenize. Here, we would apply token economics. If we want to design and control these token economies, we would use the methods from token engineering in order to build a token that would then again connect these two words. So it is therefore cyber-physical, because you can with the token not only control the digital economy, but also the effects that it has on the real world. So this is why token engineering is the cyber-physical economist design. What then is the job of a token engineer? Very simple. It is to model, it is to simulate, and it is to tune over and over again. So first you need to discover what you want to build, then you have to design mathematical models, and you have to design simulations for it, and then you can start building. It's a task similar to a system architect, right? So if you were to build a building, you would first make a plan, then you would maybe simulate how will this building or the bridge develop over time under environmental influences, and then you would adapt the way you build it. So maybe now let's talk a little bit about economic controls. Since we can maybe compare real-world economics to digital economics, I would like to use this example to understand or to show you how controls are applied in real-world economics today. What we have is, let's say, some kind of a market where the social interaction takes place. And we as humans, as social beings, we elect a government in order to drive us towards some goals that we want to achieve as a society. You can think of a nation state, right? You can say you live in Germany here, and you elect representatives that try to steer the country into a specific direction in order to achieve goals that you set for this economy. And typical goals are, you would say here, for example, price stability within the economy, and you would say the growth of the economy. But what you need to understand as well in economics, and this is why we have so many political issues, is that the goals that we want to achieve sometimes contradict, and we have trade-offs between them. So you cannot simply apply controls, or you cannot simply design the system and let it evolve in this envisaged state, because this will not happen. So what you need to do is you need to maybe separate policies and say, okay, we can apply this policy to reach this goal, and we can apply this policy to reach this goal. What I'm talking here about in particular is, for example, you can make the separation of monetary policy and fiscal policy. So in many economies you use monetary policy to achieve price stability, and you use fiscal policy to achieve growth. But the problem we have as well with the market is that we have market inefficiencies and we have shocks from the inside of the economy, but also from the outside. But still, the controls, the policies that we apply are within the system. So what I'm saying here is that the system has to react to shocks from the inside and shocks from the outside. Think of the motorcycle again. This motorcycle didn't even fall when people were kicking it from the outside, right? It managed to stay upright. Because the policies that the parts of the motorcycle applied were steering this system towards the goal of staying upright all the time. So, how do we want to model it? We need to at least apply 3 scales in our multi-scale modeling. We need to model the economic system as a part of the outside economy. So we need to say, okay, how does this economy that we build connect to the outside world? For example, if you design a cryptographic ecosystem, blockchain ecosystem, you can say, okay, how does it interact with other ecosystems, or how does it interact with the real world? You need to understand this. Then you need to make subsystems and understand how this system might be separated into subsystems that inform and influence each other. And for each of those, you would then make this loop. You would say, okay, which action would lead over which mechanism to which state, and how do you value this state within each of these subsystems. And what you need to remember is that you need to make micro foundations from the top to the bottom and macro contextualizations from the bottom to the top. So now let me talk a little bit about this last part here. How does it look in particular? This is again systems engineering, and we want to apply this on economics. So we want to separate our system into subsystems. These would be the lanes. And we want to understand how different actions that we take here over which state update functions would lead to which states. And then we could apply KPIs, health metrics on it. So we can say for every step, we could say what happens here leads to this, how we value this. And this would again inform the agents or the controls here. The diamonds are, for example, you can say human behavior. So you can say, okay, these are agents, people who are interacting with the ecosystem. Here, this would be controls that you can apply. And these would be random processes. You still need to include them, right? And again, you see that, for example, the controls are only a part within the economy that try to steer it. So how does it look as a whole picture? We are the humans, right? We want to define the goals of our ecosystem, and we want to design, implement, and govern here the software or the mechanisms that can make the ecosystem grow or make it alive. And according to these goals, we would need to define all of this, which is basically here. So how would this logic apply on our ecosystem? Which actions lead to which state changes and which evaluations again? Then we could build the model of this and we could start simulating it. And if we do so, we will then be informed again and can define new goals or design new changes to the implementation. So this is what we try to synthesize. Complex systems engineering, think of automated motorcycles, and they are decentralized because they do not have a driver, right? You do not need someone to control the system and it still stays upright. And we want to bring this into economics. Thank you.
Thank you so much, Chris. Maybe I haven't mentioned yet that we are happy if you share the talks and the comments to the talk on Twitter and hashtag. I think, Chris, this was a super good introduction to the token engineering area. Thank you so much, which is also approachable, I think, for many disciplines and people from many different backgrounds. So thank you very much. And here's our present. And see you soon. Maybe at the hangout session tonight, networking in drinks. And feel free to approach and connect with Chris. Again, TEGG.io/program, and you'll find his Twitter account, and feel free to connect to him. All right, our next talk is again from somebody with a research background, a computational economist. I'm welcoming Jamshid Shorish on stage. Ah yeah, there you are. Welcome, Jamshid. Great to have you here. This is your mic. Okay, your work includes applications of neural networks to asset pricing, so this is finance. You worked on token valuation and incentive design, and your talk will be about reward mechanisms and the engineering of token incentives.
That's right.
Thank you for being here, and give him a warm applause.
Great, thank you very much. I hope everybody can hear me here. So it's great to be here. due to some technical snafus that were referred to earlier, this title slide here, which you can see that the bottom corner there is a flock of birds. The top was actually a little movie showing how you can do a computer representation of flocking bird behavior using what are called boids. These were invented by Craig Reynolds in 1985 or so. What you would be seeing is some computer abstraction of flocking behavior, birds moving in concert, even though they're birds and therefore aren't really communicating in real time about an overall objective. Instead, there are local rules of local interaction that have emergent behavior. So I'm using this kind of as a red thread to kind of keep through the talk about this notion as to what does it mean to have a goal at the very top, which you may or may not decide is explicitly engineered, and then have local behavior, local interactions through the use of incentives to create emergent behavior, which would then reinforce this. And so what I'm going to do in the talk is to take really a background from economics and my specialization in mechanism design and contract theory, and try to convince you that there are scope for token engineering and mechanism design to be brought together to further objectives where you have a common goal, but you may or may not be able to rely upon individuals necessarily aligning their interests to further that goal in some idealized best way possible. So I was going to motivate this a little bit with some of the existing technologies that we've already seen, Giveth and the Common Stack, but of course I think Common Stack is speaking later. For those of you who haven't seen these are two particular distributed ledger technology initiatives that are looking at the idea of having a larger scale societal goal, charitable donations for furthering the public good, or a shareable pooled resource, which you can actually then divide up for individual use. And then you have this question, this problem, this tension of what will individual actors do? Can they actually be sort of incentivized or design a mechanism by which, by making themselves feel that they're doing something meaningful, actually further the common goal at the top? And the reason this is a challenge, this was well studied in the 20th century. At the beginning, and I'm going to break it down into some of the social science aspects very, very quickly, this was initially looked at in a 1968 paper by Garrett Hardin called The Tragedy of the Commons in Science, the journal, where he was describing the overuse of a common resource when everybody acts individually. And the solution that in economics was something that was presented was the notion, well, in this case, what you have to do then is you either have to make some kind of privatization, assign property rights to resources so that they aren't really commons anymore, or you have to use a top-down regulation mechanism in order to ensure that a common resource such as forests or fisheries or the commons where sheep may graze is not exhausted. Now, this was actually revolutionized in the 90s. This was done by Nobel laureate Elinor Ostrom, and she made an incredibly detailed and specific analytical case on the basis of her own field work on how small communities actually reinforce individual incentives. And they do so not by assigning property rights or by assigning some sort of top-down regulation, but through peer-to-peer reinforcement of norms and different rule sets. So this is the first indication that we could see that there is a kind of a tension that must exist, but that there is a way that we could think about decentralizing a mechanism by which individuals could in fact reinforce a common good where everybody is hurt if the common resource is exhausted, while at the same time preserving individual incentives to do the best that they can. Now, economics was not the sole location for which this was done. In sociology and philosophy, there's a lot of work being done on the commercialization of society, the commodification of the world. We've seen examples of this recently in the media. For example, in Venice, the over-tourism problem is a problem not just for the residents, the Venetians, who have an inundation of huge numbers of tourists that simply lower their own quality of life living there. But also, if you're a tourist thinking of yourself getting a snapshot on the Rialto Bridge, you don't want, basically 5,000 people that you don't know photobombing your little selfie on the Rialto Bridge. You're thinking of yourself actually as participating in the consumption of Venice independently or without other individuals who may lower your particular payoff. And so we've seen a lot of work done in sociology with regard to how can we regulate individually now, not from the top down, our notion of over-commodification as another way of looking at this particular common goal diverging from individual interests. And from a behavioral point of view in psychology, we've seen a lot of work done on the emergence of cooperation and the reinforcement of cooperation through reward mechanisms. And this is where we started to see the development of explicit reward mechanisms for different groups of individuals, whether those groups of individuals are animals or are humans, and actually providing an explicit kind of transfer to them where they then can say, okay, given this transfer that is reward-based, that there's a way in which I can then regulate my behavior such that a common goal is reinforced. And this particular development from the social sciences in the 20th century led to the development of different fields that pushed forward this agenda from this point of view of trying to align these interests. We had, for example, developments of non-cooperative and cooperative game theory, decision theory and operations research, which were in a sense combined through some of the work by Kenneth Arrow in the 1950s, and organizational behavior, where we're going to see a little bit of the mechanism I'll describe a bit later, looked at the organization of teams, team building within an organization, and how those kinds of team dynamics also reflect a common good. Now, what happened in the culmination from the economic side is that we had a series of mathematical results which indicated that if you really wanted a common goal to be reinforced for any kind of person, and by this I mean any kind of preferences that a person may have, one of those people will tell you simply what they want, and then everybody does that. So the common good becomes one dictator's result. So the dictatorship results from Arrow and then reinforced by the Gibbard-Satterthwaite theorems in the early 1970s, in a way, caused economists and some social scientists in general to say, well, let's take a step back from a universal result, and can we just find a way to pool everybody's private information that tells them what they want to do alone in some common framework where everybody pays a price. And we can use then the market to be able to take that private value, which has a value at the common level, and pool it through the market mechanism. And so this was the state of the art, really toward the end of the 20th century, for how it was that economists were looking at this notion through the idea of bilateral negotiations, for example, in contracts, where different individuals hold private information that needs to be pooled for an efficient outcome. Now we move to the 21st century. And in these last 20 years, we've seen a tremendous revolution in who was taking up the forefront of the challenge of examining the reinforcement of a common goal through privately aligned interests through a lens that was not looking at a market mechanism, because that could only take you so far. We've seen computational implementation theory, which says, look, how do we figure out how to implement particular ideas, common goals, irrespective of whether or not there is a market mechanism at all? Let's just try it and see if it works. This is from computer science. Algorithmic mechanism design, algorithmic game theory. These were the leaders in this time as data-driven and computationally driven approaches to be able to solve problems, particularly, but not exclusively in robotics, to be able to decide how these common goals can be reinforced. And so there was a real big uptake on this notion of looking at these things as collections, not just of people with preferences, but actually of subsystems, each of which has a particular reward mechanism, and then an overall system that is dictating the direction that the system as a whole has to go. So this led to this revolution in understanding how to take a particular system and then validate and verify what is going on. So we saw the rise of the computer-aided design. And of course, CAD/CAD is one fantastic example of this. And multi-agent systems allowed this paradigm from Elinor Ostrom to become actualized as a notion of, okay, peer-to-peer reward, where we don't need a central authority to be the one to dictate the reward structure, can actually become something that many, many different little system components can help reinforce each other. And so in a contrary way to the economics approach, we have what is known as a systems engineering approach. And it's this which is now the driver for bringing these two paradigms into one cohesive whole. So what I'll do for the rest of the talk is to try to show how these two environments can somehow be put together so that we can, in a way, cherry pick the best of each of these. Now, back to distributed ledger technologies, where does this actually come into? Where's the part of this that actually makes looking at DLTs such a fantastic opportunity to see this interface between these two types of approaches? Well, I will limit my use of the DLT paradigm to simply looking at it as if it is simply a database technology. Of course, it's quite a bit more. But considered as a database, as entries in a database, it has two unique features that we weren't really able to reinforce prior to this time that allow us to do this alignment of the common good through individual incentivization. First, it's a trustworthy entry, so it's non-manipulable, it's auditable, and it's consensus-based, and this is extremely powerful because it allows you to do so, of course, without having to worry about either the dictatorial results, the Arrow's impossibility theorem, or worrying about having some sort of top-down approach, which everybody has to agree on. And second, decentralized implementation. You have a distributed location. You have an ability to actually have open access to what it is that is running via the smart contract system. And no single point of truth or single point of failure is necessary. So these are the two characteristics of DLTs that I'll show are ways in which we can look at this environment as reinforcing mechanisms that are both from economics and from the systems engineering literature. So this allows us then to have a representation, and that representation then takes the form of this particular kind of database entry known as a cryptocurrency token. And what is it representing? Well, in this particular case, since we're looking at a common goal that needs to be reinforced from the bottom up, we're looking at what is called a purpose-driven token from Shermin's terminology that you saw this morning, and what was described more fully from Chris in his talk. This is the idea that you have at your disposal a particular tie between what it is you want to do and how you can distribute in the form of a reward, a mechanism that when people condition upon that, they do something which is the best for the system given the conditions that they're in. So that's the idea of what is called a purpose-driven token. There are, of course, many other kinds of representations of tokens, but this is the one slice that we need to be able to infer how to incentivize individual behavior at the common goal. Now this is, I'm going to gloss over this part. This is similarly but conceptually distinct from a utility token. It can be that these are reinterpreted as purpose-driven tokens. That's simply a formal similarity. From our particular purposes, what's important is that typical issue or objectives such as fundraising and other public good environments, common good environments, can all be cast as incentive transfer mechanisms. So this allows us to broaden the scope of what we would call a purpose-driven token by interpreting these particular types of common goods as that particular function or relationship, or even functional relationship between different behaviors that we wish to say is what the society wants or what individuals want when they're setting up this particular mechanism or ecosystem. Now this is necessary because it's really hard to reinforce people's good behavior by telling them to be good, or to reinforce noble characteristics by telling them to be noble. This is a hard problem. This is a result from psychology where it is simply difficult to incentivize when people can say or do whatever they want to have them behave well. You will have all kinds of statistical distributions of trolls and cyber trolls online who, as long as they are anonymous, they behave one way, but the instant that you can actually apply a name to them, they behave completely differently. So this notion of being able to do this without transfers limits the kinds of things that you can implement. So transfers themselves, these tokens, really become the mechanism by which you can drive a particular purpose. And it would be similar, if you wanted to think about how you could do this without transfers, it would be similar to trying to derive a barter economy, where you weren't actually allowing individuals to save up something that they think somebody else might need in the form of money. You'd have to actually carry on your back everything that anybody else might want and then try to get what you want from them. In addition, transfers themselves help align truth-telling mechanisms. This is part of the mechanism design literature where if you think about everything that people could do to say what they would like, it suffices to look at all of those situations where they are telling you exactly what they want and that they are not lying. So that what they are doing, instead of sending some kind of obscure message about what they would like, they simply say, I like X, or I am of type Y. And that's a useful way to actually examine what happens, because you can look at mechanisms that are direct in terms of how people elicit information, and they allow you in turn to examine the types of equilibria where you would say, what I care about as an individual is independent of what anybody else is doing. These are called dominant strategy mechanisms. Now, there are more general mechanisms that you can use. There's Bayesian Nash mechanisms where you're actually taking some sort of a probability distribution over what everybody else might be, bad actors, good actors. That's also an equilibrium. A simple first cut at a mechanism that you can use, which provides a strength, is that you simply get something, kind of like the Boyd representation. You look around your local environment, you make a decision. You don't need to know what everybody else is doing. Now, in the mechanism design literature, there are such incentives that do exist. And they've been well studied over the years, one of which, the most popular perhaps, is the Vickrey-Clark-Groves mechanism. This was studied initially in auction theory by William Vickrey, and then extended by Clark and Groves in the early 70s. The idea behind this is intuitively very simple and appealing from this notion of building a collective common good from individuals. The idea here is that everybody in the mechanism has to pay something according to how much they contribute to the societal good. So it's a positive or negative externality of whether or not you are contributing to society or are in a sense harming society. And so you pay or receive a stipend in the amount of that particular externality suitably defined. And that has very, very appealing characteristics if you're looking at the maximization of societal good in some fashion of saying that this is the global benefit. Now, this requires very strong assumptions, which is where we're going to get back to the DLT strength in a moment. To support dominant strategy mechanisms that may or may not pay for themselves, you may need a capital injection to come in. It may be not possible to make these assumptions that I'm going to mention in a moment. But provided that you can actually use an auction mechanism, which is called a Vickrey auction or a second price auction, to implement these types of mechanisms. So there becomes a formal parallelism between what you can do in the sense of maximizing the common good on the basis of aligning individual interests on the one side, and thinking about that common good as something which is being brought up for auction on the other side. That's another way of eliciting that private information with or without a market mechanism. So you can think about it with a market mechanism, and it's auction theory. You can think about it without that, then it's the messages with transfers. Now, why isn't this simply what we do every day? Why isn't this every kind of auction we've ever seen? The vast majority of auctions are not Vickrey auctions. And the reason is because it has these strong assumptions. The first assumption is that it really doesn't matter how rich or poor you are when you are deciding about the common good for this mechanism to work. That means that if you're talking about something like, let's say, a United Nations development goal of low infant mortality, it doesn't matter if you're a poor person or a rich person when deciding whether or not you want to contribute to that goal. Sounds reasonable. Perhaps if you're looking at one of the development goals, which is to increase people's level of income, who are very, very, very poor, well, then it might be quite a different story as to whether or not, if you are already well off, how you are going to value that particular outcome versus whether or not you yourself are poor. And so this immunity to income effects, which is called quasi-linearity as a preference assumption, is one of the strongest binding assumptions for these types of mechanisms, and is one of the major reasons why we don't see this in practice. Another reason is that practically people can band together and cheat. They can simply find coalitions of themselves, take the transfers, the things that are promised to them for certain types of behavior, divide that among themselves, and break the mechanism. And there are other assumptions that go in with this, but these are the two main ones and the main reasons why we usually see auction mechanisms in the first price instead of a second price, a non-Vickrey auction environment, simply because these are too, in a sense, too fatal. They're just not usually realized in practice. Now, I'm weaving back and forth between what we've seen for DLTs and what we've seen for economics, what we've seen now for systems engineering approach. Finally, let me bring you back to token engineering and see whether or not this particularly attractive mechanism in principle, this Vickrey-Clark-Groves mechanism, can in some sense leverage what DLTs have as strengths. And again, I'm only focusing on two: the trustworthiness and the decentralization. And it turns out this is enough to address the shortcomings mentioned before. A practical and a fairly simple demonstration of the trustworthiness allows you to, as long as you have in your DLT a consensus mechanism for validating the state of the system that is Byzantine fault tolerant, then you are able to eliminate coalitions. And this is a very kind of, in a way, hopefully an intuitive result for those of you who think about Byzantine fault tolerance, the idea that you have to have a certain number of nodes in a validation network such that a message that is passed across to all of them succeeds to reach at least 2/3 of them. Then you have the state that everybody can agree on, so you can tolerate some mistakes, either accidental or malicious. Well, this is the idea that in a situation in which you can label the particular tokens that you're using as an purpose-driven incentive reward mechanism, that nobody can come along and relabel them, destroying the opportunity for you to incentivize without a coalition. Because coalition formation is this idea that you pool everybody's token and then redistribute. Well, if you cannot pool them, if they are tied to somebody, if they are non-transferable, and therefore they're non-fungible, then provided that they can't be, those particular characteristics cannot be unwound, you can eliminate coalitions from forming. That's a demonstration result. It's fairly low-hanging fruit from the point of view of what is it that DLTs are so special for in creating incentivization. The second characteristic, which is more of an existence proof and is less about implementation, the first one is immediately implemented, the second one is more about there exists, is that provided you have a decentralized purpose-driven token and it can be produced with zero cost, so you may have a sunk cost in designing the whole infrastructure, but then once you've got a sunk cost, you turn on the token creation mechanism, it plops out a token, and it doesn't cost anything. Or more realistically, from a formal point of view, it costs something in the electricity or foregone time for creation, and you let that limit go to zero. Then you can implement such a mechanism for users that are risk neutral or risk averse. And the idea here is more involved, but it relies upon the way in which you can replicate different potential ways in which risk is distributed throughout a network. Individuals can act in a peer-to-peer environment, and by acting in a peer-to-peer environment, they transfer with each other in such a way that an equilibrium is reached where people who are risk averse are compensated just up to what they would have obtained under certainty, the so-called certainty equivalent payment that makes their risk aversion for that particular area, very, very close to that particular area, flat, as if it were quasi-linear. And then you can bring in the Vickrey-Clark-Groves mechanism once again. Okay, that's the punchline of the approach here. We've been able to tie together the properties of DLTs to an existing mechanism that's very commonly understood and very well studied in such a way that common goals can be realized by aligning individual incentives. Now, work in progress in the future. This was static. This was a one-shot transfer. What we really care about is feedback mechanisms, particularly if you're actually going to be looking at goals that change over time, or if you're going to change a focus upon a particular goal. If you have some combination, for example, of the UN development goals, maybe you want to increase your focus on education, decrease your focus on maternal mortality, or vice versa. Well, that's going to require you then to look at how you actually have this feedback loop between your function that you're trying to decide is the common good and how individuals will align. Now, converging to that is unclear. This is an open research question. I would really, really like to hear if anybody's looking at this or even has ideas on how long-run convergence can be obtained. You can do adaptive tâtonnement, which is sort of the grasping of equilibria as it iterates. You can design, and I think Zargham is working on a lot of this idea of having some global stability properties in this notion, but this is something which is an open research question. My own work is looking at consumer electricity provision in Belgium, because Belgium is a country which is committed to eliminating its dependence upon nuclear power, and they've already eliminated their dependence upon coal. The problem is that they're a massive importer of electricity, and so they have a difficulty in verifying the source of what their electricity consumption is. And so this provides us with a unique opportunity. All right, thanks very much. Oh,
Thank you so
much.
Thank you so much, Jamshid, for this enlightening talk. I think this was a brilliant example of showing the existing work which is out there and then see what makes it special in a DLT environment. So I can't wait to see more on that. Thank you so much, and talk to you soon, maybe after our talks at the Networking and Drinks. I'd like to welcome now Shruti Appiah on stage. Shruti is the research lead at Consensus, and is building the first blockchain artificial economy with Santa Fe Institute. Hi, Shruti. This is your mic.
Thank you.
And yes, give her a round of applause. And she has also set up a decentralized identity strategy at Okta and has been recognized in Canada's top 30 under 30. And today you will talk about the mystery of artificially intelligent economies. Yes. Looking forward.
Thank you. Thanks. Thank you. So, as Angela said, today we're going to be talking about artificially intelligent economies. It's a special talk that I prepared for this particular event because I think that you all will be able to grasp the concept. So, here we go. Okay, so a little bit about myself. I'll go through this super quick because we only have 20 minutes. So I used to lead research at Consensus, and therein I did token engineering research, wherein I developed everything starting from the token utility canvas, which is basically an analog to the strategizer's business model canvas, but for tokens. And more recently, I'm also working as a research scientist at the Santa Fe Institute. I'm working in collaboration with them, and so a lot of the talk today is going to be based on some of the work that I'm doing currently. And prior to this, I was also leading digital identity at Okta, wherein I founded the concept of digital decentralized identity in an enterprise environment, and I proposed it to them. So that actually manifested today in a $50 million venture fund when they are actually just investing in identity products that are implemented via decentralized technology, as well as a little bit of machine learning here and there. I'm also advising, and I'm a visiting scientist at Tallinn University of Technology. And Tallinn University of Technology, based in Estonia, by the way, is just starting their blockchain technology lab. And now that's also taking on a token engineering flavor, which is the primary thing that I'm advising. And by trade, I'm a systems design engineer. I also graduated from University of Waterloo, and I worked at IBM and a few other places. So I want to really motivate how crypto systems are akin to complex systems. So crypto systems are basically, you have a multi-agent system where multiple agents are interacting with each other. And so you can't actually break down that system into the individual components. So in traditional engineering, what we do is we take a massive airplane, let's say. Then we break it down into its individual constituents, and then we study those individual constituents, develop differential equations for it, and then we formulate the entire system by just putting together those differential equations and then coming up with a picture of the whole system. You cannot do that with crypto systems because the interactions between the agents, the interactions between all the people that are making transactions with one another are actually extremely important as well to take into consideration. That is actually what leads to emergent effects and emergent phenomena that you will end up seeing in your system that will lead up to bottom-up effects that you will actually see when these agents interact with each other, not just exist as their own. Then there are a few other properties of complex systems as well, which is that they're nonlinear, meaning that even the smallest amount of change in the signal can actually amplify and amplify and amplify and lead to an extremely large output in the signal that's coming out. So there are a lot of these properties that are kind of analogous to complex systems. And so why don't we actually just take the wealth of research and science that has been studied with complexity and apply it to crypto systems, right? So within complex systems, there is actually a field called complexity economics and artificial economics, which deals with the study of economic agents and economic decision-making when looked at it under the lens of complexity. So you don't just use those economics graphs where you have like the supply and demand curves. Now you actually simulate it and understand it through simulation. So that is what I will be talking about with regards to artificial economies. So with artificial economies, this is nothing new. This has been studied for over 30 years. And this kind of coordination problems that happen with when many agents are interacting with each other and they want to achieve either consensus or they want to just maximize their own returns, that kind of problem you will actually see in many systems, not just in economic systems. You will also see it in ant colonies. You will see it in swarms of robots that are interacting with each other, right? So recently, we have actually become more fond of these types of problems because of the fact that we have autonomous vehicles. We have to have those multi-level coordination between things that are just interacting on their own vectors, right? So that's why we have become more fond of it. And now we're starting to look into how nature has been inspiring us to create optimization algorithms, as well as coming up with computational structures that will actually allow us to study these different types of multi-agent coordination systems. So I'm pretty sure you've all heard of particle swarm optimization and ant colony optimization. It's now again being applied to not just understand these systems, but also to predict as well as develop coordination in these systems, right? And how are crypto economies any different? We're basically trying to do the same thing, right? Characteristically, the system itself is very much similar, and compared to a natural multi-agent system, they are basically just less complicated than that. Crypto economies are just less complicated than that. So we can actually take inspiration from artificial economies and study crypto economic systems as well. So some of the merits also, I'm gonna go back one slide. Okay, so some of the merits of actually using simulations to study artificial economies is that you don't have to have extensive compute power. So if you were to actually take the analytical game theoretic approach to studying a crypto economy, then you would have to make the entire decision tree of all of the strategies that you can actually have in any particular crypto economic decision, right? And you would have to compute the optimal strategy based on all of the utilities in every time step. And so that becomes extremely hard to compute Nash equilibria or even quantum response equilibria or any type of game theoretic equilibria. You would have to have extensive compute power when you're not just studying one agent that's making decisions, you're studying hundreds and millions of agents that are simultaneously making decisions and simultaneously computing and solving for their optimal policy, right? So it makes it a very extensive in computation problem. So that's why if you use simulations instead of analysis, you can actually do it with much less compute power, and you can actually develop or come up with Nash equilibria, or you can come up with stable states or global stable states in a much quicker amount of time. So going back to reality, what this helps us to do is actually do iterative design, adopt an iterative design process. So in Web 2 and in in any traditional corporate environment or in an engineering environment, we have a design process where you would actually just take an initial condition and then you would reiterate on your design over and over again until the design is perfect and it satisfies an objective, right? So you can adopt an iterative design process by using simulations as a means of validating your mechanism design. You can start off with a very simple mechanism design that you're not sure it will work, but if you keep simulating it, that simulation will give you inferences as to whether or not it actually achieves your desired goal. And based on those inferences, you can fine-tune your simulation, or you can fine-tune your mechanism. You can add some functions, you can tune your hyperparameters, etc., until you arrive at a mechanism design you're sufficiently happy with, right? So now, let's talk about smart contracts. We all love smart contracts. So smart contracts are special in the way that they have these specific properties that didn't exist in traditional economic contracts. And so those properties are basically, number one, is that smart contracts exist in a transparent environment, meaning that any agreement that you and I make is visible to everybody else in this room or everybody else on this blockchain, right? So all agreements are transparently available for everybody to see. Now, that wasn't exactly possible with traditional contracts. Usually that kind of information is obfuscated from all of the other players in an economic system, right? Your employment contracts aren't visible for everybody to see. So that is the main one big point. And another one is that they're frictionless, meaning that you do not have to go through all of the legal processes and acquiring an escrow agent or paying a shit ton of fees in order to come up with an agreement and create a contract between two people. With a smart contract, you can actually just do it very easily. In 2 minutes, just write up a piece of Solidity code and there you go. You have a contract. And that is strictly enforceable as well, meaning that that contract isn't just, it's not non-credible, meaning that it actually is legitimate, it holds its weight, and it will actually be enforced if you do make that agreement and the agreement is accepted by the other party. So it's strictly enforceable. So in economics, we often talk about threats not being credible, meaning that if you threaten somebody, you need to have a contract in order to enforce it. Whereas with smart contracts, that's actually possible because the code will actually be enforced if both parties agree to it, right? So all kinds of threats will become credible. And so with such properties, there are certain kinds of things that you can do to modify games. You can actually shift the Nash equilibrium of games that any two players are playing. So consider a traditional prisoner's dilemma game. So say A and B are playing a prisoner's dilemma game, and the Nash equilibrium obviously exists in that yellow box where if both players defect, then that is essentially the Nash equilibrium. So is everybody aware of the prisoner's dilemma, or should I explain it? Can Joe, show of hands. Okay. Okay, I think there's few people that do not understand. So basically, it's say two members of a criminal gang got caught up in a prison, right? So you can either choose to be silent, or you can actually choose to reveal that you actually belong in the criminal gang. And if you do reveal, then you will be set free. But if you do not reveal and your partner reveals, then you'll get 3 years in that prison. So that is a way worse thing. And if you both choose to remain quiet, then you both just get 1 year in prison because there's a doubt, right? So that's a prisoner's dilemma. So you are more incentivized here in order to defect. So you get 3 utility points if you defect, but your partner has to cooperate. So that is the bottom left box, where, so if you choose to defect, meaning that if you say that you do belong in a criminal gang, you will be set free, but your partner actually loses, meaning that they will actually spend 3 years in prison, right? So you are more incentivized to defect, but it's also a riskier strategy, meaning that if your partner also defects, then you both get 3 years. So this pre-contract game is defined by just the players, the set of players, the status, the strategies that they can take, and the set of the utilities, and the utilities are just represented by those numbers in the matrix. Okay, so how can you warp this game? If you and I are playing Prisoner's Dilemma, now what if a player C comes in between us and says, hey, player B, I'm going to give you 1.5 utility points if you defect on player A while the game is being played, while A cooperates. So if you defect while A cooperates, then I will give you 1.5 utility points, right? And so that is the warping contract. And the warping contract can essentially just be a normal smart contract where the contract is actually transparent. So meaning that A actually can see that C comes to B and proposes this specific game warp. But nevertheless, if A participates in the game now, the game fundamentally changes. So now the game actually changes to this composite game where the Nash equilibrium is now A defects and B cooperates, as opposed to before where when A defects, B also defects, which was what it was initially, right? And that is usually how normal Prisoner's Dilemma is. But C, a third player came in and was able to modify the game that A and B are playing just because they had specific information and an understanding between the game between A and B. So you can see how this is usually not the case in traditional economies because you aren't aware, number one, of the game that two players are usually playing, and you are also not able to make such contracts or warping contracts because they're really expensive to put together. Now, this doesn't just happen in two-player games. This can happen in n-player games. You can have extensive forms of this happening, not just between two players. You can actually warp many games that many different players are playing with each other. And another scenario that can very easily occur is also coalition forming. You can actually have an emergence of cooperation between multiple agents to maximize their own benefit. So you can actually pool multiple parties' wealth in a pooled utility, and you can have that to make even more attractive offers for player B to take. Say, instead of just offering 1.5 utility, now you can offer like 3,000 utility, because now you have formed a group of many different game warpers, and all of those different game warpers have now share their resources in order to make even more attractive and more extensive game warps, where they're able to get exactly what they want with high certainty. So coalitions can form, and it's not just that A and B, like the most dumb players per se, are getting warped. Even game warpers can get warped, right? Because they're also playing a game that is just a game that is on one level on top of all of the normal players. So game warpers can be warped by super warpers, where super warpers are actually warping games that game warpers are playing in order to make these offers. So now you have this whole marketplace of game warps. So you can imagine, say there's an agreement between two different parties on a blockchain. Now, you can have an open marketplace where there are many different parties that are offering different utilities to player A and player B, that they are going to be able to offer them this certain amount of money or the certain amount of utility if they either cooperate or defect on their opponent. So, how do we study this? This is all, it sounds very scary because it's something that we don't understand. It is not conceivable by humans, right? So how do we actually understand it? So this is conventional reinforcement learning, where you just have an agent which is affected by the environment, and the environment basically sends feedback loops back to the agent, and the agent performs actions that change the environment, right? And this is just a normal Q-learning function where Q represents the reward that an agent would get when they make a particular action, right? You can study this using not just agent-based simulations, but these special agent-based simulations, which are called multi-agent reinforcement learning simulations, because you would want these agents to be considered as little humans on a computer, right? So how do you create little humans on a computer? You need some sort of learning there. So that's why we use multi-agent reinforcement learning. And with this, it's a step away from just traditional agent-based simulations. By the way, traditional agent-based simulations is how I first started back in 2016. And I moved on to doing multi-agent reinforcement learning because you can have heterogeneous objectives, and also increasing complexity in any model in a traditional agent-based model will actually lead to overfitting. As you might be aware, overfitting is such a great concern in any kind of machine learning problem, and that also happens with agent-based simulations. So you can actually use multi-agent reinforcement learning, because that way you don't actually have to hard code the agent's action into the program. The agents just choose whatever they want to do, and they will evolve over time, get more intelligent over time by learning from their environment. So this is basically an iterated presence dilemma game. It is a normal agent-based simulation. You can see that the incentive for any player to defect when they have defected previously is 1.71 times total cooperators. So red represents defect while the previous move was also defect. So eventually everyone ends up defecting. But if you actually decrease it a little bit, you can learn that there is a stable-ish state, like a global kind of stability that arises when you have a smaller number associated with the incentive to defect. But if you have something that's close to 1, you can see that everybody tends to cooperate. So cooperate is represented by blue, so you can see that everybody tends to cooperate when its incentive to defect is almost neutral. Right? So now this actually changes the meaning of money, because if you have many AI agents that are interacting on a system making game warps on each other, now this actually makes it such that the agent that is able to make or compute or solve for the most optimal strategy is the agent that is able to get the highest utility out of the system, right? So that who is able to complete the most optimal strategy? The one with the most computational power. So computational power will be akin to money in such kinds of systems. And it's rather inevitable that they actually come up with human inconceivable strategies, because the example that I showed you is just one way games can be warped. There can be n numbers of ways in which games can be warped, not just between two players, but between n players in a multi-scale system, right? So you can imagine what kind of strategies and what kind of coalitions and cooperation methods will be formed in such systems.
Are you all right?
And so that's all. Thank
you, Shruti. I think we will dive deeper into artificial economies many times in the future. Very exciting. Thank you so much for being here. Thank you for your talk. Now, slowly but surely, we will get back to applied cases. So the last group of talks today are about how to apply token engineering in real cases, and also initiatives and tools and open source frameworks to use to further go ahead with token economies. Our next speaker is Sebnem Rusicka. You started your career as a computer scientist, and in 2016 you started Freelio. You joined a peer-driven initiative to create the Free Digital Energy Assets Framework, funded by European Ledger Program, amongst others. And recently you joined Energy Mine as a CTO. So your background is energy, or your operating field. And your talk is about the step zero of designing and engineering a token economy, and you called it the Tao of token economies. Looking forward to your talk. Give her a round of applause.
Thanks a lot. I wasn't expecting the intro. So, yeah. So I'm going to give you the gist of what I came to see as the way to do token economies, coming from an applied researcher's field, and my application field is decentralized energy systems. And here's basically your way to cut it short, because I have to make up for sometimes for the great announcements that we're going to have after my talk. So step zero is you have to design your ecosystem in order to be able to formulate the assumptions. Those assumptions are what your model is built on. And if you screw up on those assumptions, well, you can use any technology and any framework you want, you're not going to get the desired result. But once you have your ecosystem designed and your assumptions there, you can model them. And you don't just model your system, you should model the system dynamics. Once you have that, you can run your simulations, and once that seems okay, you can deploy your smart contracts. You can embed those incentive schemes that you programmed into actual physical, cyber-physical systems like smart grids, smart microgrids. And when you do that, you are going to be able to datafy, meaning you are going to be able to get real-time data from the system that you just modeled. And with that data, you are going to be able to have model and data-driven optimizations, first of your system, but also of the outcomes you thought were good and were desirable, because that might change as well once you have deployed that. Now, let me just give the takeaways. You're going to model an evolutionary dynamics, and you will see that we live in non-ergodic systems, which means any step, any incentive, any action that is taken is going to change the system space and the potential outcomes. It's more like looking into contingencies and contingency analysis rather than trying to map the entire space. And all models are wrong. Some of them are useful, and the useful ones are the ones that tell you, no, you have been asking the wrong question, go back. Go back to step zero and think about whether you have the right ecosystem design. And I don't know, how many of you were now in the CAD workshop? Just 2, okay. Then you should definitely find out about CAD. which is basically potentially a unified framework for that model and data-driven optimizations. Now, potentially because it currently can handle steps 1 and 2, but because it's a framework developed in Python, you can easily plug in your data pipeline from your actual systems and have that unified framework. Then you can rest assured that you can actually have insights into the systems that you are programming and deploying, and that are going to incentivize real people in the real world, and they're going to affect them. But you basically need to really take care about whether your design was right, whether you have included the right people in your system, and whether your system boundaries are set right to actually create the outcomes you hope for. And for that, we currently don't have a methodological way other than really running simulations and making, coming up with actually artificial economies. But you could, or you should, and coming from energy systems, you really have to utilize design thinking, and that's what I would call token design thinking. It's basically applied research on having token models, but actually embedding them into cyber-physical systems where you don't just have an automated microgrid, but also people interacting using the electricity from those systems. And I want to give a short example of the insights that we had from the Sun protocol, which was a token project until November 2018, and that's basically where I got to understand tokens and the power that we get a bit more, and the responsibility that we have. First of all, of course, you're solving for a problem, and that problem here was basically 600 million people in sub-Saharan Africa still don't have access to electricity after 150 years of electrification because it doesn't pay off in the existing systems with the existing incentive schemes. But there are already asset owners and operators, and that's what I would call an asset. And today I'm calling them digital energy assets because we can entirely digitize them. The Africa Green TEGG is such a company that operates as solar microgrids in sub-Saharan Africa, in many villages. And they can basically create an entirely digitized economies in these villages based off of renewable energy. The people get access to clean energy, to information system because it has satellite power, and basically when we tokenize those, also access to their own financial systems. And that's what I realized also through that project. When you tokenize energy, basically you're creating, if you want it or not, a monetary system, and you're creating a digital complementary currency in those villages that represents their GDP. And also it was very frustrating to see that we don't have any other KPIs in the economy other than growth. And the one thing that we saw immediately is basically that project could really use tokenization as a much better, as a much more usable way for incentivizing optimal use of the infrastructure, because a solar microgrid means that in the evening you have to get power from the battery, which is less effective. So you should use electricity when it's abundant, much of it during daytime, and at the night you should incentivize other types of electricity usage other than the productive types. And when we went into looking into that, we also realized incentivizing productive use of electricity is actually good. Good for the people because they use it in a way that generates income, but also good for the infrastructure because the capacity of the solar tinner is going to be ramped up much faster. So basically, you can have those token incentive schemes that are much more usable for the people because they're basically used to token systems already. They're mobile payments, and the way they access mobile communication is already tokenized, if you will, and when they enter the code, the same way they can top up their prepaid communication capabilities and their prepaid access to electricity. And once that happens, people know that this token is worth a couple of hours of communication or a couple of days of having access to electricity, and becomes a natural means of exchange for the people living there. Because it's really hard to get fiat money in sub-Saharan Africa because there are no ATMs around the corner. So it's actually a better system. And that was the takeaway. Tokenization makes this system better, especially in those villages. When we look at this community token contract that incentivizes the optimal operation, so it incentivizes the operator, and the optimal use of available solar energy in the villages, so it incentivizes the users, and it can be fed with the data from the smart meters and with other data that is available in the smart infrastructure of the solar trainer. So we can have an entirely automated system that is not just cyber-physical, but cybernetic. But what breaks and will keep breaking in every system that we're building is the investment side, the funding side of it. Because for that, we still need a lot of connections to the existing systems. We need the investors who come from a mindset that is not, well, that is still very traditional. And basically, I don't want to go into our design, but what we discovered just by mapping out the token model in this typical flow diagram, which is not even going into CAD yet. But you could already see what's going to be wrong with this token model when we deploy it, because we already see it in the model. This smart meter, this energy data, the oracle as we call it, will going to break because it's TEGG, or going to be broken quite often because that's where you can manipulate the system. The fiat token on ramp will going to take a long time, and it's going to be very powerful once it's there. And the third case was, as I mentioned, on the investor side, it still means the investors, the contributors are sending their investment into places where actually there's a lot of risk of losing that investment. And these were the three models, and the third one you can't even really solve with tech, but you really have to change their mental models. And the insights that we got is, okay, we need to solve also, look for more systemic incentives to deliver the correct data, to protect the smart infrastructure, the oracle. We need to find ways, incentive schemes for governments not to freak out when there are digital complementary currencies through tokenization. And basically, the realization that got us to solve the next problem was these investors are actually ignoring the effect of their investment, the impact of their investment, because they say, okay, if I send money to high-risk areas, I'm going to lose that money. The risk is very high. If you don't send it, you will keep that risk high. But if you invest in crisis regions and they get this infrastructure, they get the stability, the economic stability as well, then actually that investment has effectively reduced the risk of losing the investment. So that's something we figured out impact investors don't yet see it, because they don't have these mental models of the business dynamics, of the investment dynamics that they do. So that meant for us back to step zero and redesigning the ecosystem on purpose, because we want those infrastructures to be basically contributed towards, but we needed to solve for a lot of systemic incentives. And basically, we started that without the methodology, and I just found those people that could really make a change and help us with methods through the program that Angela also mentioned that is funded by Next Generation Internet, the Ledger program, and that is Ville, who designs business models for digital ecosystems. And he makes that in a way that we can actually use because it's very similar to what startups and business developers are used to, but it's based on really research from Simone and Eleanor Ostrom, which we really need to incentivize and to wire the right incentives in these decentralized networks that we're building. And the good thing is, we can use that as an input specification for modeling with CAD/CAD. Now, if you don't know what CAD/CAD is, maybe it's going to be a bit tough. As I said, it's a modeling framework, but you basically need to figure out what your inputs are. And we can use Willis research, or basically the templates that they're building, as a way to gather that knowledge, these requirements from the business. I have to, okay. I wrap it up a little bit. So basically you have to look for what's the highest value in your ecosystem. That's your ecosystem's missions, and you have to build your rainbow around it with the key players, the leaders, the contributors, the users of the system. And these are your agents and the outcome. And next, you can use the ecosystem member profile to actually map the value creation of each member towards that outcome. You have the characteristics, because that's going to rewire how they're going to behave naturally. You have the valuable assets that each member can contribute, and you have their valuable capabilities that will determine their actions in the ecosystem. And once you have that, you can plot what is called a motivation matrix, where you plot each agent or each actor in your ecosystem against each other and tell who is giving what valuable asset or what contribution to the other. And some may give and not get, and those may be the agents in your system that need to be given to through subsidies, for example, or through other means. And this is what CAD/CAD is called mechanisms. And the next step then, once you have mapped that, what will come naturally from who you included in your ecosystem, the intrinsic motivation for collaboration, you still need to see the corner cases and side cases and make this self-governance towards the outcome explicit. Because if you don't do it, no governance means bad governance. So, and this basically translates into what we call policies in CAD/CAD, and wiring that all up gives you your mechanism dictionary. And if you don't know CAD/CAD at all, you're going to be disturbed. But for those who are there, I hope this gives a nice intro into how am I actually going to use CAD/CAD, how am I actually wire that all up. Is basically you can come from these templates and have your functional requirements or your requirements specification in a way that that is needed for CAD/CAD, and you can start to code, run your simulations, run your Monte Carlo simulations, etc., and improve your system. So what happened basically is that we came up through token modeling with a better business model, that we enlarged our ecosystem because we saw we're not going to get the impact investors just by having that one digital energy assets in a crisis area, but we're going to get the impact investors over the edge if we can pool those digital energy assets in high risk but high social impact areas in developing countries with energy assets here in developed countries with more stable returns and revenue shares. So this was basically the aha moment that, yes, show me the incentives and I'll show you the outcome. That's so true. And now we have the tools to actually simulate those incentives and outcomes. So our ecosystem redesign, once we use those templates, also become, first of all, manageable by people who cannot code, but are perfect for business translation. So those behaviors, motivations, and policies are explicit and well documented. And once we have that covered, we have a requirement specification where the coders basically can use CAD as a framework to have programmable financial and programmable governance models, and that's a game changer. Because then we can literally A/B test our assumptions, and if they don't work out, we don't have to go out there and actually crash, but just rewire and redo. And by, as I said, cyber-physical systems like solar microgrids are perfect for it, because we're also going to get real-time feedback from the system how people have been interacted with the incentives that we deployed. So we're not driving blind anymore. And also that means literally our economies right now are driving and blind and are driven by blind people. And that's something we should really change. Okay, and that's something I'm super bad at because still we're all in the systems, even if it's tokenized and programmed, it's still all too human. Means we have our mental models and that needs change as well, and we cannot just reprogram them in your favorite programming language. For that, I mean, look at the challenges. 2 of 3 is not something we want people to do, but we want people to change in their thinking. Don't freak out, okay? Don't ignore. And that means before we even can show them the results, we need to get them to understand. And you don't get people to change and understand by telling them to do so. So we need to create ways where the actors can actually become co-designers of the system, where they can have their own aha moments, because without them, we're not going to get anything changed in the all too human world. And what works always is play. And that's also something I just recently discovered, and that means Ledger is really a good community, because 2 great finds in 1 month, it's perfect, and it's even better than the funding we got from the program. So Federico, Bonelli, Fred, and Rafa, they came up in 2016 with this board game, this table game, basically makes people understand collaboration, coordination, commons, trade-offs, and actually be part of the system that we can now program and simulate, but they can actually experience the effect of their doing and non-doing directly at the table within a game. So you can look for Le Grand Jeu. It's on GitHub, and it's something I really think we have to look more into, because we're dealing with people who are non-programmers, and we want them to be part of it. We don't want them to be manipulated, to be incentivized in ways that they don't understand and they did not consent to, because that's what we're currently trying to do. And we need to talk. I don't have time, but literally that was the tip of the iceberg. And it's very deep and very broad. And I'm really happy that within a year we came together. It's so much more experienced. And if we can have been able to manage that within 1 year, I'm really super excited for next year. And let's keep exchanging and talking and figuring out.
Okay, great, Shebnem, for this talk and for this, let's call to action as well. Thank you so much. This is your shirt. This is her Twitter handle, so feel free to connect with Shebnem. And I'd like to let you know that the CAD workshop is over, but we have a second workshop. There is the chance to join DWF for a Ask Me Anything session on token regulation. So whatever question you might have, take the chance. You can grab them in the workshop room and make use of their expertise and take advice for all legal questions on tokens. Now, we are planning for lightning talks to highlight some really good initiatives in the token engineering sector. We have 3 guests from blockchain projects, talking about what they are doing and planning in token engineering. But before having them on stage, we'd like to make an announcement for the token engineering meetup group. So you might know that token engineering meetups today has 17 local groups in 13 countries. And from the beginning, people were asking, hey, you're a token engineering group, why don't you launch a token? I mean, this is a good question, but of course, launching a token is easy, but what should be the purpose in it? And then the question, of course, is, for example, how could a token help us grow in the community? How could a token help us adding value to the community? And what is interesting for our members as well? And then we met Protea, and Wayne is with us today on stage. Welcome, Wayne. Give him a round of applause. And the Protea team has been doing research in what is relevant for digital communities, for global communities, and now has launched on mainnet, actually, a token economy and a system that helps driving and managing communities. And we decided to give it a try and to launch the token engineering token. And Wayne will now tell us more about this initiative. Thank you for being here.
Thank you very much.
Yeah, okay.
Hello. There we go. Hey guys, my name is Wayne van Niekerk. I'm the community manager of Protea.io, and just FYI, it's pronounced Protea, not Pro-T. And essentially, Protea is a wildflower unique to South Africa, and it symbolizes resilience and adaptability. And the reason why I say that is it survives wildfires, but not only that, it actually uses wildfires to pollinate, expand, and grow back stronger than ever before. And we at Protea.io envision these characteristics and strengths to resemble that of a community and what they should be and can be. So when we think of a community, we think of real people coming together around a shared vision or purpose, just like we are here today at TEGG. And with Protea, we are looking to unite real people and real communities by empowering them with decentralized financial tools, but also incentivizing them around community-centric interactions, with the use of token economics. So that brings me to Protea X, our protocol, which is an open source toolkit that we're looking to provide as the backbone for dApps looking to build emerging cooperative ecosystems. Now, Protea Gather is the first dApp that we've built on top of this protocol. And as Angela had mentioned 3 months ago, actually launched on mainnet. But today and tonight is launching on XDAI with the integration of a next level and next generation UX SDK called Bridged. Now, Token Engineering Global is one of the first communities or ecosystems to migrate over onto Protea Gather. And this is essentially going to enable them to use sustainable funding economics as well as tangibly reward their loyal members for the commitment and engagement. So what makes Gather tick? And I'd kind of like to look at it as 3 components. The first one is actually belonging to the community. So when you belong to a community on Gather, you are actually buying into a microeconomy. And this is made possible by XDAI bonding curves. And when you place your DAI into this community, you'll get your Token Engineering Global tokens in exchange. And essentially, these tokens will go into the community, and a small percentage will go to the community itself to assist in financial longevity, but the rest of that you will hold. And as the community grows and more people join, the capital that you hold in the community will grow in value too. So this rewards the community as a whole, but also rewards the loyal members. Now, the next component of Gather is sustainably engaging in a community. So something like Token Engineering Global is a meetup community, but we also have volunteering communities. And events and gatherings like these form a very integral part of that. And how can we sustainably engage that? So what we've implemented is a simple RSVP mechanism that you guys might be familiar with. is where this community capital that is sitting in your community, you can use as your skin in the game to put down and almost signal your commitment to attend an event or gathering. So let's say I've staked in 20 DAI to my community. I'm going to use 5 of that DAI to signal my commitment to say that I'm going to attend the event. If I attend, I get that stake back. If I don't, I forfeit. So the people that do attend get a portion of what was forfeited, and it's evenly distributed to them. So if you go to an event, you'll obviously get more than what you actually staked in for, or just what you put down. Now, the third component is not yet in existence. We are still looking into it, but I'll explain why in a moment, is being able to patron your community that you care about without losing any value. So imagine Token Engineering Global starts to earn automated interest on its collective capital. This provides long-term predictable financial stability for Token Engineering Global. So if I had to put the numbers to you, Token Engineering Global as it stands is roughly 3,000 members. If each member puts down 50 DAI, and over that year, that pool of 50 DAI per 3,000, well, each 3,000 members that's put in, essentially that will accumulate interest of roughly $10,000 US. This in itself is going to create sustainable community engagement to some level. And the way that the community wants to delegate the way that that interest is spent will be entirely up to them. And I think as the community's DeFi substrate matures, we'll be able to see how well that will accelerate and be integrated. So the reason why we haven't really brought the patron side of things to fruition is because we've actually, over the last 3 months since launching on mainnet, put a lot of our resources towards dealing with our UX hurdle. And this is where we've integrated a bridged with XDAI. And this is probably the first time that people have integrated these two technologies. And I really hope that what our developer, Ryan Noble, and our project lead, Florian, have done today, along with the assistance of our other devs, is pave the way for all the other dApps to follow suit, where we can really focus on UX to help people that are actually using our systems realize the value proposition behind the token economics that we're putting forward. And when I say this, Protea can now officially be accessed via any browser, not a crypto browser, not a crypto wallet or anything, any browser Web 2. If you needed to go on via your PlayStation's browser, you can access and interact with Gather. Not only that, you can sign up to Gather with your email and password while your wallet gets set up in the background automatically. When you want to sign transactions, it's like pushing a button on Twitter. And not only that, they're so fast and the gas fees are so negligible that this is by far the most frictionless UX we've ever dealt with. And moving on to this is that tonight will probably be the first time that you'll be able to experience such good UX. And we are so proud to say that Token Engineering Global is going to be migrating all of their meetup groups, 18 or so, around 13 odd countries, onto Gather. And that officially starts tonight, where we're going to interact with the XDAI testnet, and we're going to be able to sign up, join the community, RSVP to an event, and if you really want to, publish your own community on testnet. Get familiar with it, and then sooner or later, once everyone's familiar and the bugs are fixed, we'll move over to mainnet. If you guys have any questions, please feel free to find me outside, and I look forward to seeing you all tonight. Thank you.
Thank you, Wayne. And thank you to the entire team. So this is to the live stream. Thank you to the entire team of Protea. And greetings to Florian. Hello. It's really great to have this result tonight. Thank you. You get your t-shirt. There you go. All right. The lightning talks of today. First, I'd like to welcome Status IM and Status's co-founder Jared Hope on stage. Welcome. You kicked off a research initiative to evaluate various token models in the Status network. You have several, and you'll show us how you applied traditional means of financial evaluation to decentralized systems. Welcome, Jared.
All right, cool. All right, thank you so much. Well, what a long week this has been. I'm exhausted. Congratulations to everyone here who's still sticking it through. Give yourself a pat on the back. It's been a long week. I hope you've enjoyed it. Yeah, so I'm from Status. You might know us for our mobile Ethereum clients. It's kind of like a super app. You do messaging, have a dApp browser in it, and obviously a wallet. We try to be entirely peer-to-peer, and we try to run Ethereum on mobile devices with mixed success. Anyway, so we basically have a bunch of white paper promises. They've pretty much all been delivered. They're currently going through security audits. And I'll just run you through how we're starting to look at them these days. So basically, SNT is a compositional token of multiple utilities, which I'll talk about later. There's things like telenetwork, tribute to talk, our dApp store, which is like kind of like a curation market, these kinds of things. And we kind of built them earlier on without really understanding how much value that these things could potentially capture in the SNT economy. We also wanted to find a way that was easy to present to stakeholders of SNT, and we actually found this kind of useful for kind of thinking about our monetary policies around our crypto network. And we've actually modified some of our designs, which we think are actually a better UX, and actually capture more value at the same time, which is pretty cool. So basically we approach this by looking at how other investors are trying to evaluate the crypto space and how they're looking to allocate their resources. And it's also important for us as developers on how we think we should allocate our resources and what gets priorities. And some warnings and disclaimer. Basically, this is still early days in terms of evaluating crypto assets. If you're applying these kind of traditional financial models to the crypto space, we don't really have enough empirical data to know if that's actually going to work. So treat this as like pure research and just kind of like a bit of fun. Yeah, that's pretty much it. We also take a pretty narrow view. So at the moment, we're only looking at the net present value of each individual utility, but we're not looking how they interact, and we're not looking at other externalities. So things like improving the user experience and how that could potentially change value capture. The first thing to note is that crypto networks are not companies. So when you're evaluating crypto, it's pretty important to recognize that they aren't. The view that we used to have was that the crypto assets don't actually have cash flows. So using a discounted cash flow doesn't particularly work. However, we have found in our username that a variation of this discounted value flows kind of works pretty well. But what we tend to use from the other utilities is an equation of exchange. And this really lets us understand the flow of money needed to support an economy, and it actually becomes like a cornerstone in how we are looking at these things. And basically, the equation of exchange is kind of like looking at the GDP of a network. So that's the equation there, but how we interpret it is basically M is the size of the asset base. This is actually what we're trying to solve for when we're trying to see how much value it's capturing. V is the velocity of the asset, so how often does the asset change between hands? Price is P is the price of the digital resource being provisioned. It's important to note that this doesn't represent the price of the crypto asset itself, but instead the price of the resource being provisioned by the crypto network. And Q being the quantity of the digital resource being provisioned. So you can pretty much look at the on-chain transactions as kind of a log or a measure of this GDP of the crypto network. However, it's not perfect because a lot of those transactions are moving in and out of exchanges, and you kind of need to get rid of that. So token velocity, this is something that is kind of like really kind of vague at the moment, in my opinion, and accurately estimating that is a little difficult. But there was some research done at Coinbase in terms of how users interact with Bitcoin, and they came up with a velocity metric of roughly around 20. However, this does fluctuate quite a bit. So for example, in 2016, a lot of people were just hodling Bitcoin. They weren't really transacting with it, which actually meant that only 46% of all the transactions were using Bitcoin as a transactional medium. And then so in 2016, it did have this sort of velocity of roughly 6.5, just to give you an idea of the sort of variation that can be in play. So The other thing we need to talk about is discount rates or the cost of capital. And this is basically to determine what the future cash flow is worth today. But as we mentioned, crypto assets don't really have cash flows except for in some other instances. So what we're really doing is we're discounting back to a single future utility value to the present. So we're pretty much looking at the cost of capital, looking at a weighted average cost of capital. Really, there isn't a cost of debt, so all we're really looking at is cost of equity in that equation. And particularly finding out what the beta coefficient is. That is basically a measure of the volatility or the systemic risk. And so to do that, we're looking at CAPM, and we use Bitcoin as an index because it has the longest history and it has the most liquidity. And we end up coming up around sort of 15%, and that's what we use in our models. So for every one of our models, we have a set of standard variables. We have assumptions of initial count of current users. We have a count of basically the growth rate of those users, the churn rate of those users, both of those per annum. Because we are developing these systems, we also try to factor in a probability of failure, and I'll talk about that in a minute. And we try to look at a sort of 10-year holding period because there are some compounding things that we can play with. There is also the acquisition costs of users, and we measure that as basically a percentage of the lifetime value of a user. So the probability of failure is important for us because we are developing these things, and basically our burn rate is a risk factor. So we basically need to kind of estimate what we think is the chance of failure and factor that into our models, which helps us estimate these, what we think is going to be the value of these things for us and S&T stakeholders in the future. So basically, very shortly, we have these applicable milestones. If we're way later in the stage, we've deployed this, basically the value accrual is already kind of exceeding the cost of the capital that was used to deploy it. And so your probability of failure, we estimate it going to be roughly about 10%, and we use that to factor into our models. Then we work back from that. So the key metric for that particular model, if it's growing over time, we go, okay, the risk of failure is probably 15%. If it's positive in general, then it's 25%. If we finally deployed it to mainnet, we take it down to 40%. Active development, it's a 50-50, we'll see what happens. And if it's still being researched, well, 60%. The other thing that's really important for us is we are trying to create these decentralized systems, but it's, it's pretty easy to kind of tank the Ethereum network as it currently exists. So scalability is an issue. So if the particular utility requires scalability, then the probability of failure goes straight up to 90%, and we keep it at that. We also have another one that's kind of relevant to us, which is decentralization, because we don't want to rely on any sort of trusted intermediaries. And so in that case, we have different factors for whether it's highly decentralized, somewhat decentralized, and minimally decentralized. Yep, so basically, I won't get too shilly, but click those links, and you can basically look at some numbers, well, type them out or find the slides, you can't click it. But yeah, basically we've gone through these different models, and you can kind of see what we think is going to be the sort of expected value capture over a 10-year period. So this one's in particular for message forwarding within Status, because that isn't free in Status. Neither is inboxing, same thing. Basically, the probability of failure is 72% on both of those. And we're looking at the average price of the message stored or message forwarded, and the quantity available of messages both stored and forwarded. The dApp store actually doesn't use this. We pretty much base the model entirely on the size of the market and the expected ratios. Because it is a curation mechanism, and there's actually a better models for that, so it's a little relevant. But you can click on that and have a look at it. The dApp store is basically a curated market, kind of like an app store. Anyone can stake SNT, and get their DApp listed. You can stake more to get higher, but also then if you're being a bad actor, you can get slashed more. So, yeah. Tribute to talk is basically an economic barrier. So like in instant messages, you probably, or hopefully you're not used to blocking too many people. But in status, you don't really block people. What you do is you set a certain price that it's worth them communicating with you. So like, if you really don't like somebody, you set it as like $1,000, and if they've only mildly annoyed you, maybe $5 or something like that. The Teller network is a bit more interesting. This is a fiat to crypto exchange, something like local Ethereum or local Bitcoins. But the difference is it's entirely decentralized. It's insecure. It's being audited now, the contracts. So yeah, stay tuned for that one. It's pretty interesting.
And I think we will be happy to share all the links, but since we have only the lightning talk. Okay.
Perfect, thank you.
Thank you. We might pick up those topics again in one of our token engineering meetups. Thank you for coming, Jared. And we will share the links. You will get your t-shirts. Thank you so much for being here. The second lightning talk is TrueBit. Jason Teutsch. Welcome here. Come on stage. Yay! He just flew in. And Jason just published a paper for TrueBit. I think the rest is up to you. You will explain. Thank you for coming and thank you for being here.
Thanks, Angela. I'll take it from here. So, yeah, I'm going to be doing that one. Oh wow, that's better contrast than I got on. Wow, it's still kind of trippy though, right? Hey, great news! We have a token. This is what I need. I know you came all the way here to Berlin to hear that. TrueBit is a computation oracle for blockchains. Okay, so if you know what a blockchain is, if you're running out of gas, you can use TrueBit. If you want to run functions using normal programming languages, also can use TrueBit. So that is solving the problem of limited computational power of smart contracts. So yeah, and as we said, it's here. It's blockchain enhancement, also known as layer 2 that sits on top of other existing systems which enable scalable, trustless computation. And that's pretty much what you need to know for this talk. So if you think about it, there are really 3 things that are happening in this system in terms of, what do you need a token for? So one is, it's a system where anybody can issue a task, anyone can get a reward for performing that task. So we have a tasking function, we have a reward function, and we have the staking function, which we need for, somewhat technical reasons, but basically to eliminate spam and people who are doing wrong things. So that said, so as I said, the goal is to do decentralized trustless compute. So there are no distinguished nodes. That means basically no governance. It's a public permissionless system. So all these sort of what you would expect from a blockchain, I suppose. But what I really want to focus on today is talking about dynamic market pricing without price oracles, which might be useful in other contexts as well. But specifically here, because when we're just talking about, this is kind of a generic setup, right? So in other words, how much you're going to pay for a task, how much you're going to get for a reward. So in the case of a task, you want a stable task. Stable value for the cost of a task, right? If you bought enough fuel to fly across the Pacific Ocean and the price of fuel changed while you were on your way, you didn't want to have to stop in Hawaii because the gas evaporated due to the price fluctuation. Okay, fine. Simple example. And of course, if you're participating in the network as a solver, you want to make sure you're getting some worthwhile rewards. So obviously, let's talk about the elephant in the room. what's wrong with the single token? Why do you have to separate consumer and service tokens? So let's take in two examples here, simple as a case study. Ethereum, okay, so Ethereum, greater use of ETH, the Ether, the local token, implies higher price of USD. I mean, we kind of saw that in 2017, but it was also somewhat driven by sort of the miners sort of fixing the price of the gas price didn't change and the US dollar price went up, but really it could also be driven by real demand as well, I guess, for the network token. Okay, so this doesn't really scale. You can't, it's the opposite of what you want. As the number of users goes up, it gets more expensive. You're just going to cap out. So in TrueBit, what we have is you obviously, as I said, you want to pay for tasks with a stable token, and you want to pay the remaining rewards. These should be the ones that absorb whatever price fluctuations we have in relative to fiat currency. And it's always with caution, you don't want to ever design, well, I shouldn't say never, but I don't want to design a system where it pays out more than you paid into it, because now you've just created a spam machine where people issue themselves tasks and get rich. So, and in fact, nobody ends up winning because, well, that's supply and demand. Fine. So, so how do we do it? So I'm going to just outline our bag of tricks. The first thing that I call this like collective pricing. So dual staking. This means that every solver and verifier in the network, who are the ones that are performing your computational tasks, are going to stake both two kinds of tokens, the tasking token and the reward token. And they also, when they stake, they're going to provide a local price between the two of those tokens. So and in order to make sure they give you the right local price, anybody can now show up and exchange at that price. So if you priced it wrong, then yeah, so you've just permitted somebody else to trade at that price within some, say, reasonable bounds. And as I said, this is a technique that will generalize into external tasking tokens. I'm going to go on that later slide. Obviously, this is lightning talk. But the conversion rate. So the tasking conversion rate, this is the actual rate you're going to use here, is the median of all the local prices. So notice here I never talked anything about using an exchange or anything like that. So it's all internalized that the staking, what happens is, if you want to take, this is only going from, you can burn the smart contract of TrueBit allows you to burn the TRU in order to mint CPU tokens at the rate that's designated by this protocol. And if you want to go in the other direction, private tasks, check out the paper. Okay, fine. So now let's talk about CPU and TRU relative to US dollar and just ask the basic questions here. So I emphasize that as we have this stable coin, stable relative to the utility, not necessarily stable relative to the US dollar, but could be. And we fix, just say, one CPU token, always buys you one computation cycle in TrueBit, whether you use it today, tomorrow, or on your birthday. So question, what happens if the CPU price is too low relative to the USD? So this is something that could happen, and you might think people just walk off and stop solving. And I can argue the opposite, that actually rational solvers and verifiers will be incentivized to hodl TRU, and sort of the simple reason is that when you hodl, then the supply goes down, the total supply, net supply of CPU TRU conglomerate, and this effectively increases the reward value in the long run as other people are spending, and it increases the value to the people who are holding the token. So it's exactly what you want. So that makes it actually go back up. And on the other hand, if the price would be too high, then of course the solver, solver verifier that's holding TRU can absorb some of the value also by just changing the median price, what I call the tasking conversion price. So, and then of course, what happens if exchanges pop up? Obviously we can't prevent it from happening, but it doesn't mess it up. So that's again, lightning talk. So why, and of course, another question that might pop up is why can't you just use why can't you just use die? So for one thing, this doesn't solve the basic question, which is how to price a task. I don't know how many die should one pay for a task. And in fact, there's a big problem in TrueBit that if you underprice the task, well, if you price it so low that nobody else is going to do it, well, then you just solve it yourself and get whatever answer you want. So that's one of the sort of basic challenges that we're trying to solve here. And of course, you want a system which aligns miner incentives, builds network effects. What else do we have on the list? Let's see. TrueBit needs a stable token, which means token stable relative to tasks, not relative to USD. That's the airplane example I gave earlier. Existing stablecoins are, of course, increase complexity and or can decrease security. And the last point is that, of course, CPU itself is already a stablecoin, which is pretty simple because I was able to explain it in about 2 minutes. Okay, fine. So and then the last question you might be wondering is, okay, great. So now we have this perfect steady state system. How do we get there? So it's not, TrueBit is not like Bitcoin. You can't just turn on your laptop and start mining TRU because you have to put in a stake in the network. The other problem is if nobody had the tasking token a priori, then who's paying for the task that you're solving? So this means that you need to address the deployment issue. And there are different ways that you can do it. This includes, enabling external tokens to be used for these in tasks through these conversions. You could also, in the sort of really short term, stake with external tokens and possibly even use some sort of governance conversion whitelisting. Refer you to the paper there. And here's the paper. Oops. It's my first time using that app. So I'm perfect timing. Thank you very much. And thank you. Any questions? No
Thank you, Jason. I'm sorry. Thank you, Jason. Yeah, as mentioned, this paper is brand new. So take a look at it and get in touch with Jason as well. So you can find his contacts on our website. And of course, Jason, this is your t-shirt. Whoops. Okay. Thank you. Our last lightning talk is DidCraft, and this is also a very brand new, it's a project, not only an initiative. And there's Marvin Kruse with us, introducing DidCraft and your goal and what to incentivize in the open source sector. Welcome.
Thank you very much. Yeah, my name is Marvin. And I'm part of the DidCraft team, as she just mentioned, and today I'm going to be talking about DAO-driven software development and why this might be something to consider if you're in software development and especially in the open source area. So, yeah, we at DidCraft, we believe that software, and especially the source code of software, is the most valuable resource that we have when it comes to the advancements in our digital society. And since that is the case, we think that software has to be as secure, sound, and as the highest quality that we could imagine. And at the same time, the requirements that we pose on the developers are also getting higher and higher for them to deliver. And so we think that the burden on the shoulders of every software developer is able to be spread out onto the software development community, and this is what we're aiming for with DidCraft. So let me start out with showing you some of the pain points that we kind of discovered for software development. And the first one might be not very obvious to everyone, but we kind of saw that there is, kind of a little bit of malgovernment going on in the open source area specifically, because it's always a very small group of people that is kind of governing the whole development process. And especially for software like OpenSSL, for example, I think it's very hard to find at least one device in this room that's not to some extent using OpenSSL or anything, but very few people actually interacting with the code itself. So we think that even if it's very hard to say that it is malgoverned per se, there is still room for improvement to kind of govern code in a different way. The other point that we found is that open source and coding itself often lacks monetary incentivization. And often the development itself relies on the goodwill of the developers. I think OpenSSL is also a very good example for this, since we all saw with Heartbleed that yeah, it was basically just 2 people in charge of reviewing that code, and yeah, they, I don't think they are to blame, but it was only after the bug got discovered that they kind of started to fund the project a little bit more and have full-time developers working on that, which is something that is not very optimal for software that our whole infrastructure is based upon. So we asked ourselves the question whether a DAO could be a solution to this, or at least fix some of the points that I just talked about. And this is something that we at DIGcraft call the idea of a code DAO. So it's not like a classical DAO that you might know, but the idea is just kind of related to the idea of a DAO as well, and we combine that with coding. So at DIGcraft, we are considering ourselves to be a network that is aiming to incentivize developers, democratize the whole governance structure, and decentralize the aspect of coding. And we're doing that through basically 3 things. And the first thing and the most central one is the DIGcraft protocol. The basic idea is that if you want to change something in a repository, you need to get your community's approval before doing so. So in our case, it's if you merge something into the master branch of a repository, you need to get the approval of your community. If you're working in open source, it can be the whole world of developers. If you're working in a company, it can be your coworkers, which is your community in that case. So to do so, we kind of developed 2 things, which is the first thing is the DIT Explorer, which is, you can imagine like EtherScan or Block Scout. We can go through all the proposals that are there. You can visit the profiles of a contributor, of the repositories as well. And yeah, you can browse through all of it. It's all online, so you don't need to be part of our system to look through it. So I highly recommend to just go there and check it out. The other thing is why we also have on our t-shirts our tagline, "DIT is the new Git," is our idea of creating a decentralized version of the Git client. Because if you want to have one point where you can attack these problems that every developer is familiar with, it's Git. You know, because everyone uses Git, we just wanted to create something that is like an augmented version of the client that includes staking and voting on the XDAI chain. It's all live. And from there on, you interact with our smart contracts that kind of give you all the features of the protocol. So to touch a bit more on the protocol, we basically have 2 classes of actions that you can do within our system. So the first one is what we consider a good action is if you vote on something and the majority agrees with you. So if you vote to accept a code change and the majority also accepts it, you did a good action and you receive the stake that you initially posted, which is an XDAI. You receive it back. And you mint something that we call knowledge token. A knowledge token is something that is not transferable. You can't buy it, sell it, or do anything with it except for using it inside of our system. And it's also created according to which area you are currently interacting with. So if you vote on something, on a code change that's written in Java, for example, you will get knowledge tokens labeled with the label Java. So if you work on something with C, it's another way around. So if you do the opposite, so if you vote on a code change and everyone else sees a bug there, but you say, oh no, it's fine, we can accept that, you get your stake slashed, and you also lose a significant amount of your knowledge tokens, which is why you're incentivized to kind of behave and do your job properly if you review code or if you develop code yourself. So what do I do now with these knowledge tokens? You can use them to kind of grow your weight in the vote that we're using. So if you, for example, are an expert in C programming, and there are 3 people who don't know really what they're doing, they just voted to accept a code change, but you see a critical bug, you should be able to outweigh them, not by your money, but yeah, by your knowledge, which is something that we find particularly cool, to kind of have influence on something with your knowledge and with your bank account. So why would you be using all of that, and why would you be using the code DAO is what I'm going to tell you now. Is the first thing is we created a monetary incentivization for developers. So even if you're not part of a software project, you can earn a bit of money on the side or whatever. You can grow your reputation by interacting with it and reviewing their code through the votes. Also, through our knowledge token, we created something that is a community-vetted reputation system. So you can use it for just, I don't know, hiring reasons, or just to see where you're good, where you're at, and compare yourself to other persons. So we kind of have this reputation system that we created. And something that I think is very interesting is because, yeah, we see it, the probably most familiar with proof of stake, which is, yeah, kind of based around the idea of the more money you have, the more power you have in that governance idea. So for our case, it's not based on your money. You can't stake anything more or less than anyone else. You always have to stake the same thing. But the only really difference that you do or that you have is the knowledge that you have. And I think that's very cool to kind of have a knowledge-based approach in all of this. And the last thing that I want to mention is the early bug discovery. What I mean by that is, since when you do regularly software development, you probably only you wait until the end, until you're kind of done all of it, to go to an auditing firm or do kind of code reviews at the end. But with our protocol, since you're doing continuous merges into the master branch that are always getting reviewed by the community, you get this continuous cycle of reviewing, and this can also increase the quality of your software and yeah, discover bugs early on, which is pretty cool, and kind of lightens the work of reviewers, since they don't have these thousands of lines of code at one time, but always this itinerating cycle, which is pretty nice. So yeah, as this is kind of the end of my talks. I'm just going to ask you, what are you waiting for? It's all live on the mainnet. If you are interested in that, you can try it out. You can try the client. It's all live. You can use it. So the only thing that we're actually really eager about is, yeah, just experience. We need your feedback. We need people to use it, because we can design tokens all day long. We just need people to use it and see how they use it and whether they're actually accepting it and if it works. So yeah, if you're interested in that, just check it out or hit us up. Thank you.
Thank you, Marvin. Thank you, Marvin, for being here. And just to let you know, we will have the videos of all the talks online. So also for sharing did graphs amongst your peers, we will publish it on our website, TEGG.io. And also feel free to reach out to Marvin for further discussing did graph. Thank you for being here. And now we are coming closer to the spectacular conclusion of this event, the TEGG. And I'm very happy to welcome Jeff Emmett from the Commons Stack on stage. And he will present us, yeah, give him a round of applause. Yay! This is the mic. You present us what Commons Stack has in stock for the Commons and token engineering.
Thanks very much, Angela. And thanks everybody for sticking around to the end of Friday of a long week. That's really awesome. I'm excited to see all the smiling faces here. A couple sleeping, but I don't blame you. Cool, so my name is Jeff, and I'm here today to talk about the Commons Stack and the tools that we are building to scale the Commons to reprioritize people and the planet. Do I have a clicker? Where did that go? Ah, here. Perfect. So I think it's first good to establish why are the commons important. So there are some really big problems on our horizon that we can only solve together. We have climate change, resource depletion, global social unrest, and actually I'm going to add one more up here that was a really great lead-in from the last lightning talk, open source incentivization. These are all public goods that are not that are prone to the free rider problem. So you produce these public goods, and this free rider problem underlies all of these, extraction of environmental resources, of the usefulness of code, for example. So if you haven't heard of that, definitely look into it, because this is basically a large coordination problem that underlies some of our biggest challenges moving forward. There's a lot of interesting talks and research done by Elinor Ostrom and other commons advocates that say basically we need larger coordination mechanisms to determine social rules over how we allocate these resources. I mean, we have some of these already, but there's something wrong with our current approaches. So we have markets, we have states, these are global coordination mechanisms, but they have some problems. We have one-dimensional economies that maximize for profit, and they optimize out people and the environment. We have outdated governance structures that are reactive rather than proactive with the problems that we face and the speed at which we seem to make more and more problems for ourselves. And we have a lack of global coordination around the resolution of these problems, which leads to a breakdown of cooperation on a global scale. You have nations coming together to resolve climate change, for example, but country A doesn't want to do anything because country B is not going to, and country B is not going to because country A won't do it, and all of a sudden we have runaway climate change and no way to address these issues. But solutions do exist. There are cooperative structures, commons, basically communities that come together around these shared goals, and they create value-aligned economies that value their local communities and their local environments. They have local governance that is a non-hierarchical decision-making, which is really important. But these small communities rely on trust, and trust today is person to person. There's nothing wrong with that, it's a wonderful thing, but it doesn't scale. So we need to be able to scale trust and scale these coordination mechanisms to be able to apply the solutions offered by the commons at a global scale. Luckily, there's this new technology you may have heard of called the blockchain. So we have this opportunity for global trust networks, essentially. We can align economic incentives with these community values. We can give communities economies and allow them to encode their community values within those economies. And by doing this, we can scale these rules of commons into global networks that are protecting our most valuable resources. So this is essentially what the Common Stack is trying to do. We are trying to scale trust using the blockchain, and we are trying to scale the commons using these components that we're building. So we are building an open source library of blockchain components that enable purpose-driven communities around any cause, whether it be planting trees, cleaning up trash, or producing open source components for the betterment of humanity. And we're giving them the ability to raise and allocate funding, to make decisions, and to measure impact. And this is what a future tech stack for the commons may look like. We have various shelves of tools, from governance to funding, proposal tools, analytics tools, simulation tools, initialization tools, and this list could go on and on. The key here is that these are interoperable modular components, so any project can take the pieces that are relevant to their community, combine them into a token network, and basically create, this is almost like an SDK for DAOs. So you can take any of these components, you can interoperably combine them and launch your token network around your community goals. So this is a future vision of the Common Stack, and we'll zoom in a little bit to where we are looking at, where we're looking at starting this. So we would love to build a minimum viable commons, and we've identified these 4 key components. The augmented bonding curve would provide sustainable funding for communities. The Giveth DApp is providing proposal and escrow service. We have conviction voting, which is a continuous decision-making governance process. And the Commons Analytics dashboard allows us to measure the impact in this community and determine whether we are producing the value that we want to as a community. And we will be launching these in an iterative engineering approach. So we'll be building each component one by one and launching them into a beta test environment, inviting communities to join in, and testing out how these components work and seeing how we can improve them in our next code base iteration. Once each of these 4 components are built, we will synthesize them into a minimum viable commons, and we think this will be a new standard in token network design. So the important thing to note about the Common Stack is it has a rigorous token engineering foundation. So we're not just building these components off of an idea in a white paper, we are starting with token engineering tools and processes like CAD/CAD. So each of these components is modeled from mathematical first principles, designed and implemented, and we are producing a library of robustly designed components that can then be forked and used in any commons initiative or open source project. And of course, anything we learn from those live deployments, we can collect data and improve our model. So we're turning this into an engineering design process, which is going to revolutionize the entire crypto industry. So the funny thing about complex system design is it's really complex, and anybody who's spoken to Michael Zargham at any length understands that. So we're not asking everybody to start from mathematical first principles, but this is where these components come from. We start with defining conservation laws, then we model these systems in token circuit diagrams, and then we simulate these systems to see where their systemic failure modes are before we even write the first line of code. Now the great thing is you don't have to go and do this mathematical modeling. You can use the Common Stack components, trusting and understanding that this robust design is already baked into these components. You can just fork them, customize them to your specific community need, and move forward from there. So now that we've looked at the overall system of the common stack, we're now going to zoom in on the first component, because each of these is quite a complex component. We could talk for days about them all, and I would encourage you to speak to us afterwards if you're interested in any specific mechanisms. We'd love to dive deeper into any of these. But for the rest of this talk, we'll just talk about the augmented bonding curve, which is essentially a sustainable funding mechanism for your community. And we believe this will resolve the problem of open source incentivization, which the last lightning talk really did a great job pointing out the issues with that. So the augmented bonding curve is a token bonding curve. You've probably heard about these before, with some slight mechanisms to address some of the attack vectors and issues with bonding curves. So as I mentioned before, it provides sustainable funding for your project and community, and it has two different phases. There's the hatch phase, which is an initialization period for the bonding curve, and then there's the open phase where it's live to the public. They can purchase, they can sell from the bonding curve. And I'm going to walk through each of these phases and just explain how that works. And let's do that. So the hatch phase is a community crowd fund to initialize the funding pool and the collateral pool behind your bonding curve. So this is different from most bonding curves. Most just have a collateral pool. But by separating these into two separate pools of value, we're creating two different uses for the token, which brings some stability that we'll talk about in the next slide. I'll show you in a diagram. Sorry, the slide after this one. So essentially a community comes together, this is the hatch phase, and they fund this community pool. So they put in some money into the bonding curve, that money is split by some community determined percentage into a collateral pool and a funding pool, and they're issued some token from the bonding curve. Now this token has two purposes, as I mentioned. It is worth a claim on the collateral pool, so you can burn it back to the curve and receive some value, or also, it gives you governance over the funding pool, so you can use this to vote on how community funds are spent. And this is the bonding curve on the right. I'm sure you've seen these before. It's a little bit confusing to look at these because it looks like the price just keeps going up forever. This is actually not a time graph. This is the amount of collateral behind the bonding curve. So as people buy and sell, it can go up or down this curve. So just to correct, this isn't a magic money-making machine. But yeah, this is the collateral, and the price is actually on the y-axis there. So now we're moving into the open phase of the bonding curve. So you can see that as the price goes up, you may expect that people want to sell their tokens. They are interested in reclaiming the collateral behind those tokens. So you have this pressure pushing you down the curve. But then as more and more people exit the economy, the people who are left have all the governance over the funding pool. So there may be other people who want to exert governance over the funding pool. Maybe you have projects that you want to have funded by your community. So there's this opposing buy pressure. So the interplay of these two forces creates volatility in the market in some acceptable range. And that volatility is actually turned into continuous funding through the exit tribute mechanism. So each time someone leaves the community, this is again a preset amount when you are initializing the bonding curve. In this example, we give 10%. Every time someone sells some of their community token, they pay that as a tax into the community funding pool. So this basically ensures a sustainable funding mechanism for this community to continue doing work. So to recap the augmented bonding curve, we are basically creating circular regenerative economies that can be used by any community, any open source project, anyone who wants to coordinate a community around a goal. So we have incoming capital that is split between the collateral pool and the funding pool. We have funds flowing from the funding pool to complete proposals and provide value for the community and perhaps the world at large. In the case of the open source industry, we are producing public goods that can be used by anybody. And you also have exiting capital, which produces this circular flow from the collateral pool into the funding pool. So you have sustainable funding for your community. So this is a narrative showcase of what we can do with CAD-CAD. This is a simulation that we've run up. I would love to run it for you, but we don't have internet here. I'll provide a link in just a moment. But you can see here on the left-hand side, we have all of the initial conditions of this curve, so you can determine the amount that goes into your collateral pool versus your funding pool. You can set the initial price of your token and the post-hatch price of your token. You can determine the amount of your exit tribute, as well as the vesting half-life, which protects the initialization period before this community establishes value for itself. And you can approximate how much you might raise from your community. And when you run this simulation, you can get some interesting information about, I mean, this is obviously a simulation, it's not predicting how your economy is going to go, but the green line is the value of your community token, and more importantly, the blue line is the accumulation of funds that is continuously flowing into your community funding pool, which can be spent according to your governance processes on work within the community. So you can see this community in this example has raised 2 million DAI over a 52-week period. So this is just a narrative showcase of what we can do with CAD-CAD. This is before a single line of code has been written in the augmented bonding curve, but we can use simulation tools like CAD-CAD to understand where these systems are going to fail before we even get into the coding of it. So if you want to take a look at this demo, it's up online, abcdemo.commonstack.org. Feel free to play around with it and see how it can be useful for your community. So now that we have an idea that these augmented bonding curves can provide sustainable funding mechanisms, where can we use it in our crypto space? I mean, we have ecosystem funding DAOs popping up all over the place, and they're targeted towards specific purposes. We have Moloch DAO that is looking to push forward with Ethereum 2.0. Metacartel is focusing on UX. We have art DAOs. We have open source DAOs. We have all sorts of different communities that are conglomerating around causes. And all of these groups could benefit from using the augmented bonding curve as a sustainable funding mechanism rather than just relying on member donations. And there are other challenges we can tackle within the DAO funding, ecosystem funding DAOs as well. So today we have no accountability of funds. If the community says we should fund this work, the money is dispersed and we just kind of cross our fingers and hope that it gets done. It's not really a sustainable way to move forward with this. We have all sorts of on-chain voting issues all over the blockchain space. That's a fairly hot topic. And we have a lack of impact measurement. So are the proposals that are actually carried out useful for the community? How do we know? Well, this is essentially the roadmap of the Common Stack. We are building components to address each of these issues one by one, and then synthesizing them into a minimum viable commons that can be easily forked, easily used by any of these communities who want to solve these issues and move forward into an age of decentralization. So we have an invitation for the community today, because we've realized that research and development is a commons as well. It's providing public goods for the entire community to use it's non-rivalrous, it's non-excludable, and therefore it falls prey to the free rider problem as well. So we need an ecosystem funding DAO to forward token engineering R&D in the blockchain space. And our invitation to you today is to come together as a DAO to take the augmented bonding curve as soon as the component is available and launch the Token Engineering Commons. And the idea of this is to unite all of the siloed researchers who are doing token engineering research essentially in their spare time. I've spoken with many of them myself. Most of them are getting paid by client work, doing things they don't want to do, and doing token engineering research in their spare time. And I believe that this discipline is going to forward the blockchain ecosystem overall into the next level of maturity. And I think the Token Engineering Commons will provide a sustainable funding mechanism for all of those researchers, basically a higher level incentive framework to unite them around the common cause of maturing this industry. So we're going with an old school tranche style raise to fund the development of each of these components. The cool thing is, once we build this is the last time anyone will have to do an old school tranche style raise, because from here on out, we can use the Common Stack to fund open source development of all of these endeavors. So we have broken this out into component by component and synthesizing this into a minimum viable commons. We are an open source project. We got here to this point through contributions of labor and finances, and we are more than open to contributions from the token engineering community or the blockchain community in general. And we are really excited to start building these components. We have a lot of ideas. We have tested our assumptions. We have simulations. And now we're ready to get moving on building these components and providing these open source tools for the community at large. We have a dedicated, experienced team with decades of experience in the blockchain space and other incredibly relevant fields. And we have some of the top token engineering advisors that are lending us their wisdom and expertise in making sure that we are moving forward in the most judicious way to build these open source components. We also have a very strong legal team who's looking at the future legal framework of DAO ecosystems, because this is, of course, an important entanglement we need to keep our eyes on. So I'm here today to ask you to join the Common Stack community to help us help you realign our economies and prioritize people and the planet. And if you would be interested in joining, the link is right here. But before I close out today, we have one more announcement. A year ago, actually, at the first unofficial token engineering global gathering, perhaps, a tool was announced that has the potential to revolutionize the crypto industry by introducing an engineer's loop of simulating, modeling, and testing these systems before we go to code. That tool is CAD. You've heard about it all day, I'm sure. And our team and advisors think this is such an industry-critical bedrock for token engineering that we completed an internal raise, and we're happy to announce that we are open sourcing CAD today.
Yay!
Thank you. So jump into the repo, have a lot of fun, and join the the Common Stack community. We are looking to coalesce a community of people who are interested in using token engineering tools and token engineering practices to move this discipline into a new level of maturity so that we can tackle the biggest issues of our times together. Thanks very much.
Thank you, Jeff. Great. And thank you to the entire Common Stack team. So this was TEGG 2019. Thank you for staying with us. It's awesome to really have all the people in the room following all the talks. I think we have earned a decent drink now. So we'll move on to Republic Beer Garden. It's just 5 stops with the S-Bahn away from here, Janowitzbrücke. Perhaps you know it. We should have a map here as well. Zurück. And yeah, so just 5 stations from here. It's just to hang out, to talk, and to have some drinks and also dinner. And yeah, this is the map. It's Janowitzbrücke, Republic, Berlin. And the time you need to travel is way enough to take a look at protea.io tag. So you can try it out and sign on to the Token Engineering Protea Gather group, and also trying and testing RSVPing, and then have a trial on how this works out, and could be managing an RSVPing for a Token Engineering meetup group in the future. I'd like to thank you for being with us, for visiting the tag. And of course, I also like to thank all the people who have been contributing to the tag. So this is the DAppCon for hosting us, Chris Paruk for co-curating tag, Jonathan Gabler, Jeff Emmett, and Jacob Huckel for supporting this vision from day one. You remember our early phone calls on it? Daniel and Sarah from Ocean Protocol, and also the entire Ocean Protocol team for supporting us over the last year. Big thank you to you as well. Yeah, give some applause. Lorente for the designer who did the great design for the tag, and Alex for communications. And please come on stage, this amazing team of volunteers for tag. Come on, give them a big hand. because they did such an awesome job, and it was so great to work with you and to, well, be on this journey together with you, and really you deserved great applause. Thank you so much. Okay, see you at the beer garden. See you at the next Token Engineering meetups. We will share links and materials. Sign up for the newsletter, follow us on Twitter, and stay up to date and join in into all our future activities. Thank you. Bye.